Very good morning. You're watching India Market Open, and we can hope for a bit of a quiet day today, as consolidation is the name of the game. You know, sometimes quiet days are not half bad when you've had too much action.
It's that old proverb, right? May you live in interesting times.
May you live in maybe sometimes quiet times is also fine. So I think results will be in focus, stock specific, but at least the big issues, trade wars, geopolitical wars, regional conflict, on pause for now.
Yeah, and some consolidation in the global indices as well, which is not bad. But the interesting thing, I mean, the standout headline for me over the last 12 hours, etc., is the IPO pricing by CATL, right? At the top end, it'll be the world's biggest listing in 2025. Just kind of underscores the sentiment in China. There's an HSBC note which says that the Chinese investors, they're saying this, but I'm saying this, that the Chinese investors are now doing what the Indian retail investor was doing, which is put money into the equity markets.
Interesting.
So, yeah, pretty interesting what's happening at that side.
Yeah, I would assume that anyway, China has a very robust equity market in any case, but not the kind of widespread that India was seeing recently. Yeah. Is that because in comparative terms already you would have a larger bulk of Chinese investors?
Yes, but the Chinese investors for the last 12 months to 18 months were sitting on large pools of cash.
Now
they didn't want to put in. Right. They're starting to do it.
Interesting.
Yeah.
Could be
Makes sense after the big, sword over their head is off in terms of US China trade. But yeah, so it's a mixed day of trade as far as global markets is concerned. The mood overall does remain upbeat on that very factor. That's the US China trade deal. Key indices saw, like I said, mixed. S&P 500 closing up in the green, Dow mildly in the red, but the story really staying with the NASDAQ and tech stocks. I don't know if any of you all saw those visuals of top US corporates and CEOs lining up to meet MBS in the meet with Saudi Arabia and the United States, and Trump there ushering them all one by one. So AMD, Nvidia, all of that still in focus. Bond yields are steady, as all eyes now on key economic data which will come in next couple of days. What will be important will become PPI, that's the Producers Price Index. You will see first cut of jobless numbers coming in, so that becomes key. Ahead of that, the 10-year at 4.54%. Gold prices have dipped sharply as fears of economic recession ease. So even as a lot of people have been coming and saying how gold is the best bet, there has been some cool off. Spot prices were at $3,180. Oil prices have also dipped after a sharp run up, Brent at the $65 mark. Asian markets opened largely in the red and continue to be there. As far as India is concerned, you're looking at a completely flattish kind of a start. There you go. 2 points up. So it's going to be neither here nor there. You're going to have very specific action which will determine the flow today, and result focus will be one of them. Key sectors will be what drives it, and perhaps the defense move as well.
Oh, absolutely. It's been a fantastic move for the defense pack as a whole over the last couple of days. But let's talk about what happened in trade yesterday. And you had buying both by foreign institutions as well as domestic institutions on a net basis. Foreign institutions buying to the extent of 930 odd crore rupees, 316 odd crore rupees pumped in by domestic institutions. But it was an interesting session because you saw for the benchmark Nifty 50 quite a bit of chop and churn. It gained about 0.4% or ended there, but it was pretty much in the middle of that range. It was a 230-point range for the Nifty 50 through the day, and it was quite choppy. It recovered from trading in the red for a little while. But the breadth was actually very positive. 38 stocks on the Nifty 50 gained ground, led by Tata Steel's 4% move on the back of its earnings. And it continues to trade, by the way, above all of its key moving averages, substantially so above the 200-day moving average of about 600 plus points or thereabouts. The broader markets have outperformed yet again, and that's where you can take heart. The Midcap index gaining about 1.3%, small cap index ending higher by 1.4%, and the market breadth overall strongly favored the advances, ending in a 4:1 ratio in favor of the advances. Defense, as Tamanna pointed out, was once again the top sector. In fact, take a look at the top performers. The defense sector was up about 3.2% or thereabouts. Metal was up 2.5%. Realty gaining 1.7%. Energy up 1.4% as well. The underperformer and IT was up about 1.3% or thereabouts. But banks underperformed in trade by about 0.25% was what they dropped. And finance as a whole was a pack that underperformed in trade yesterday. But do remember that they have outperformed in the recent past. The question, Neeraj, I think is that broader market strength, does it continue?
Yeah, I mean, so one we can look at yesterday's trade as volatile and selling at higher levels, but I think it also showed the unwillingness to correct despite the selling at higher levels, because from the lows we recovered. So the markets came off, and the last 1 hour showed that pickup from the lows on the large caps. The mid caps, of course, are doing well, which is a great sign. And third consecutive day of outperformance by the broader market, showing some remarkable strength. Again, look at the delivery percentages, right? Nifty 500, and don't necessarily only look at the percentage gains by these stocks, but Sapphire Labs, 88% mark for delivery. You could argue maybe there's some bulk deals that happened. Thermax, not getting deleted from MSCI, 80% mark for delivery, 2.5%. Sundaram Fasteners, not necessarily a very highly traded stock, 77% of the quantity mark for delivery. So some serious buying is happening into stocks in which there is a whiff of a reason. So and the broader end of the spectrum, the non-Nifty names, which is actually a really good sign. We see these things happening in smaller names like RACL, Geartech, for example, would have seen some serious delivery-based buying because Malabar India Fund went in and bought about 1.88 lakh shares. And typically when such bulk buying happens, those smaller stocks see some serious delivery percentages. No, I'm talking about RACL, Geartech. But for a Thermax or some of the others to do so, these are not necessarily the most liquid names, and they are seeing, or rather very liquid names, but seeing some serious delivery-based buying, which is actually a good thing. And I'm guessing in terms of sectors, yes, defense is numero, there is no questioning that, it's just on a roll of its own. But metals, not bad. And I think with this China sentiment turning positive, metals may continue to outshine. I mean, yesterday Tata Steel did what it did individually, but also the metal pack amongst the larger packs was amongst the best performing ones. And this CATL IPO pricing or some of the others all leads to fact that maybe there is some optimism around China after this resolution of the trade tariff, and that may help the metal stocks because it will just positively impact the metal sentiment. So maybe that's another bucket that you want to keep an eye out. It won't do a defense, but it'll do okay.
Yeah. Metals, and I would reckon maybe a re-rating in some of the auto stocks. I mean, Tata Motors by itself, a poor set of numbers, but a lot of overhang on auto stocks was also because of a lack of clarity on trade. So as that settles, maybe you'll see some, relief over there. Even commercial vehicles and tractors, maybe not yet. Street has not yet recognized that there might be an uptick over there. So we'll wait and see how those go. But rotational plays the game. Just a few more maybe factors that you'd want to watch. Of course, Nifty closed about 0.5% up on May 14th, staying within Monday's trading range. The index continues to trade well above all key moving averages, signaling a bullish trend. Index is likely to move gradually towards the 24,800 to 25,000 zone as long as it defends crucial support around 24,380. Immediate support lies at 24,500. Now, while short-term consolidation may persist, the index is poised to test the 25,000 mark if key support levels hold. Bank Nifty was down about 0.25%. Formed a bearish candle for the second straight session, but still trades above all key moving averages. The index also held above Monday's low, taking support at the previous record high from September 2024. Market direction will be influenced by corporate earnings, weekly options expiry, and that's really the big one. That's the big factor where you're seeing a quiet start, but the weekly expiry, Puneet, is what will move the markets today. What's the setup looking like?
Well, thank you for that. So definitely in terms of, since it is the expiry day, we are expecting a narrow band in terms of trading. In the short term, one of the levels will be 24,700 to watch out for, while the long term, support stands at 24,500. Currently, just 6 points in terms of Nifty implied open is what's indicating. On the Nifty bank as well, we are expecting a narrow band of trade. Some stocks that might react will be based only in terms of earnings. In terms of the both call as well as put option open interest, the maximum level yesterday we saw 4 calls was at 25,000. That's a big candle that you can see. It's continuing to maintain that level as well. While the 24,600 level has also been seeing consistent buying. That's another key level. Apart from that, we saw yesterday on the put side there was a new level on 24,200. A lot of open interest created yesterday on that for the put open interest, and 24,500 remains one of the key levels for the put option investors who are making that call and having an increased open interest on that level as well. Let's finally just look at some of the key stocks in terms of both open interest distribution gainers as well as losers. in terms of gainers. First, we've seen some long build up on stocks like NCC as well as Tilaknagar. Also some on Shree Cement as well. Came out with its earnings yesterday. JSPL has seen some kind of, I think most stocks have seen short covering in terms of, open interest losers. We've seen some on Tata Tech as well. Apollo Tyres also one more stock which is in focus on the back of earnings, largely in line as well. So overall, we are expected to trade in a narrow band, but will be interesting to see if we can break that 24,700 level early in the trade and maintain that throughout the day.
Okay. So those are some of the factors that you need to look out for, but it's all going to be stock specific. So let me start with the ones on my list. Eicher first, it's a thumbs up. From our side, revenue is up 23.1% to 5,241 crores. A tad above Bloomberg estimates as well. EBITDA was up 11.4% to 1,257 crores for the quarter. And just in line, I would say, with Bloomberg estimates. Margins have seen a bit of a hit at 24% versus 26.5%, and this is below estimates, so you might see some pain there. But net profit was also up 27.3% to 1,362 crores versus 1,070 crores. Again, a beat on estimates. They've recommended a final dividend of 70 rupees per share for FY25. Now, here are what the notes are saying. Citi maintains a buy. They've hiked the target price to 6,200 from 6,050. They say that the Q4 EBITDA is slightly below estimates, and other income has also buoyed PAT. The demand outlook is positive as management expects tax cuts to bolster urban demand in FY26. Rural demand is already healthy. They believe that volume growth might not percolate down to earnings if the margins remain weak. Morgan Stanley, on the other hand, maintains an underweight. They've hiked the target price to 4,079 from 3,855. They say the volume focus was there in Q4, but margins were a miss. EBITDA margins have missed estimate by 100 basis points. It's the second consecutive quarter of a similar kind of margin miss. Growth over margins is the right strategy, but the stock pricing is high growth and high margins. So a bit of a mixed view there on Eicher.
Just the interesting piece is I was talking to Puneet that when the last time in quarter 3, you mentioned these 2 quarters of a miss, right?
Yeah.
Last time, I remember it was an 8% downtick on the stock because of this margin miss. Wonder if maybe this time will be different, but wonder if it's an encore of a sharp downtick on open, or does it not? Because the brokerage notes that you highlighted seem to be pretty sanguine. So
that's the thing. There's this sort of a mixed view, and this has been hotly debated in our newsroom this morning as well. Viewers on, whether Eicher is. So we decided not to cop out and just say in line or neutral, because one way or the other. The reason for the thumbs up is that on most metrics, they've not done too badly, and the management commentary is the reason why I've chosen to give it a thumbs up, because they are saying that the tax cuts, which we have not yet seen what they will do, will boost urban demand.
Yeah.
So
I think the Citi note stated that rural is anyways looking strong.
Rural is anyways looking strong. So
interesting.
Which is the reason. But then, of course, this is a long-term view. We're not in the business of predicting what's going to happen in the first 5 minutes of trade. So Tilaknagar, the next on my list. This is clear. This is a thumbs up. Key highlights of the company's strong quarter and highest ever quarterly EBITDA. High value and volume-led growth has boosted the numbers. Strong market share gains across all key states. So these are the results. Revenue up 14.3% for Q4 at 881 crores. EBITDA was up 63% at 78.4 crores. Margins have jumped up well. At 8.9% versus 6.2%. Net profit is up 2x at 77 crores versus 31.4 crores. There were exceptional items that have increased by 62% to 64 crores. So if I look at the adjusted PAT, it's still up about 95%. So this is what's worked. In terms of operational metrics, volume growth of 20.1% year on year has been seen. So this is one space which continues to grow. Jubilant is the other one. Now, Jubilant is an interesting one this morning because what I'm looking at right now is the numbers. I'm looking at the numbers. I'm not looking at the sentimental impact of their business from Turkey. So in terms of the numbers, they've delivered a better growth than peers and saw market share gain. That's what the thumbs up's for. There's a strong margin outlook as well. Revenue is up 33.6% to 2,103 crores. And better than estimates. EBITDA is up 24.7% to 389 crores. as well. Margins are at 18.5 versus 19.8%, a bit of a dip there, but better than estimates. The Bloomberg estimate, for example, was 17.5%. Net profit is down 76.9% to 48 crores, versus 207 crores as well. The company had an exceptional gain. That's because of base year, because in FY24 Q4, the company had an exceptional gain of 170 crores. Now, here's the tricky part. They, of course, have bought DP Eurasia. That's business in Turkey, Azerbaijan, and Georgia, which contributes 23% to top line and 27% to EBITDA in FY25. The total investment of the company in DP Eurasia is about 1,400 odd crores. And according to management, business is cash and profit accretive. Citi says buy on Jubilant Foods. They've hiked target price to 805 from 750. They're saying they're delivering market share gain, growth and possibility. LFL continue to outpace other QSR players. That's like-for-like growth. And they say that we see scope for re-rating. Jubilant is our preferred pick within our QSR coverage. That's the Citi view. Goldman Sachs, meanwhile, has maintained a neutral. They've hiked their target price to 730. Their commentary is that it's a strong quarter on all fronts. Revenue growth momentum is sustaining, driven by like-for-like growth. EBITDA margins have begun trending upwards as operating leverage improves. So now, this is the tricky bit. Even if I look at the 1% downtick yesterday, if I say that was because of anti-Turkey sentiments, I'm not sure if that will continue today, because at the end of the day, markets are a very practical beast. They will look at the numbers today, and that, of course, is a larger and very important issue.
Yeah, no doubt. All right. So the stock that I picked at the start is Hitachi Energy, and if there's companies that have benefited from India's power story, this is definitely one of them. And take a look at the numbers, right? Look at the revenue uptick. It's about 11% or thereabouts. The EBITDA has risen by as much as 31%. This is on the back of an improvement in the margin. It is coming at 12.6% during the quarter, and it's a substantial expansion compared with the previous quarter. The PAT number is up as much as 62% as a result. But really the big piece that will likely bolster the stock in trade today, as it did yesterday, is the order book. The fact that the orders have risen by 55.7% in the fourth quarter, came in at 2,190 crore rupees or thereabouts. And this is supplementing what they saw in the third quarter as well, where they saw over 10,000 crore rupees of order come through. The order backlog, as things stand right now, at the end of the year, is at 19,246 crore rupees, which is very, very substantial. So the focus really for this company is going to be on execution more than anything else. The second company is a real estate company, Brigade Enterprises. This is a thumbs up. It has beaten its FY25 pre-sales value guidance growth of 15 to 20%. The volumes have remained pretty flat on a year-on-year basis, and that's because of what occurred in the fourth quarter. We'll come to that in just a bit. It has reported also a robust growth in its average price realizations. But take a look at the Q4 operational trends. The pre-sales volumes number stood at 2.03 million square feet, and that compares with 2.72 million. Pre-sales value has increased, as we spoke about, 9% year-on-year, came in at 2,448 crore rupees or thereabouts, and collections have increased by as much as 5%. The average price realization is up 47% though, and that's quite a considerable number. It has launched 4 million square feet of residential projects during the quarter, and the leasing revenue rose as much as 34%. Do remember that the company has upcoming projects to the extent of 12 million square feet in the upcoming 4 quarters. So do bear in mind that the real estate pact was in focus, has been in focus of late, and this should be looked at positively by the street. Tata Power is the last counter that we'll talk about, and that I will talk about rather. It's a thumbs up on the back of a meet in most of its metrics. The revenue is up about 8% or thereabouts, in line with expectations. 17,096 or thereabouts crore is the number. The EBITDA has increased by a healthy 39% or thereabouts, and come in ahead of expectations at 3,246 crore rupees. The margin has stood at 19%, so it's quite a substantial expansion versus the previous quarter, and it's come in ahead of consensus estimates as well. The previous quarter number stood at 14.7%, and finally net profit has increased by as much as 16.5% to 1,043 crore rupees, and that's more or less in line with expectations. So watch out for this in start.
Okay, the next set of stocks and the 3 on my list, Lupin came late last night and modest beat, guys, I thought. I don't know if you guys differ on that, but revenues up about 14%, EBITDA up 32% though, which was a highlight, and margins at 23.3% versus 20%. So strong move there on the margin front, as a result of which the bottom line number also went up quite a bit. Now, you know, the revenue growth was led by North America, which was up about 19% YOY, and the EBITDA margin improvement was led by operational efficiencies. Now, I was looking at the JP Morgan note that we have, that Sumit shared earlier, and the key positives according to JP Morgan, the good show on margins despite material uptick in R&D spend, healthy growth in the US, likely driven by strong ramp up in Mirabegron, which is one of the key drugs for them, and continued momentum in EMEA. The problem area or the question mark is the soft growth in India. That is one thing. And I think when we talk to the management, the outlook on the India business growth is the most important thing or one of the key monitorables. But suffice to say, maybe the stock shows a bit of a positive move today. Muthoot Finance was interesting because strong AUM growth and credit cost improvement being seen. So total income up 43% at 4889 crores, NII up 36%, and the resultant bottom line uptick was about 42%. The gross NPAs cooled off quite materially, 3.41% versus 4.22% quarter on quarter. Now, Morgan Stanley says that FY26 is poised to be another year of very strong earnings growth. However, they are equal weight because they say that the stock appears to be fully pricing in the cyclical positives, which is high growth, high gold prices and the defensive positioning, with the valuations at about 2.6 times price to book value. I think the 5-year average is about 2.4 times. Their estimates are 2.3 times, or their valuation metric is 2.3 times. So maybe it prices in the positives according to Morgan Stanley. So may not be a very strong reaction, but the results by themselves pretty strong. So if there is a strong reaction, you know, because of the results, if it isn't, it's probably because of the valuations. And the third one is Wendt. Now, we don't often see this. I think the last time that this happened was probably with Whirlpool. And now we're seeing this with Wendt, wherein the promoter entity is going to sell a very large stake via an OFS route. 37.5% stake via OFS. The company holds about 75%. The floor price is at 6,500 per share. I think the current market price is 10,460 if I'm not wrong. So sharp discount, naturally so, because they want to sell a large stake in a very illiquid counter. We don't know how this moves ahead, but yes, 37.5% stake is a very large one. They're nearly halving their stake in this entity. So watch out for Wendt because of the promoter stake sale. But guys, they're just a clutch of very, very other important names that we will talk about during the course of the show, because today too, much like yesterday, is a day packed with news flow.
Yeah. And I think one important bit of news that we should address, and this data that our colleague Sumit Sarkar has put together. So India's relations with Turkey and Azerbaijan are strained due to their support to Pakistan, their criticism of India's strike on terror camps, and the fact that they provided equipment to Pakistan during the conflict. So the boycott Turkey call has seen a massive spike in cancellation of bookings. Now, while trade with both Turkey and Azerbaijan, as far as India is concerned, are limited, we enjoy a surplus. The question now is, and the focus is turning to companies that have strong relationships and an impact on their balance sheet from their businesses in Turkey. Now remember, we're not calling for a witch hunt, we're not calling for a boycott, we're just merely putting together for you a list of companies with exposure to Turkey, and Sumit Sarkar is helping us do that.
Well, yes, firstly, let's start off with the economic exposure. Now, if you look at India's economic exposure to Turkey and Azerbaijan, it's quite limited. In fact, if you look at the exports that we have done so far in FY25 till February, to Turkey, it stood at close to $5.2 billion, which is just 1.5% of the total exports that India is doing. With Azerbaijan, it was as low as $86.1 million. When it comes to imports from Turkey, it was around $2.8 billion, and from Azerbaijan, it was around $1.9 million. So very limited exposure and trade surplus with both the countries. Now if you look at the tourism data, now here's where the major impact could come in for both the countries, that is Turkey and Azerbaijan. For Azerbaijan in 2024, nearly 2.4 lakh Indians visited the country, and Azerbaijan's tourism board was expecting the growth to be around 11% for the next 10 years. So there is where the hit can come in. For Turkey, around 3.3 lakh Indian citizens visited the country in 2024, and the average spend was around $1,200 to $1,500. So on an average, around 4,300 crore rupees was spent by Indian tourists in Turkey in 2024, and that's where the hit could come in. And for Turkey, it is more important given the fact that tourism is one of the key contributors to the GDP. Nearly 12% of the GDP number was coming in from the tourism sector. Now let's look at the companies that have exposure to Turkey and Azerbaijan. But do remember, this is not an exhaustive list. We have tried to compile as many as companies that we could get who have some or the other form of exposure to Turkey and Azerbaijan. When it comes to Jubilant Food, this is the only company which has the biggest exposure to Turkey and Azerbaijan, because they had acquired this DP Eurasia company back in 2024 for around 1,440 crore rupees. Now this company has an exclusive master franchise of Domino's Pizza in Turkey, Azerbaijan and Georgia. Now this business, this segment contributed nearly 23% to the top line and 25% to the consolidated EBITDA of the company in FY25. When it comes to Indigo, it seems like Indigo might have a bigger exposure given the fact that they have a code share agreement with Turkish Airlines. But if you look at the seats deployed or the capacity deployed by Indigo towards Turkey or Azerbaijan, it's very low. The seat and capacity growth was at 5% for the Turkey country. But if you look at the seats that they have deployed overall, compared to the total number of seats that they have, is just 0.5%. For capacity deployed, it's just 2% of the total capacity has been deployed to Turkey. And when it comes to Azerbaijan, the number is very less. The seats deployed is just 0.1% and capacity deployed is just 0.2% of the total capacity that Indigo has. Moving on to some two-wheeler companies or the auto companies. Now, if you look at the auto companies, multiple companies have exposure to Azerbaijan and Turkey, but none of them have more than 5% exposure to both these countries. Mahindra and Mahindra, Bajaj Auto, Hero Moto, TVS Motor have operations in Turkey. M&M has an R&D and manufacturing facility of tractors. But if you look at the number of units that they're selling in a year in Turkey is less than what they sell in a month in India. Two-wheeler companies like Bajaj Auto, Hero Motor and TVS have sales offices in both these countries, that is Turkey and Azerbaijan. When it comes to Dabur, now they have exposure to Turkey because of the acquisition that they had done back in 2010. It's the company is called Hobby Cosmetic, and the exposure to the top line from this company comes to around just 3 to 4% odd. Polyplex is another company which has a significant exposure. They have a Turkish plant which contributes to the international businesses of the company, and that contributes around 5 to 6% to the top line of the company. Polyplex market cap of this company is close to 3,500 crore rupees. Apart from that, there are some bigger companies, but again, the exposure of these companies is less than 5%, could be around 2 to 3% as well. There are companies like Dr. Reddy's, Sun Pharma, Reliance, UPL, they sell a lot of chemicals. IOCL, they buy some crude from Azerbaijan, and then there is TD Power, which also has some exposure to either Turkey or Azerbaijan. But then again, the exposure is not more than 5%, and this is not an exhaustive list of companies that have an exposure to Azerbaijan and Turkey.
Okay, so very exhaustive list that has been put out there by Swamit. So at least it's important to know right now what is the exposure of which country to what extent to Turkey at this point. We'll take a very short break. On the other side, we get your top trading strategies for the day. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Back with India Market Open, and let's welcome in our first guest on the show today, Parag Thakkar, Head of Fund Management at Fort Capital, with us in our studios. Parag, bye, great having you. Thanks for joining in. We are no longer at 22,500.
Absolutely.
Nearly 25. But all tensions behind us.
Correct.
Global and local.
Correct.
Is this the time to add on, or is the earnings delta not strong enough for you to put money to work?
So I would like to say that, see, as you very rightly said, and this is my my submission, that at the lower levels I always remain more bullish. I always think of good things like India's macros are very strong. Oil is at below 65, and that's what we told last time, right, when the markets were down. Now when the markets are up, you should remember the bad things. Right, and so but definitely you should be dynamic, and our by the way, our fund's name is dynamic, so we stick to it, and so we'll be less bullish, and as you said, more selective. Like for example, last time on our show I told cement is something I'm betting on big. That continues, and after Tata Steel, what they said, Tata Steel's interview, that Europe business will turn profitable. Tata Steel is something which we are already having, and we might add on. So I would say that there are select pockets now. It is not that entire market is a buy. Of course, IT can see a good rebound, because now the worries around US recession are receding because of this US-China trade deal going through. So I would say that IT, and that is also where we have, for example, we have TCS, HCL Tech and Mphasis in our portfolio, and we are equal weight in IT now. Because the TCS, HCL Tech offers you 4% dividend yield. And if US is going to turn around and the recession's worry are going to ease, there can be some discretionary spending revival next year. So I would say that, as I said, cement, IT, metal.
And a lot of commodity bets, huh? Cement, metals, etc. Interesting.
But I would say
where there is a value. So banks were earlier, banks were earlier my top picks. In banks, I am very selective now, because ultimately, looking at the inflation numbers they are coming, the rate cuts can be far more and faster enough than what we think. And so if RBI does not support it with OMOs and does not provide enough liquidity into the system, so then banks are in a soup, because then banks' margins can take a hit with every rate cut which happens.
No, so I was just commenting on the point that you made, when everything is time to turn bearish. But it's been barely a few days. Let's enjoy this for a little more time.
Not bearish. I'm not saying I'm bearish. See, with a country like India, where you have so strong macros, you cannot be structurally bearish.
No.
I'm bullish. So 90% of the portfolio is invested.
So let's come to the sections or the stock sectors that you think are now overheated. So for example, PSUs, defense for one, rail. Do you think that story, it's time to get out of it and stop that celebration?
Yeah, so we keep on booking profits when we feel that there is a euphoria, there is too much of recency effect in the market. Because of this India-Pakistan war, again, some themes are getting reignited. So we have to take advantage of such situations when market wants to buy them, grab them at any price, and we give it to the market.
What are your top exit calls right now?
So see, because it is stock by stock in my fund, I cannot discuss it. But as you, but thematically, yes, I would book some profits into defense and railways in this massive rally which is going on.
And not cement, despite the run-up?
Yeah, cement I am structurally bullish because, see, I'll tell you, something which is at the bottom of this earning cycle. For example, as I told you last time, December, Q2 and Q3 were worst for cement.
Yeah.
Right? Because government was not spending, RBI was very tight, and all those situations have changed. And entire industry, if you look at commentary of Ultratech, if you look at commentary of Ambuja, if you look at commentary of Shree Cement, entire industry is bracing for higher profits now because they have seen that 5 years their profits have not gone anywhere. Right? And as I said, if you set up a new plant, it costs you $80 a ton. So you have to make at least 800 rupees per ton EBITDA.
Yeah.
So basically the entire, and see the results of Nuvoco Vistas and Birlacom.
Yeah.
Luckily I own both the stocks. They have reduced debt out of their internal accruals when 9 months were very bad. In just last quarter, Nuvoco has reduced debt by 390 crores. Birlacom reduced debt by 800 crores. Right? Now, just to extend that point, in those markets, the demand is good. In April, May also, in East, the prices have gone up by another 10 to 12 rupees per bag. Nuvoco sells 75% of its cement in Eastern market. Right? So, and see the discipline in the industry about improving profits and reducing debt before going for a big capex. So, Birlacom also announced a capex. Which is a very competitive capex, $73 per ton, 7.5 million tons at 4,300 crores. And before that, they reduced debt by 800 crores. So they brought balance sheet into Nuvoco also, reduced debt, brought it down to below 4,000 crore from 6,300 crores.
So,
and now
you said you were lucky to have it because it's run up very quickly. I'm assuming that you're going to wait for a little while before adding more?
Yeah, those kind of tactical calls we cannot discuss and that's why I keep saying that just don't blindly follow what I say in here because at the fund level you have to manage it dynamically.
Of course.
Because there we have to take care of our investors.
Just because Parag Bhai is kind enough to speak more openly than most fund managers, and we always appreciate, doesn't mean you don't do your own
so
homework.
put a disclaimer again. Don't follow my advice if you are doing a daily trade, intraday or something. Take your advice of your financial advisor before taking a call. These are just 2-3 year views. If it plays out early, I'm happy to sell at a profit.
Be dynamic if you are following dynamic.
Oh, God.
Amardev Singh, Senior Vice President Research at Angel One with us as well. Amar, great having you. Thanks for joining in. How are you approaching trade, Amar, this morning?
Yeah, very good morning, and thank you for having me on the show. So we've been bullish on the benchmark indices, and because the way the markets have bounced back very sharply, and also across sectors, we've seen this happening, and across multi-caps as well. So I think from that perspective, and if you look at the trend on the charts, that also has been positive. What we are seeing is definitely at higher levels, 24,800, 25,000. That's going to act as a zone of resistance for Nifty because if we see the move has been very fast from 8th of April. So we've seen that very fast move of almost 13-14% from those levels. So we are bullish on the market, and any pullback is a buying opportunity. As far as Nifty is concerned, we see that 24,400. 500, that should act as a zone of support. So any pullback towards those levels is a buying opportunity. Upside 24,800, 25,000 is a zone of resistance. On the talking about Bank Nifty, we are seeing some sort of weakness. Earlier it was Bank Nifty which was outperforming. Now we are seeing some sort of selling pressure on the daily charts, which is restricting Bank Nifty from trading above the 55,200 levels, which would act as a zone of resistance. Whereas on the downside, Bank Nifty is strongly supported around the 54,300, 400 zone. So it's more of a trading play with a positive bias, no doubt. with Nifty being stronger as compared to Bank Nifty as of now.
Okay, Amar, let's get your picks very quickly.
Yeah, sure. So the first stock is NBCC. This we've seen some very sharp move in this week itself. It's up almost 15-16%. So this is one stock one can look at buying at the current levels or any dip towards 105 with a stop loss of 97 and an upside target of 123. And the second is Mahindra and Mahindra Finance. So what we've seen that this stock has made a very strong bottom and the stock is inching higher. So currently it's around 259, 260 levels. So any pullback towards 255, 256 is a buying opportunity with an upside target of 283 and a stop loss of 234.
Okay, since we are on expiry day, Amar, what would be your strategy?
So I would say that I would be more on the buying side. So I would like to rather go for a bull call spread, provided we see some correction in the Nifty towards 24,600 odd levels, 50-60 points correction. From there, we could witness a bounce back. So one can look at a bull call spread would be a better option.
Okay. I believe that we've got, so Neeraj just pointed out, we've all pointed out, there's so many stocks to look at this morning. We've addressed a few. Let's go straight across to some of them, actually. And we've got several small cap howlers to talk about this morning. Among them, Sheela Foam. There is, in fact, the margins which have come in at 3.9% versus 9.5%. And the PAT as a result has fallen as much as 66%. Watch out for this in trade. ADF Foods, here as well, there's an underperformance on the EBITDA front. It's down about 28%. The PAT is lower by as much as 36%. Indian Hume Pipes, the revenue is declined by as much as 3%. And here too, there's a contraction in margins. It's coming at 15%. Compared with 18.9%. RACL Geartech as well. And
that's
here
the reversal. So that's not a howler because independent of the results, Malabar India Fund has, so let's remove that small cap howler topic from RACL Geartech because
it's not relevant.
Buying by Malabar India Fund makes it a really interesting one.
Interesting. Parag, you want to comment on any of these? Do you have coverage on any of these?
No. So I would not like to comment because we don't own the stocks in the portfolio.
Okay. I do want to ask you about another stock though. Hitachi Energy, it was something that I looked at very closely yesterday and the numbers seem very good. In fact, that order wins number in the third quarter was very, very good. In the fourth quarter is up over 50% year on year. They're ending the year with order book of 19,000 plus crore rupees. What do you make of it? Is it too expensive?
Yeah, so basically all cap good stocks I feel, especially MNC ones, are very, very expensive. So I would say that that is one. But I saw, and again I don't hold it, but Tata Power results looked interesting to me because their Orissa Discom has shown a fantastic profit, and that they acquired when the stock price was 85, and now stock price is of course 400, but I think that has played out very well for them. And so this Discom buying Discoms and turning them profitable has become Tata Power's mastery, I would say. So I would watch out for it. I think it was an interesting result. So and as I said, I remain bullish on power generators at a good price because it's a
But generators, you don't like the ancillary companies.
Ancillary companies, wherever I see value in terms of good valuation,
Where
definitely.
do you see value?
So right
don't
now,
give the names, but
no. But I'm saying not much. Everything is very expensive actually.
T&D, transformers, nothing.
So I'm saying, I'm not saying the valuations don't offer too much of comfort.
There's a lot of interest in the space. You're saying that it's a little oversaturated.
Yeah, correct.
Okay.
Okay, so another set of, not stock specific, but I think an important story that we should address, and Alex, this is something that you've been digging up on. A lot of screaming headlines that, X number of SIPs have been cancelled in the month of April. And why that's important is because it gives an inference as if there is a big panic among retail investors. But your digging has found quite another reason. No,
absolutely. And this has to do with a regulation change from last year. Starting April 2024, SEBI directed mutual funds to tag SIP accounts or SIP folios that had been paused for 3 successive installations as cancelled. Now, this is important because in April of last year, they started doing this prospectively. There was a headline, there were a few headlines that talked about a 300% SIP cancellation in the month of April, and this is misleading. Understand why. First of all, a SIP cancellation is, and this ratio is basically cancelled SIPs as a percentage of new SIPs that have been added during the month, right? So what has AMFI said? I spoke with them yesterday. They've said that they've undertaken a one-time cleanup of their SIP book in April. And what has happened is that before April of 2024, there were several legacy accounts that were not prospectively cleaned up at that time, and that number stood at 1.62 crore. And so that big chunk of dormant SIP folios was taken out in the month of April. And so as of the 14th of May, in the latest update, the total SIP number stands at 8.89 crore rupees, and that is down from 10.05 crore rupees at the end of March. The contributing SIPs, and this is where this is very important for you to understand, you see that gross SIP flow number, and that's at about 26,000 crore rupees. It hit a record high in April. The contributing SIPs at 8.38 crore is simply the number of SIPs that have contributed to that gross number. So that really is a number for you to pay attention to. Now, why is this important? On a net basis, the number of folios have actually gone up in the month of April by 27 lakh from 8.11 crore in the month of March. What AMFI has said is that this is a one-time cleanup. It's done now. And so on an ongoing basis, assuming that the equity markets now go up as they have done in the recent past, and there are no new changes and focus is on earnings and several other things, that domestic flow and through retail investors, through SIPs will continue.
Yeah. So I think that's an important clarification to make, that there is no big trouble as far as SIPs are concerned. But we have so much to cover this morning, so let's get through it as fast as we can, because we're aiming to give you the maximum information before markets open. HAL is one that we want to focus on. Of course, numbers came in yesterday, but a lot of brokerages notes this morning. Nomura has retained a buy. JP Morgan maintains overweight as well. Anushi, what are brokerages saying about Hindustan Aeronautics?
Hey, morning, Tamanna. I'll start off with JP Morgan first. Now, they've maintained an overweight rating on the stock, and this is with a target price of 5,040 that we are looking at. Fourth quarter result. Now, this was a beat that they're seeing in terms of where the EBITDA margins were concerned. Now, do note that the company came out with a margin of around 38.6% compared to 39.9% this year. So, the expectation for a margin contraction was higher. So, a beat on that is what we are looking at. Quarterly P&L can be volatile due to the nature of business in terms of where the order execution is concerned. So that's why it's important to consider a quarter-to-quarter basis scenario also for a company like Hindustan Aeronautics. Now, Nomura has a retained buy rating on the stock with a target price of 4,700, which is a 2% of an upside that we are looking at. A marginal beat in the top line is what they're seeing, with adjusted EBITDA ahead of expectations. Now, the company has a strong order book of 1.84 lakh crore. We saw about a 90% of an increase compared to last year. But it's the prospect pipeline which is interesting, of over 1.4 lakh crore. So this order book continues to give execution, gives execution growth visibility over the next 5-year period itself. Even in terms of where the balance sheet is standing, we saw a reduction in the net working capital days as well. Even in operating cash flow, there was an improvement of a jump of 66% that is seen. Stock currently trading at about 37 times basis on its FY26 earnings. Nomura maintains a buy call on this stock. So this is the overall view that we are seeing for HAL.
So HAL in focus. I'm sure you'll see some of that defense play today as well. I think Parag Thakkar's view is very interesting this morning, saying, time to exit if you've
not exiting on huge profits. Just to put a disclaimer, we have HAL in our portfolio.
You saw the numbers?
Yeah, numbers. See, basically, HAL, you cannot actually see numbers quarter on quarter. It says a 6-year order book, right? Correct. So when which order will get executed, the margins, revenues will depend on that. So it's a long-term view which you have to take and dynamically manage the position, because I was significantly overweight. So I would like to trim it at in this rally, because see, market will give you opportunity, right? Then again, there will be a sector rotation where this theme will fade away a little bit after this geopolitical tension eases out. That is the time you get in at a lower level. So
while we're on the topic, and I know you've spoken about defense per se, but I do want to ask about these shipbuilders, right? So Garden Reach, for example, yesterday 14.5% up. And the numbers were good. Nobody is denying that. But the question is that justified?
So basically, see, in defense, because this is a very high entry barrier business, right? If you even just to start your first supply into defense, it takes 2 to 3 years for you to get approvals and all. And so the business always deserved a higher multiple than it got. But in between, after COVID, definitely government's focus was on something else. It was not getting that attention. I remember Cochin Shipyard and Mazgaon Dock were trading at 300, 350 rupees, and only legendary investors like Damaniji used to buy that stock at that time. Yeah. When the net cash in the company was 30% of the market cap and PEs were 10, 12. So I've seen those times. So now to see them at 25, 30 times, it looks little bit. So it's I would say individual issue that you have seen something at 350. Now you cannot buy at 3,500.
I think you'll admit also that maybe it goes to 45 times also,
I
right?
admit that.
It may go to 45 times also, but you can't buy.
Because what I see is that HAL is one stock where there is a huge entry barrier, right? Because what it makes, nobody else can make. So at 37 times FY26 or 31 times FY27, I don't find it too grossly expensive. And with a 6-year order book, with all the chances of order book further improving. But rest of the stocks, we have seen them trading at such a low prices like Garden, all this Cochin Shipyard or Mazgaon Dock.
So there are some winners in this space and there are
100%.
some who are just riding the bandwagon. I suppose sifting between the two is. I just wonder if you saw Jubilant this morning. I mean, yesterday's numbers.
So basically, there are so many results that it is very difficult to look at all the results.
I agree completely. But just in that consumption QSR theme, there was Jubilant. I think there was Westlife as well.
Yeah.
But any views over there at all?
So basically, it is just that the overall entire consumption space has suffered in last 1.5 to 2 years. Right, in India, nobody is able to show great growth. Jubilant, of course, has done well. Westlife has done little bit better than others, I would say. But there is no big growth as such, and the multiples look very stretched right now, as of now. But of course, these are long-term growth areas in India where the
burgers and pizzas are not going to go out of fashion.
Yeah. So at some point, it will look interesting. But today, I feel the valuations are far stretched for the growth. Which is actually looking, in short term, the growth is not looking that great.
Actually, so Amar, would you want to come in on levels for any of these? So one is Jubilant Foodworks, of course, it may start off maybe, if the brokerages are to be believed, marginally higher, but there is also this overhang of Turkey, part one. But also, if we haven't spoken to you about specifically the shipbuilding names, because those were the big movers, right? Garden Reach Shipbuilders, Cochin Shipyard and HAL. I'm adding HAL to that list. So these 4 names.
Yeah, so Jubilant Foodworks, I would say it's more or less clearly indicating some sort of consolidation. And the trend, though the long-term trend is positive, but intermediate, we are seeing some sort of consolidation because it's unable to breach the 720, 730 on the upside. Whereas on the downside, it's strongly supported around the 640, 650 zone. So I would say it's more of a range play, but with a positive bias. Talking about the other stocks which you mentioned, I'll first talk about HAL. See, HAL is very strong on the charts. So the correction which the stock had witnessed from almost 5,600 levels to 3,000, that was definitely a very good buying opportunity. And looking at the structure of the chart as of today on the intermediate term basis or the long term basis, that continues to remain positive. And what we've seen is that the stock has taken out its previous top, which it had made in the second week of December. That was somewhere around 40, current levels only, 4,700, 4,750. So sustaining above 4,800 is something which is very important. Then the stock could inch higher towards the 5,000 mark. And looking at the other stocks which you mentioned, Cochin Shipyard, if I talk about. So Cochin Shipyard is also broken out of a resistance zone. Earlier, it was unable to breach the 1,500 levels. So it's taken that out, but it needs to sustain above the 1750 for any further upside meaningful rally towards 2,000 mark. And lastly, to talk about Garden Reach, which you mentioned. See, this stock is stronger on the charts as compared to Cochin Shipyard on different time frames. So I would say, and it has breached its resistance or the tops which it had made in December. So this is one stock one can definitely look at initiating an entry, but not at the current levels. because the stock has got good support coming on the 2000, 2050 levels. But the upside for the stock has a potential towards 2350 levels in the short term.
Got it. Okay, Amar, we'll leave it at that. Thanks much for taking the time out and being with us today on the show and giving your insights. Now, the other bucket to watch out for could be pharmaceuticals, because there are 2 or 3 names which are in news today because of results. Lupin, steady set of numbers, good margin expansion. Could it react positively remains to be seen. Piramal was a bit of a howler, and considering what CDMO companies have done, Piramal didn't quite perform well, so maybe Piramal Pharma sees a downtick. And then Blue Jet, which came out with numbers yesterday. But the analysis of the numbers, and by the way, viewers, we'll talk to the management today. It's an interview you don't want to miss, because the numbers were very, very strong. Now, Parag bhai, do you track any of these? Any view on the CDMO space, because that seems to be working for almost all companies?
Sure. So basically, Lupin, as you said, a steady set of numbers. I think the numbers were in line. And another 2-3 quarters, you will see good numbers from Lupin, in my view, because that's what I have understood, that some of the products which are getting approvals will get operationalized. And so the numbers will remain good, at least for this year. It looks to be a decent this thing. And of course, now that the worry around entire pharma space is also, I would say, taking a back seat little bit, because the Trump's order which came out was not that risky, was not that negative. And it is for innovators to reduce the prices and not the generic ones. Of course, there will be some rub-off impact on generics. Coming to CDMO, of course, the China plus one theme remains. India's capability in that space is fantastic. Up till now, we have saw good results from, as you rightly said, Blue Jet, a very good result. I saw a result of Sai Life Science, which was decent enough. Of course, the EVs will report again a fantastic number, but Piramal was muted. So I would say that, and this is my view for the entire market. I would like to extend this to the entire market. Now at closer to 25,000 Nifty, you have to see it bottom up, company specific. See, most of the macro worries are behind.
Yeah.
Most of the geopolitical worries are hopefully behind.
For now.
For now. So now, and that is being factored by market also.
Correct.
At 25,000, right? So now it is company specific, bottom up. You cannot take a blanket view that it's a buy market. Yeah. You cannot take a blanket view on any particular sector. It's a blanket buy. Even in cement, for example, I would be selective. Right, because in some stocks the entire this price increase thing has been priced in. So that's why I was coming to, for example, Nuvoco, where the stock is at replacement cost. So stock has not done well anything, not done well actually, because of some selling by some institutions. So I would say that these are the stocks where there is a earning trajectory. This quarter they generated 390 crore cash profit.
Yep.
And market cap is 12,500 crores. And they repaid the debt of 390 crores. So I'm saying that, you have to be stock specific in each sector and across the market.
This is where I suppose we come in, where we help you make a call based on all the information that you need. We need to take a very short break, but we're right back. Pre-open rates, brokerage of the day, and a lot more on the other side. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead.
Welcome back. Just as we wait for the pre-open rates, a quick programming reminder. We have a superb defense analyst coming up next. We'll tell you what to do in this space. But the other focus right now is paint companies. Paint companies have come up with their Q4 results. Most of them actually, not all. But Mahima is joining us to tell us how they fared. I think Berger stands out, right Mahima?
Absolutely. Berger is standing out, and we've seen market share gain consistently for Berger Paints. Now, in terms of how overall Q4 has panned out for three major companies, that is Asian Paints, Berger Paints as well as AkzoNobel. Asian Paints did miss analyst estimates completely. Berger Paints was a beat in terms of what the analysts were expecting, and overall numbers for AkzoNobel were largely in line. In terms of how the financial performance fared, Asian Paints revenue was down by 4.3%. Net profit did see a dip of 45%, but for Berger Paints, revenue was up 7.3% and overall PAT was also up 18%. For AkzoNobel, revenue was up 9% and PAT growth was overall flat. Now, in terms of operational metrics, in terms of volume versus value growth, Asian Paints saw volume growth of 2% versus that of 7.4% growth for Berger Paints in terms of volume, and value growth for Asian Paints was around 1.4%, but Berger Paints has managed to grow in terms of value as well by around 4%. In terms of what has happened in terms of commentary on demand, Asian Paints has said that demand to remain subdued in first half of FY26. So the demand pressure will continue. But Berger Paints has come out and said that demand to improve drastically in FY26, and this will start with the first quarter of FY26 itself. In terms of the overall market share gain and losses, Asian Paints have come out and said that they are losing some of their market shares because of high competition that is not only coming in from existing players but also from the new entrants. And overall, in terms of Berger Paints, market share gains has been seen. FY22 they stood at around 18%, whereas now they are at 20% in FY25. In terms of what is the common takeaway from all of these paint companies, for AkzoNobel, of course, the market share was fairly stable, but in terms of common takeaways as to what to look forward to where it comes to paint companies, competition to tighten further in FY26 with Birla Opus also coming in. Grasim will come out with its earnings on 22nd May. We'll know as to how Birla Opus has performed then. Automotive segment growth has been ahead of decorative paints overall, and gap between volume growth and value growth is narrowing. So this is the overall picture as to how paint companies have performed in Q4 FY25.
Got it. Mahima, thanks so much for getting us those details. We're joined now by Shrikant Chauhan, Executive Vice President and Head Equity Research at Kotak Securities. Shrikant, thanks so much for joining in. Good morning to you. When you look at the index levels today, do you think that consolidation is on the cards? We ended at the midpoint of the range yesterday, 230-point range for the Nifty 50. What's on the cards today on expiry day?
Good morning, Alex. Good morning, Tamanna and everyone. See, like for Nifty, yes, we could see some more consolidation because the market is finding difficulties to sustain at higher levels. At the same time, we saw a very strong rally from the levels of 23,900 to almost 25,000. So it was like the rally of 1,100 points without any specific correction, or we can say with the broader performance of the market. So we may see some time-based consolidation in the near term, and 24,500, 400 going to act as major support for the market. But at the same time, at higher levels, 24,800, 900 going to act as major resistance. And today, as it's a day of weekly expiry of indices, we need to be careful close to 24,800 levels. So there we should look for taking profit on long positions. But in case, because of any reason, if we see the market is dropping to 24,500, then there we should look for taking contra bets of going long with a stop loss at 24,400. So that's the strategy that we should look for creating if there is any specific level-based kind of activity happens in the market.
Hi, good morning, Shrikant. What are your top stock picks this morning?
Good morning, Tamanna. I think the way the market is now indicating or signaling that it is going to consolidate, we need to focus more on mid-cap and small-cap companies because there we can see some more buying interest in the market. If we consider India's VIX, then there also we are seeing some cool-off sort of activity from the highs. So whenever we see such type of activity, we can say that the certainty is again returning to the market, and where the valuations are like very expensive, we need to focus more on those companies where there is like momentum. So we like specifically IRFC from the railway basket. Yesterday we saw a strong rally in almost all the railway related stocks. IRFC looks good. We can expect 137, 138 sort of levels on the higher side, and we can keep a stop loss at 125 for the same. The other stock which we like is Samman Capital. It is around 124, 125. There we can keep a stop loss at 119, and we can keep a target of 132, 134 on the higher side for creating any long positions on Samman Capital. Most of these NBFCs are finding some buying support and genuine buying support. That's our view. So we may see some more activity in Shriram Finance or maybe Chola Finance sort of companies. And lastly, from the pharma space, we like Laurus Lab, which is around 604, 605. There I'm seeing the rates of 630, 35 in the near term, and we can keep a stop loss at 595 for the same.
Right, so those are the stocks you should watch out for in trade today. Shrikant's picks. If you're looking at defense as a pack, and if you're holding any of those stocks, then you probably be very happy with the run that you've seen over the last few days. But if you've not, and you're wondering what to do, well, hopefully this next conversation gives you some perspective. Amit Dikshit, lead analyst, metals, logistics and defense, ICICI Securities, joining in right now. Amit, we're asking the question as well. Something like a Zentech is at 5% upper circuit in the pre-open session today as well. Seemingly it's going to go higher, and we've seen the entire pack move up very substantially. Of course, we know the context, but is this justified is the question.
Yeah, hi. Good morning. Thanks for having me on the show. See, the entire defense pack has moved up due to the reason that is already well known in the market. Now, some of these stocks have moved, I would say, beyond their fair valuation. Again, what the fair valuation is in these times is a matter of conjecture. However, what we believe is that if you look at the overall packets, at least, the way things stand and from the recent conflict, what we believe that the priorities of the government would be. I believe clearly the missiles have done very well, particularly the indigenous ones. So a stock like Bharat Dynamics, for instance, it has shown a good run up. Now at this price level, whether one should get excited, that's a different question altogether. There are certain other parameters that one should look at, particularly with respect to drones. So this conflict was essentially a drone-heavy conflict. What are the stocks that we can pick from that space? That one has to look at. The third bucket is, of course, the electronic systems, particularly the air defense systems. And if you really look at it, there was, of course, undoubtedly, a lot of contribution from the indigenously developed platforms like Akash, like Nagastravan, like let us say BrahMos, which is of course the joint venture with Russia. But there was a lot of foreign element also. The equipment that we procured, particularly the one that has been talked about the most, that is S-400. So indigenization of these platforms would be the key, and the company that would be involved in these endeavors would be should be in the focus.
So, Amit, I from your opening answer, it seems that a lot of these businesses or a lot of these stocks have run, if not ahead of themselves, then at least valuations seem a bit stretched. Where is it that there is comfort on the back of, one, the growth that might be there, and valuations being reasonable? Is there a pocket which combine within defense, which is a combination of both of these, even now?
See, in defense valuations, if you look from a trailing basis, of if you look even 2 years forward, valuations of good stocks or the stocks that have got growth prospects have always seemed to be slightly lofty. But here you have to take a long-term growth perspective, and one has to consider that the stocks that will be in focus essentially would be the ones where you will, which of course depends on the government spending. But a lot of these, the news items that have been flowing in, the development programs, the possible development programs, all the contracts that the companies will get, the results will only be visible after 2 years. So even if one is a spectra fast and one develops any of the program, our defense procurement procedure suggests that it takes at least 3 to 4 years for something to be procured. And therefore, you don't necessarily have to look at 2-year valuation. You have to take a long-term view. Now, having said that, if I take the long-term view, then certain stocks like solar industries, for example, might seem to be expensive on valuation as of now. But it's a stock that should be looked at because it is in the right pockets. If you look at then, for instance, Bharat Electronics, a short while back, people had doubts on the order accretion. But the point is that again, because of all the electronics coming into focus now, particularly the air defense system, the Indianization part of it. Again, if you take a long-term view, then order inflow for Bharat Electronics could be significant. Then there have been certain stocks that have just ridden the rally, like shipbuilders, for instance. I believe this is the pocket that one can avoid at this point in time.
That which shipbuilders to avoid. Okay, so solar industries, BEL, from what you said right now, should be looked at, and also from what you said, look at the next 3 years and beyond in terms of revenue recognition and growth because of the order book and how that will pan out. Anything else in the space, Amit, that you would recommend looking at right now?
No, so, again, anything that ties up with UAVs, because UAVs is something that we definitely need. The nature of war has changed. It's no longer fought by. So if you look at the current war, people expected that there would be, the big, the old school of thought that, there would be armies flooding in, but nothing of that sort happened. In fact, we saw a swarm of drones. So UAVs are going to be the next step. So the companies that are engaged in UAVs, I mentioned solar industries. Then the companies that are on the downstream side, for instance, Azad Engineering, which is the co-development production partner for developing the indigenous 4 kilonewton thrust engine. That is an important company according to me. Then BrahMos, again, we have received the media articles suggest that there are a lot of inquiries from the foreign countries. Now, BrahMos, you can't just play by the regular listed space, but there are companies like PTC Industries, for example, that would be involved in the supply chain of BrahMos. These are the exciting companies that one can look at. On valuation side, I mean, you might just say that, okay, PTC, Azad, they are very rich in valuation. But then, as I've been maintaining, that there is a price for everything.
There is a price for everything, and that price just went up when it comes to India's defense companies. Thank you so much, Amit Dixit. Absolute pleasure having you on the show on, I think, what is the hottest sector right now. But time for our big brokerage call of the morning. Investec has initiated coverage on Biocon with a buy rating, target set at 400 rupees. Varsha is joining in to tell us why.
Yeah, thank you for that. But for Biocon, everything is set up. It's just the execution. Execution is actually a now key when it comes to the company. Well, Investec has initiated this with Biocon, which is led by new launches, which will be upcoming by the company. And Investec says that company is well positioned to leverage the global biosimilars opportunity. Now, biosimilars is the next leg of growth when it comes to Biocon. Company is also benefiting from growth in both your diabetes portfolio, that is GLP-1 products, and also services business. The recent success of one of their Yesintic, that is Stelara approval, is a key positive for Biocon, and also recent launches in the US and EU and upcoming approval should aid growth and higher profitability according to Investec. Now, the planned restructuring along with the growth should help in debt reduction according to Investec. And the recent success in Stelara especially augurs well for the company. And when it comes to the GLP portfolio, that is diabetes portfolio, both liraglutide and semaglutide are interesting given the opportunity size, and Biocon's approval is expected in H2 FY26, which will be a huge growth driver for the company. And basically GLP-1 will actually surprise given the large market opportunity when it comes to emerging market also. Lastly, on the key risk, execution is the key risk when it comes to timely launches according to Investec.
Prashad, thanks a lot for that. Thanks for that. Okay, just Mark, Biocon. Mark went, by the way, down 20% on expected lines because the promoter is selling stake. But Parag bhai, before we let you go, result season, 35, 36 Nifty companies out, but non-Nifty, Nifty milake. In a nutshell, which is the set of results that impressed you the most?
So I would say my favorite remains cement, of course, because cement is where you saw March quarter always is good seasonally, but this time you are seeing a price action also in terms of increase in the prices, which has happened in North in March quarter, and in April, May, June it is happening in South. If you have seen Sagar Cement's call, the results were bad, but they said that there is a significant price improvement in South. So the stock did not fall. So as I said on the last call, Remco and India Cement will be benefiting from the South price hikes in June quarter. Plus they are also reducing debt. So I would say that one is that Tata Steel's call was very interesting, that Europe in Q1 FY26 itself they are expecting a turnaround. And amongst the companies which I don't own, of course I saw a result of Tilaknagar yesterday. The result and the commentary both were very, very good. I would say that, of course I don't own that in the portfolio, but I would say that because as we are discussing, now we are at a point and at the valuations where you need a real big positive surprise from the result.
We're just a minute away from opening, so I'm just going to quickly take one call from Shrikant very quickly. Some buzzers in the pre-open session. Sri Renuka, actually very good results, a bit of a turnaround story. Anything that you are spotting after the pre-open session, Shrikant? Just about 50 seconds to go.
Yeah, I think this Jubilant Food, there we are seeing a higher opening on the back of strong numbers. But at the same time, technically also the stock is showing a lot of strength. It is around 704, but I am expecting this stock to move towards 740, 45 sort of level. So it's a buy even at current levels with a stop loss close to 690.
Shrikant, quick 20 seconds. Tilaknagar up 11%. Allied Blenders the last few days has done well. Any trades here? Quick 20 seconds.
Yeah, I think this space is really doing well, and in that we like ABDL, Allied Blenders, which is around 400 levels, but still if we consider the technical pattern, then I think it is heading for the levels of 430, 440. So eventually it is going to outperform the space.
Got it. Got it. Shrikant, we'll leave it at that, Shrikant. Thanks so much for that. Parag, just wait on for a bit. Maybe we'll take it a question after market opens. But here's how the markets are starting off this Thursday morning. Flat. Absolutely flat, no big reaction, which is good, by the way. We want markets to be stable, not necessarily very volatile. Nifty IT, if we can pull that one up, I would reckon it will be flat. Yes, it is. Mid caps and small caps, though, might be in the green because small caps were showing uptick. Yes, the Nifty small cap up 0.4%, mid caps 0.12%. There's a fourth day of an outperformance if indeed it ends this way or better. But let's get the heat map up on the screen. I doubt I'll have too much luck today. Indesit down a little bit. Eicher, yes, reacts a little bit negatively because of that margin miss. Remember in Eicher, there are both positives and negatives, by the way. But I think the street for now is looking at the margin miss yet again, just that it is not that 8% downtick that we had in the previous quarter. ONGC a little bit soft, HDFC Life, FinServe. So I think insurance companies a bit soft, and M&M and Maruti bring up the auto names, which are a bit soft. So auto is probably the one which is kind of sulking along with IndusInd Bank. What's doing well? JSW Steel, 1.38% higher. I would reckon this is on account of the fact that metals by and large are doing okay. Tata Motors about 0.75% higher, and you heard our colleagues Sajit and Puneet do a very nice conversation with the management as well. Hero Moto marginally in the green, so actually auto is getting balanced out. Adani Port in the green, Titan, Bharti Airtel. No big newsmakers. I think there are trends out here, mixed stock-specific moves. Maybe metals, Tamanna, stand out as probably one pocket you want to look at, because I see no other reason why JSW Steel should be up a couple of percentage points.
One would reckon all the action in the broader markets today because you're completely flat on the Nifty and the Sensex. In fact, let's start by pulling that up as well. So yes, much more movement, not massively, but 0.2% up on the mid-cap 150. But once again, you're seeing that trend of the broader markets come in, which is good. I mean, portfolios are staying steady. That is always a good sign. We'll pull up the sectoral heat map just for a second to give you a sense of what's working there today. And yes, defense it is. Metals not doing too badly, but really it's all about the defense story once again. So that theme continues. Third day in a row, or fourth trading day in a row as well. Small cap 250 is up there as well. Consumer durables are doing okay. What's not working, and not massively, I would say this is a very range-bound market. The street is not taking, an extreme view on either side. Nifty Pharma seeing a bit of pain. Maybe that's specific counters pulling it down more than anything. Private banks, finance are not doing too well either. Let's get to the stock specific story because that's where all the action is this morning, and it's all about results. So I'm just going to go through the key results all at one go, one after the other, and let's see how they are doing. So I'm starting off with Muthoot, Berger Paints, Jubilant Food. Muthoot Finance actually seemed like a good set of numbers. Even the brokerage reports were very, very positive on it. It was on our watch list this morning as well. 4.5% down as a downtick. Is this a sell-on news kind of a situation? We'll have to look more deeper into Muthoot Finance. Berger Paints was a good set of numbers. They've gained market share at the cost of the market leader, 3% up on Berger Paints. Jubilant and Westlife, let's pull up those as well. Jubilant seemed like a decent set of numbers. Maybe the Turkey impact is pulling it down. Westlife also seeing pain over there. Lupin seemed fine, about 0.5% up right now. So no big reactions. I want to see Torrent Power and Tata Power, and let's look at what's happening to those two that also reported results. Torrent Power down in the red, mildly. Tata Power mildly up in the green. We're going to be speaking with the management ahead in the show. Sri Renuka, actually a bit of a turnaround story on Sri Renuka. Margins have also improved. Losses have narrowed. So that stock actually doing pretty well today in trade. Tilaknagar is the other one that I want to see. Apollo Tyres as well. Tilaknagar is a standout. It was on my watch list this morning. We talked about it. It was a thumbs up. Good, robust set of numbers with volume growth, 12.5% up. Apollo Tyres and Vascon Engineering also doing well. So some numbers actually working. Let's look at the defense names because really we can't not look at them. This morning, Zentech stuck on that 5% upper circuit for the last several trading sessions today as well. HAL, a lot of positive brokerage views, but the stock is okay. It's in middling territory. Cochin Shipyard is doing fairly well this morning. So that's the action. Back to defense and some standout names. Tilaknagar and Sri Renuka comes to mind.
There's another one that we discussed before the start of trade, Tamanna, and that's Berger Paints. On the back of numbers that were better than expected on the bottom line, it's doing well. 3.5% up right now. And Parag bhai, just a quick view on this, right? Berger Paints better than expected, but still there's a pall of gloom, if you can call it that, in the paint space overall.
Absolutely.
What are you watching specifically?
So paints, as I told, paints is a space from last 2-3 years since Grasim announced its plan to enter, and Birla Opus is now clearly visible everywhere. So I don't have a very bullish view on paint industry. Of course, when there will be a price point which will attract us, we will have a look at it. But right now there is an increased competition in the space, so the margins for the entire industry will go down. Plus overall demand scenario, as I said, from last 15 to 18 months, we are not seeing a very big consumption boom in India, right? So from demand perspective also, I have not seen paint industry growing in single digits or those kind of things in my life, I would say. So, so some of the spaces where the size of opportunity appears to be very, very big, right? Retail, you saw D-Mart's number, right? Avenue Supermart's number. Fantastically run company, but profit growth was hardly anything. Yeah. So I would say that even if you saw Swiggy's numbers, right, the 1,000 crore loss in a quarter.
Correct.
So I would say that this entire consumption boom is not happening, and so why to pay 40-50 times for that, for some of the, and especially in paint where there is a huge competition.
Yep. Good question. Okay, fair call. Parag bhai, thanks so much for joining in and giving us your perspective. Really appreciate your time.
Thanks.
All right. Well, that's the view from Parag Thakkar. Always great talking to him. We should have asked him a question on real estate. As to what's happening there, but maybe we try and do this with Bhavan Irani, Chairman and Managing Director of Keystone Realtors, as he joins in right now on the show, to try and talk about their numbers and the outlook going ahead. Bhavan, great having you. Thanks for taking the time out. So, these days we've figured out that there is no point in asking a developer at the end of Q4 about how pre-sales might have been down 30% or up 50%, because it's a very fluid scenario. So maybe let's try and talk about a trend. The last 1 year, right, ending with Q4, how do you see the year to have gone? And what's the standout feature of FY25 that could carry on in FY26?
Thank you very much for having me on the show, and I'd like to begin by saying that real estate continues its strong growth trend, and I do not see this slowing down except for a few blips maybe here and there. Second, I must repeat this again and again that Mumbai is very well placed. Mumbai MMR is very well placed because the kind of infrastructure growth out here and the number of companies that are looking at coming in to this space. We've heard about Japanese companies making large investments in BKC, and there are MOUs being signed every single day for some industry or the other. There's the entire airport coming up. There's the Vadhavan port, which is not too far away. We've heard about the entire coastal road that's going to go all the way from Mumbai all the way up to the Vadhavan port. All of these things really are making Mumbai a great space to be in, and we are seeing a whole host of development and redevelopment going on. As far as, if you want me to talk about what we've done, I think in the last year, which has been an extremely great year, we've proven ourselves to be a predictable company, which is, consistent on the growth path. We've done 3,000 plus crores of pre-sales, which is exactly as per our guidance. We've also, very happily declared for the first time in our history a final dividend of 1.5 rupees per share. Which is a welcome, move for all my investors, and I'm looking forward to continue this trend in the future. We are extremely excited about the fact that we've tied up 22 projects in terms of our BD has done an excellent job with 22 projects, of which 18 of these are in the redevelopment space, and 16 are in what I call the aspirational and mid-mass segment of the market, which is the largest market of Mumbai. I've said this before: 3 crores to 7 crores is where your maximum buying power is, and this trend will continue in the city of Mumbai for a long time to come. I can tell you our guidance for the coming year is also about 4,000 crores, and I think we are well on our way to achieving it. We're launching 7,000 crores worth of projects this year.
Okay.
Yeah.
Okay, so that 4,000 crores of actual revenue, it results into what? A pre-sales of northwards of 30% for FY26, and does it happen because of volumes, or do you reckon pricing will stay stable as well in the market that you're operating in?
Again, as a company, I'm glad to say that we've done a 35% CAGR growth year on year in our pre-sales, and we've maintained this. We are very calibrated with the kind of projects and the locations that we go into. I don't need to stress this out again. But Mumbai has about 7 or 8 markets, everything from affordable to mid-mass to aspirational. And we, as Rustomji, are across this entire spectrum. We've got an extremely strong pipeline of projects that we are launching, even in the premium and uber premium spaces. And Rustomji, as a company, is able to serve the consumer's needs for everything between, I would say, a 50 lakh rupee apartment to a 100 crore plus apartment. And we're very happy to be serving this entire space. 3,000 crores was our pre-sales this year, and our PAT was 188 crores, which was up from 111 crores of last year and up from about 2,200 crores of pre-sales last year. So we've seen a 35% CAGR growth, and we will continue this trend even in the year that's coming. As a matter of fact, I'm glad to say that of the 7,000 crores of launches that we're looking at doing this year, close to around 4,000 crore launches we've done in the last 10 days itself.
Yeah. Baman, hi, good morning. Tamanna here. Did I hear you saying 3 to 7 crores is the sweet spot for Bombay, for the MMR regions?
5 crores, if I was to give you a point, is absolutely a sweet spot for Mumbai city. And I'm again saying the largest buying is taking place in this space. If you look at the kind of data that is coming out of all the reports that you will read, we're very happy to read 174 crore single apartment sale, but nobody sees the volume that is taking place in the 3 to 5 crore or 3 to 7 crore segment. Everything from Borivali coming all the way up to Bandra East, and everything from Mulund coming all the way up to Sion is the market that I'm talking about. Is really huge and is doing extremely well.
Okay, so that's really interesting that there is still that much appetite for a 5 crore apartment. 3 to 7 crore is where you're seeing enough volume. I just want to talk about the GDV targets, because you had a 6,000 crore GDV target for this fiscal, which doesn't seem to have really hit the mark. Were there project delays? What really happened here?
So you're right, Tamanna, we hit 5,000 plus crores in terms of the launches that we had. And a project of ours did, which we were supposed to launch in the last quarter, did not get launched because of approval processes. But what we lost in the last year, like I told you, we've already made up in the first quarter of this year, and we've had projects of about 4,000 crores being launched in the last 10 days. 2 projects in Bandra and 1 in Chembur. All these projects are just launched, and they're getting a very good response from the market. And we are very enthused with our location and the product type that we are kind of putting out there.
What's the target for this fisc in terms of GDVs?
So we will be launching 7,000 crores of projects. We are well on our way to surprise most of us because we've already done 4,000 crores and it's not even completion of the first quarter. So we should look for more. And like I said earlier, I'm pretty excited about the way our company is growing and what our teams are doing at this moment in time.
Hi, Biocon. Alex here. I'm just wondering about input costs, because your margins have improved quite substantially year on year. 8.6% versus 6.4%. Are they benign? Are they likely to stay so?
So, Alex, thanks for that question, because we've said this in the past. There were certain legacy projects that we've been kind of completing. Because, in real estate, it's not about how much money you make, but how many projects that you complete and continue completing. Especially, there should be no project left undone, because that's like a blur on the company. So there were projects of the past that we were carrying on. We call them the legacy projects, which are now completed or nearing completion. So our newer projects are the ones that are giving us a heftier margin, and that's why you see this entire growth.
Okay, so therefore the follow-on question for that, Baman, is that assuming that the mix improves going forward, even from this point, is that likely to take place? And from that perspective, what is the trajectory that you see margins taking?
So, Alex, again, a good question. Like I said, we are across the entire bouquet of projects. And we do everything from a 50 lakh home to a 100 crore home. Obviously, the margins happen to be higher in a premium and uber premium property. But it's also important to continue to keep the bell, the tolls, the tills ringing as we go along the way. And that's where projects in the mid-mass and aspirational category, which is about 16 of the 22 projects that we've tied up, will be aiding us. You will see a lot of launches taking place in the Borivali to Andheri segment, and maybe something more even in the Bhandup segment. And as far as we are concerned, you're aware that we follow the project completion method to kind of book our revenues in. And this is why it becomes a little lumpy. And we're trying to move to the a different method of accounting. If all goes well, we should be able to do that this year. Otherwise, we'll continue with this form of accounting itself.
All right, Baman, thanks so much for joining in for that clarification. Wish you all the best going forward.
Thank you, Alex. Thank you, everybody.
All right, just have to slip into a very quick break. As we slip into the break, we're down about 0.2%, not too much movement. And this is par for the course, really. Consolidation is expected. We'll be back on the other side with more conversations. Do stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential.
All right, back with India Market Open right here on NDTV Profit. Now, for example, there are a few stocks which are standing out today. So, for example, if you look at Muthoot Finance, right, down 4.5%. And you would wonder why so, because the results looked okay. I think the devil might be in the valuation detail, because if you look at the Morgan Stanley note, for example, they're saying that the reason why they are equal weight on Muthoot and not overweight is because it is pricing in some of these benefits, and gold prices are no longer rallying the way they did in the last couple of months. So maybe that is what is hurting the stock in the session today partially. Keep in mind that the market isn't exactly the hottest today. Everything from Nifty to Nifty IT to Nifty Bank are all down, except for small caps which are holding out. Almost everything else is looking slightly wobbly. The other one is the management that is going to come up in about 10-15 minutes from now, Blue Jet Healthcare. Very good set of numbers, and I think the con call was robust, as a result of which most brokerages have come out and said that they love the numbers and they love the commentary. No surprise that the stock is up 7%, and therefore it will be a conversation that you don't want to miss at all. For a business which has done so well, ahead of estimates, looking at very strong CAGR numbers, what is it that the management commentary is? We'll try and tell you in moments from now. And of course, in moments from now, we'll probably also get in Nirav Sheth of MK to try and understand what to do in a scenario like this. Because I'm told he's here, because Nirav in the last 6 months has done a bunch of US tours, has done a bunch of global client conversations, and he would have thoughts of his own about what to do with the Nifty at 25,000. Nirav, great having you as always. Thanks for taking the time out. We are no longer at 22, but geopolitical tensions behind us, trade tensions behind us. Is this a conducive environment to invest, or would you believe we need a bit of a valuation reset?
No, so I've believed for some time, Neeraj, that the decks are stacked up for India. We had a bit of wobbly situation. It was a bit of nervous situation because, wars are very easy to start, very difficult to pull back. The history goes against you. So, but we are back on track. I feel very bullish. And, I've had this view for some time that the biggest advantage that India has got right now is that there's a big dollar reset that is happening, right? Very rarely would you have a situation where, the equity markets in US have rallied and, bonds have gone up and the dollar is depreciated 10% from the top, right? So this is a big, big reset. And there's a very conducive environment for emerging markets in general and India in particular. So short answer to your question is that very bullish. No one knows what happens in the next 1 or 2 months. But I would wager that in the next 5, 6, 7 years, India will end up being the bubble market in the emerging market territory.
Hi, good morning. Tamanna here. At the best of times and at the worst of times, there's one point that I have to make, that Nirav Sheth is always very bullish on India. So this is the one time where actually I think the whole atmosphere and wave is with you as well, because of that's what the entire mood is.
Right?
Yeah.
Let me come in. So I sort of agree, and I try and keep on pinching myself that I'm a perpetual bull. But I like to go by data. So you look at the last 5 years, 10 years, 15 years, 20 years. There is only one period where US market has outperformed the Indian markets in dollar terms. You are the best performing dollar return markets in the 5, 10 and 20 year bracket. That tells you something, right? So you do well. And why should you be even bearish when you got this kind of returns in the past 20 years? And the future is looking better than what it has been in the past.
No, completely. And on facts. It's not just, chest beating. It's on facts, and money has been made. Now, the question is that if there are opportunities right now, are we seeing in this consolidation phase in the market right now an opportunity to set yourself up for the next phase of the bull rally? Because we've seen a period of turbulence, I would say 5, 6 months, and then some pullback as well. But we're evenly placed below the 25,000 mark right now. What would a Nirav Sheth do at this point?
So, I'll tell you what, when I talk about being bullish on the market, you have to look at, what are my alternate avenues, right? So I would want to have a 20% return. Maybe I want to double in the next 3 years. But where do I go and invest, right? So returns are always relative. So I look at my options in terms of what I'm going to get in the bond market, what I'm going to get in the real estate market, what I'm probably going to get in the commodity, what I'm getting in the equity markets. In that context, I don't see a clear line of sight of being invested in anything other than equity. That is number one. Secondly, the way I look at it is that it is important that we have the right policies to try and ensure that my economy continues to hum around at about 6.5%, 7%, which with my earnings will grow at about 12 or 13%. And if that is the case, then you should ideally expect that the markets could double in sometime around 5 years or something in about 6 years. Broader markets, which means that within that, some sectors that will do well, some sectors that will not do well. But yeah, most important thing, I think the big reset that has happened to me, I think for the first time now you've got monetary policy that is aligned to your economic reality, right? You need stimulation. Your credit growth has been stagnating. When I talk about credit growth being stagnating, for last 10 years, my credit to GDP ratio has been flat, right? So we are running an unusually tight monetary policy, maybe because of inflation or whatever it is. I'm not a great believer in that, but I'm no economist. Going forward, I suspect that your rate cuts will be deeper than what the markets are believing in, because you are getting more outcome focused. You need to drive to a particular objective. There is nothing called 100 basis points of real interest rates or 200 basis points of real interest rates. I think that we are done with the fiscal tightening. So monetary policy is in favor, fiscal policy is in favor, and therefore, ideally, the fact of the matter is that this should start reflecting in earnings growth rate.
Nirav, okay, yes, let's say you pinched yourself and you still found that it's worthwhile to be bullish. Now, when I look at, for example, earnings, not just for Q4, but maybe Q3 and Q4 and the commentary that has come in, right? There are select pockets that are sounding very constructive and select which are sounding slightly skittish. And I was trying to get your view on maybe 2 or 3 of those. Your guys have written a very good note today, for example, on a Blue Jet Healthcare, the management that we are going to speak in the next 5 minutes after you. And that prompts me to my first question. Across the board, except for a Piramal Health, CDMO companies have done really well. Now, pharma is in a bit of an eye of a storm, if you will, but CDMO is shining bright. What do you think of healthcare and pharmaceuticals currently?
That calls for some level of domain expertise. So I will not get into too much of detail. But from what I understand, and from my, I've got a very good pharma analyst, we are not very constructive on companies that have got an exposure to US trade market, by and large. So we are not a great believer of a rebound in profitability of US generics. Companies that are logically facing the Indian markets, which is more of a consumer sort of a play, are the companies that we generally tend to like. But you also have to appreciate that these are the kind of companies that are going to grow at about 6, 7, 8% growth in free cash flows, very similar to like how the consumer companies are growing. And therefore, your ability to make any superior alpha or generate superior alpha out of that could be probably limited. Those are not my sector focus. I'm trying to predict what could be the next big delta. Can you identify the next Eternal? Can you identify the next tech stories? Are there any great outliers in the infrastructure? Are there any great outliers in the EM space? Neeraj, what is happening, right? For the last 20 years, we've never been a part of this global supply chain, right? And now when I look at the next 20 years, a lot of the companies are going to fall in that space, right? So those are the things that you want to look at. Now, valuations could be out of the story. Sometimes the stories are out of the valuations. To me, those are my focus areas, because that is where the big delta, in terms of both earnings delta, in terms of valuation delta, could be there.
What are you liking right now? Are you seeing maybe a return of the broader and small caps, mid companies right now? Because for the last few months, we've just been hearing stick to the tried and tested, look at the large caps. Do you see that now reversing as confidence grows?
Well, I have a slightly different view. So I think people are getting anchored by what has happened in the last 4 or 5 years, which is like, your small cap index is up some, I think, 4 or 5 times. But you try and push that timeline into last 8 or 10 years, then it probably compensates for a serious underperformance pre-pandemic, right? So earnings to a large extent are mean reverting. I, for one, and I'm now talking more anecdotal, more bottoms up, I think there are far better growth opportunities in a large tail that India has created, right? And there are more companies getting listed. Actually, curiously, if you look at the construct of the large cap companies, and I'm now talking about the Nifty companies, and then if you look at the earnings evolution over the next 2 or 3 years, you're not getting many strong, even double-digit growth rate. I mean, just pick up the private sector banks, right? And we also like that space. But look at the consensus earnings growth rate for an ICICI or Axis or a Kotak. If I'm not mistaken, that number is close to about 8 or 9%. Maybe the analysts are behind the curve. That is my estimate. But the broad consensus estimates for earnings growth rate is nothing to get very excited about. While as you go down the market cap order, there is a significant amount of delta that is happening over there.
Okay. Well, we'll talk about the lower down the order conversation the next time, Nirav, but unfortunately I have to wrap up today. But thank you so much for the insights in today's show. Really appreciate your time.
Pleasure. Thank you, Neeraj. Take care. Bye.
Take a break. On the other side, VK Singh, CEO of Blue Jet Healthcare, Johnson. Stay tuned. You don't want to miss this.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. The focus now on the big earnings boost for Blue Jet Healthcare. The stock moving well this morning after a strong set of numbers on the back of high sales volumes. We'll be speaking exclusively with the management in just a minute. But first, let's head across to Varsha, who tracks the sector, to set up the conversation. Varsha, what's worked for Blue Jet?
Yes, thank you for that. So superb numbers when it comes to Blue Jet. The revenue growth was driven by higher pharmaceutical intermediates, and the profit improvement that you're seeing is on the back of higher sales volume, cost optimization strategies, which has also led to EBITDA growth. And company has also approved fundraising of rupees 1,500 crore. Now on the segmental revenue, if you see, contrast media grew negatively year on year. The pharma intermediates, if you see, grew 446%. This is the interesting highlight over there. This is the reason why we are seeing the huge growth. High intensity sweeteners saw a negative growth of 12.5%. On the outlook, if you see, companies expecting long-term revenue growth of almost 15 to 20% CAGR. And on the CDMO, companies expecting strong traction from Europe innovators benefiting from China de-risking as well. And they're also targeting GLP-1, that is diabetes portfolio, cardiovascular and gynecology intermediates.
Right, thank you for that short and sweet. VK Singh joining us this morning. He's COO of Blue Jet Healthcare. Mr. Singh, very good morning. Tamanna here. Great to have you on the show. Can you explain to us how your margins go from 28.8% to 41.1% in the quarter? And is this something which is a one-off, or you see this range sustaining?
Tamanna, let me just, set the context.
Right.
Earlier when I was on your show, then Neeraj had asked me for some sort of a guidance for the year, but we don't give a guidance. All that I had said was that this would be a watershed year. And I think the numbers are stellar, and kudos to the Blue Jet team for working together to achieve it. I think this year, all three verticals have done well. against so much of headwinds, I think contrast media has done well. It's a very profitable business that we have, very niche. But then the growth has been driven much more by the PI segment, where we supply a very complex chemistry-based advanced intermediate to a cardiovascular product to the innovator, and the product is still under patent. So it's in a patented space with no generic competition at this point of time. So this has been the key growth driver for this year.
So, are you seeing incremental benefits which will continue? So the key growth driver for this year, I've understood, you said watershed year, I can see it. My question is that does this sustain and continue? Is now in the range of 40% in terms of margins what we can expect to continue seeing from Blue Jet?
See, we have been very consistent of, delivering EBITDA levels at the mid-30s, right? However, we stretched out to 40% in this particular year because of very high amount of operating leverage. The sales grew because of a ramp up of the PI segment, which we had anyway anticipated and for which we had built capacities, last year, second quarter onwards, and the molecule globally gained very good traction. We normally don't give a guidance for future, but if you will see our track record, our EBITDA levels have been high and at least in the mid-30s. And I think given all that we are doing for all the three segments and the platforms that we are creating and the pipeline that we have, I think going forward also, the trend would be maintained. This particular year, we would be launching 2 new products on the contrast media segment. Contrast media is our flagship segment and will continue to be the mainstay of the company. And we will be launching 2 new products, one on the iodinated side and one on the gadolinium side. So I think the year ahead will also be a very good year.
Contrast media, which you've mentioned as a flagship vertical, you've seen and fantastic numbers, so not to pick holes, but you've seen a slide down in contrast media as a segment, isn't it?
See, this is a very, very niche segment, right? It is completely innovator dominated. The global market will be about, $7 billion. As far as volumes are concerned, our volumes have not gone down. The invoicing that we have done has also not gone down compared to last year. But then the manner in which sales are recognized, that is showing a slight dip. So we are not concerned.
Mr. Singh, good morning and congrats. I mean, highest ever quarterly earnings should be very pleasing. Just one piece which I wanted to understand, maybe I don't get it, but you mentioned that there is this one hero product which doesn't have any generic competition thus far. Could that come sometime in the future, and does that disrupt growth or pricing in any fashion?
So generic competition, Neeraj, will always be there. But then there is on the opportunity that we are tracking and the advanced intermediate that we supply, this product is under patent till 2031. And if you would see last month, there have been some settlements with generic companies. As a part of those settlements, some of the generics will be coming onto the market only in 2040. So whether others come earlier than 2040 or not, but regardless, I think there is a fair amount of time for which there is no generic competition.
Okay. Now, your gross margins are higher because a lot of people say that there is a structural change in the mix of pharma intermediates. You are also taking your capacity utilization levels higher, as I understand, and that the belief is that these will only continue to move higher. So you've already told in response to Tamanna's question that while you don't give guidance, the outlook is positive. But on the gross margin side as well, do you reckon there are further upsides? EBITDA is one thing, but gross margins, are there further upsides?
See, this year we are adding a capacity in one of our units, which is going to be for backward integration. Once that happens, then about 90% of what we buy will be localized. Our China dependence would be very minimal. With that, I think the gross margins will certainly show an uptick.
Okay. The other question that a few people have is that whether there are upside risks to the assumptions that they have made of a 30% CAGR for the bempedoic acid intermediate sales because you are commercializing some products. Pardon me if I've gotten that pronunciation wrong, but you get the point I'm trying to make. Are there upside risks to some of the key product sales that people are penciling in? I know you don't give guidance, but still.
See, this is something, which is in public domain, so I can speak about it.
Okay.
And it should not be construed as guidance or it should not tantamount to giving any type of guidance. Pempedoic you mentioned and your pronunciation was perfect. This molecule is growing globally at about 60 to 65%. In US, it is growing at about 40% annually, which means that the growth in other markets is higher. This is alternative to statins, and I reckon that it is in the process of becoming a blockbuster. So, I mean, there is an opportunity. There is an opportunity, and we are the primary suppliers. And we have a lot of capacity that we have built in last year. So there is headroom for growth. Should there be any uptick in demand because of all these, tailwinds that the molecule is experiencing, I think we have the capability to take care of that incremental demand.
Just on the outlook globally, I think one thing that helps is that your exposure to the US is not that much, more concentrated in Europe, Mr. Singh. But do you see any global headwinds or regulatory headwinds coming in from your key markets?
See, a lot of changes are happening and a lot of structural changes are also happening. These changes, once they happen, may be there to stay. But one thing we need to understand that Indian pharma market today is not about cost arbitrage. It's about a value arbitrage. And till the time we are differentially better than certain other very large economies, let me say China, let me call out the name, I think we shouldn't be very bothered about it. Some reshoring will happen. And but then it is not easy because, pharmaceuticals, there is a regulatory pathway. So, but nevertheless, some reshoring could happen. But if you look at the opportunity, I mean, there was a phase when we were big in APIs. Then there was a phase in which we became big in antiretrovirals. Then there was a phase in which we became very consistent and very significant in the affordable generics. And we continue to be there in that space. Now is the time for the CDMO business. I think in the next 5 to 10 years, this will be a great uptick for CDMO companies because the opportunity is extremely large. We are tracking a $200 billion opportunity. I mean, for small molecule company like ours, it's a $80 to $100 billion opportunity. Indian market share is just about 4 or 5%. So there is tremendous headroom to grow. And companies like us, we are witnessing a surge in RFPs, because of which we are adding capacity. And we are also building new R&D centers. So about 18 months back, we doubled our R&D capability, our R&D number of labs that we had. And in the next 12 months, again, we'll be doubling our R&D capacity and building some new platforms also. So I guess as a country, there are headwinds, but then we are very well poised to take care of them.
No, so just one follow-up to something that you answered to Neeraj, and I found that interesting. You said that you're working on backward integration, which is going to help you replace dependence on China.
Yes.
What are the timelines for that to really take place? Because as you mentioned, replacement strategies in your business take a long time, and it's not something that you can do overnight. What is the kind of timeline that you've penciled in for this?
See, the capacity will be on stream in the second half of the current financial year.
I see.
And I think we should be able to commercialize the product also on similar timelines. And you have a very valid point that, there is a regulatory pathway when we make a change. In our case, we had made the change anyways in the past. So our product, if we make it in-house, is already approved. It's now just that we are putting capacity enough to be able to support our total consumption.
Okay. Mr. Singh, the visibility around the R&D pipeline, I mean, there are a lot of people who talk about multiple opportunities, so many in late phase 3, commercial, I think, can you talk about that?
See, Neeraj here, we are a company which is very focused and is in very niche segments, be it contrast media or the PI space where we focus on chronic, or in the high intensity sweetener where our focus is only FMCG and beverage. We are not a company which has too many products. So if you will see that we have, our per molecule revenue is one of the best in the industry. So we are not tracking too many opportunities, but yesterday in the earnings call, I also mentioned that at the R&D level, we are working on 20 molecules, and about 30% of these, that means about 6 of them are at phase 3 and close to commercialization.
Okay. There's a fundraise that you announced, Mr. Singh. Is that for further expansion in the very near term?
See, we are a debt-free company, so our balance sheet is completely unleveraged. So whatever fundraise that we have will go towards growth. So we'll be building up capacity. In the last 4 years, we have quadrupled our capacity. In the next 12 to 18 months, we'll add another 40%. Beyond that also, we envision that we need larger and higher capacities given the customer lock-ins and business visibility that we have. And we'll also be investing in new R&D centers.
Got it. Mr. Singh, sorry, we're out of time completely, but quick 30 seconds. If you're a debt-free company, why raise equity capital? Why not fund it through debt?
I think, this is a better way. And we need capital for growth. And this will be deployed completely for growth. So I think we are, and even by law, earlier we diluted about 14%. We have to make another 11% dilution.
Okay, fair call. Mr. Singh, lovely going. Thank you so much for sharing all these details. Look forward to talking to you again soon.
Thank you so much, Neeraj. It was a pleasure being on your show.
Thank you so much, sir. Well, that's Blue Jet. We need to slip into a very quick break. But on that note, that Blue Jet as a stock is really revving up, 9.5% at the highest point of the day. We take a break, come back with more earnings conversations.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. Yes Bank, talk of the town. The stock is making some smart moves, of course. And this is on the back of SBMC buying stake in the company. My colleague Vishwanath is in conversation right now with Prashant Kumar, MD and CEO of Yes Bank. Let's listen in.
Investor like SBI and the other banks who in 2020 had at that time entered Yes Bank as part of the reconstruction plan. For them also, it's a massive sort of exit. How are you seeing this in terms of, say, valuation, rating for Yes Bank?
No, I think I would like to see in terms of bank continuously delivering on the both business growth as well as on the profitability. It's a continuous upward trend. Okay. And whenever we were speaking to the rating agencies, there were always two questions. The first question in terms of they would like to see a continued path of the profitability, which bank has demonstrated. Okay, last 4 years it's a profit. Last year was actually almost double the profit of the last year. Okay, and quarter on quarter there has been a growth on the profitability. So that part has been addressed. The second question was more in terms of what is going to happen to the shareholding of these banks, how they would be given exit, and actually who are going to replace them.
Correct.
The worry was like if they are replaced by some short-term players like a private equity, then actually the problem is not solved.
Correct.
Okay. But since now they are replaced by a very reputed, the second biggest financial group in the Japan and the 15th largest in the globe, then I think that question is also addressed. So we are quite hopeful that there is an opportunity for the bank for the re-rating of the bank.
Now let me just talk about this investor. Now you've had PE investors, private equity investors come in the past, and they bought sizable stake to large private equity players. To your mind, what does patient capital do for the strategic intent of the bank? Because yes, they will be patient with their capital and they will continue to repose faith in the way the bank works. But as a leader of a bank, how important is this for you?
No, I think what is important for us to understand, the private equities, their objectives are different. Okay. Normally, the private equities, they come for a period of 3 to 5 years. But the objective is always to maximize the returns for their investment. Okay. And when the objective is to maximize the returns, sometimes you don't contribute in terms of investing for the future.
Yeah.
Right?
Yeah.
But a strategic player, when they come in, they always would like to see that you need to invest for the future, so that there is a sustained improvement in the business growth and the profitability of the bank. I think this is a very significant difference in the approach of a private equity and a strategic investors like SMBC, which is again because of the objectives for both these funds are there. So I would always like to see that especially in a financial institution, we need to have the strategic investors, okay? Because sometimes you come with a short-term objective, okay, and you may maximize your returns, but whether you have really contributed to the long-term vision and the stabilization of the bank, I think sometimes there can be doubt around this.
Okay. You've obviously met with the management at SMBC, before this conversation has closed. I mean, it's been going on for about a year, because I remember I reported on it when the original conversations had started. To your mind or to your understanding, what is it that they want to achieve by buying a sizable 20% stake in an Indian franchise?
SMBC, they were interested in the Indian financial market, because if you see the growth of GDP in India, the fastest growing country. Okay. Similarly, the financial system of India is not only stabilized but doing very well. Now today, if you see the presence of SMBC in India, they operate through 3 branches, right? Delhi, Mumbai and Chennai. Last year they have opened a branch in the Gift City also. They also have a 100% subsidiary as a NBFC. Okay. Now this NBFC actually takes care, they have more than 1,000 branches in the NBFC. They take care of mostly the rural and semi-urban area for a very, very small borrower. There are 3 large branches, take care of very large corporates. So their own ambition in terms of having a presence in India in the entire banking spectrum, okay, Yes Bank actually completes that spectrum. Okay. So they have the very large corporates, they have the NBFC going into the rural and semi-urban, but they were not having a bank which takes care of the SMEs, which takes care of the retail deposits, which can take care of the commercial banking, and on top of it, Yes Bank has a very strong transaction banking platform and the digital capabilities. Okay. So I think these capabilities and the business segment complete the entire spectrum of a presence as a financial conglomerate in the Indian market.
So that's Prashant Kumar of Yes Bank. What's interesting is that he comes out and says that there is a possibility of a re-rating with regards to Yes Bank, and that is what the street needs to watch out for. Analysts will come out as well with whether this becomes a re-rating candidate or not. But moving on, Muthoot Finance, an interesting one to watch out for because at the face of it, the numbers looked pretty decent. However, the street is punishing the counter with cuts of nearly 5% coming in there. Let's quickly understand what has really not worked for a Muthoot Finance. Firstly, the margins have been under pressure this time around. So that is one of the key negatives. Apart from that, if you talk about the AUM growth, that was mainly driven by the gold price increase that came in. Because if you talk about the loan account and the number of customers, that has gone up nearly by a marginal 2%. So that is one of the concerning factors because the moment gold prices are not sustainable and start inching lower, it will be clearly visible in terms of the future earnings growth. Secondly, they've maintained a gold growth guidance of around 15% for FY26 versus a 40% that they achieved in FY25. And the management is saying that they're absolutely conservative when they come and give their guidance. They will be revisiting the guidance in terms of the second quarter of FY26 as well. Overall, the asset quality in terms of the MFI portfolio, that is the microfinance portfolio, that has worsened because if you talk about the stage 3 in the MFI book, that has inched up significantly by almost 207 basis points to approximately 5%. So that is a concerning area as well. In terms of the current LTV, which is approximately at 61%, it can go max up to 62 to 63% per the new draft gold loan circular. Now, the growth would then pretty much depend on how much gold prices sustain, and they're expecting low origination ticket sizes as well. Plus, the competition becomes a key headwind as well. And if you talk about the multiple new players, that is increasing the probability of competitive pricing. Spreads could be a concern, and the pricing behavior needs to be watched out for pretty closely. So these are the key concerns we are citing out in terms of Muthoot Finance. In fact, I did speak to the managing director, which is George Alexander Muthoot, to understand this further. Let's quickly listen into that conversation. My first question coming to you is strong AUM and profit growth that we've seen. The growth has been driven by strong loan growth, and this is mainly in terms of the gold segment. Now, when you talk about the growth that you've seen in gold loans, 33% rises on the back of your gold prices, a 12% increase in customer base, but on a sequential basis as well, the customer acquisition seems to be soft. What is the trend you're expecting going ahead? Because gold prices are a risk.
Okay, thank you. And we are also quite happy that we have been able to do well. We have had a good landmark achievement of 1 lakh crores for the pure gold loan business. That is, I think, one of the best in the NBFC sector. So your question about the prospects for gold loan, it is really good. Let us look at the gold loan, where the demand is coming from. The demand is coming from the need for the public for funding. Public needs funding, whether it is a personal loan, which is nowadays little difficult because the risk weights have been increased for banks and NBFCs. So they are getting slow on personal loans or the unsecured personal loans. The microfinance sector is not doing well. They are almost stopped for new lendings. So people need money, and gold loan is a good option. That is the demand side of it. Of course, the price of gold is also helped because today the price of gold in the last 1 year has gone up by 30 to 40%. So people with gold see gold as a very valuable asset. And smart people among them are trying to use it and monetizing it to take a loan instead of selling the gold. Instead of selling the gold, they're taking a loan, and probably after a few months they're closing. So that is why you see good loan growth. So the risk of gold price is there, but that is why all the gold loans we give are only up to 75% of the current market price. So there's of course a definite margin. And the second thing is that we give loans only against household used ornaments. So there is always a sentimental value. there's a making charge on the ornaments, which is also there as the equity of the borrower. So what we have seen is people don't abandon the gold, they take it back. So this is a good sector. It fulfills the funding needs of the public to a very great extent, very convenient, and that is why it is growing. Gold price, yes. If the gold price comes down, our lending rates also will be coming down. So it is in tandem with the new gold price.
Right. George, my question is, again, when it comes to customer acquisition, that has been muted. So what's the reason for that? Is it the increasing competition that you're seeing from banks that are entering the segment that is becoming a deterrent for you? Or how would you look at that aspect of the business?
I am not sure about that facts which you have said. In the last all the 4 quarters, we have been able to add around 4 lakh new customers. 4 lakh new customers have been added. So that's not a small number, because in the last 1 year, we have added almost 15 lakhs of new customers. It's not a bad number because, of course, as you say, there is a lot of competition. But then people are also borrowing more. Earlier, the people are prospering. So earlier, somebody who used to take about 30,000 or 40,000, today they take more. Today, the average ticket size is almost 80 to 85,000, which was only about 40,000 rupees maybe 2 years back. So the same people are borrowing more on the gold, and that is why our AUM is also increasing. And we have also added 15 lakh new customers in this year. It's not a bad number.
And with regards to the competition from banks, how have the yields been? Because there has been a slight bit of a drag, and this is on the back of low yielding products as well. So taking that into consideration in this quarter, how are you expecting it? Do you expect this impact to wane off in the coming quarters, or will it remain at similar levels?
The first part of it, competition. It is not competition. It is that all the banks are also now doing gold loan. They have realized that the bank can also do gold loan. They are doing the gold loans because of the, what should I say, the visibility of gold and gold prices. Every day in the newspaper, there is at least 2 news items about gold prices. Gold prices are hitting high. Gold price is increasing. India is importing gold. The government of India is stocking gold, all those things. So people are now looking more at the gold, and they are using this as a means to finance. So more and more people who were earlier not very comfortable or reluctant to, use gold as a collateral is now going. And added to this, banks are also advertising. So the pie is increasing. More and more people are using gold. So the market is increasing. We have grown 40% last year. So too, many of the banks would have also grown in their gold. So the market is increasing. Competition is there, but the market is also expanding. Now, the second part was the yield. See, we try to maintain our spread at about between 9 or 9.5. For the last 4 or 5 quarters, we have been able to maintain that spread. So whenever the cost of funds goes up, we tweak our yield to maybe maintain our net interest margins or the spread. So when the price, when our funding cost comes down, we actually pass it on to the customer. We are mainly concerned with our spread, which is about 9.5, and we, by all means, every time we are able to maintain that net interest spread of 9.5%.
All right, that's the conversation with George Alexander Muthoot. Like we said, the stock is down today because the valuations probably bake in a fair degree of positivity. The market itself is looking slightly sluggish. So not only Muthoot down 5%, look at Jubilant Food, for example, down a couple of percentage points. Nifty IT is down 0.7%. Nifty Bank 0.4%. Nifty 100 is about 0.25% lower. It is only the small cap 250 which is standing out right now. Maybe some capital market plays could be doing okay. I wonder, so I see an MK which is up about 5%. I wonder if the likes of Motilal Oswal, Motilal Oswal, DAM Capital, etc. Are they in the green? No, not really. Motilal Oswal is flattish. DAM Capital down 5% in fact. So not everything is in the green. Suzlon up 1.75%. Strength in Inox Wind Energy and Inox Wind. So that's the other set of stocks which seem to be doing okay for themselves. A stock which has had a really good rally recently is Zinka Logistics, up 2.5% again. And if you look at the last 7 days, has had a very, very good run. So bear that in mind. And something that is bouncing back today is Syrma SGS. After about 6-7% downtick in trade yesterday, that stock is up about 1%. What is sulking really badly is Wendt. Wendt GmbH likely to sell or on to sell about 37.5% stake, and Wendt is down 20% in the session today. So that's one name you got to keep in mind. 17% now. Okay, let's keep up with the earnings conversation. Tata Power is the stock in focus. Varsha Johnson for a quick review of the quarter.
Yeah, thank you for that. Revenue and net profit did meet estimates when it comes to Q4 earnings. Odisha Discoms and solar have actually driven the growth that you are seeing. Odisha Discom Q4 PAT jumped 3x year on year, and their module manufacturing margin was at 27%, aided by third-party sales. EBITDA rose due to a strong core businesses comprising generation, transmission and distribution, and renewables, and lower tax aided net profit, but this was offset by lower other income. If I were to talk about the capacity details, total operational plus under construction capacity stands at around 25.7 gigawatt, 9.9 gigawatt of clean and green capacities under construction. And on the solar rooftop, if you see, order book stands at around 1,036 crore. Order book is up 25% year on year. On the transmission business, if you see, 2/3 of transmission projects is expected to commission when it comes to 2025. 2,414 circuit kilometer transmission line is under construction. So overall, revenue and net profit did meet estimates when it comes to Tata Power Q4.
Yeah, and modules business did okay. Varsha, thanks for that. But capacity addition maybe a bit of a spillover into FY26. Let's ask that to Mr. Praveer Sinha, CEO and MD of Tata Power Johnson, right now on the show. Mr. Sinha, thank you so much for taking the time out. It's good talking to you. It's been a while. Thank you so much for joining in.
Thank you very much, Neeraj. Always a pleasure to be part of your show.
Thank you, sir. So how would you summarize the quarter, sir? I mean, if you look at the headline numbers, they look in line. One of the reports says that the modules segment is shining, but capacity addition has shown a bit of a drag. How would you sum up the quarter?
I think what we need to look at is that how the core businesses are doing, because if the fundamentals of the company are good, then the core business will do good. The other businesses which are non-core, sometimes they give you some profit, but they may not be so consistent going forward. So all our core businesses have done very well. Our generation has always been the cash cow and has performed well. Our T&D has done very well. Our Odisha Discom has started showing very good results, and that is the trend you will see going forward, because many of the legacy issues that we had in Odisha, we've been able to overcome that. Our AT&C losses have improved. So also our customer service, reliability and all has improved tremendously. And what you have seen in Q4, that will be the trend going forward for the whole year in Odisha. Similarly, for our manufacturing of the solar cells and modules, exceedingly well performance in the fourth quarter. That will be the trend going forward, because the whole year we will see the full impact of the cell and module plant operating at full capacity. Similarly, rooftop has done exceedingly well in the Q4. That will again become the benchmark for performance during the year. So I think you will start seeing many of the things that we had started or had taken initiative to invest. Those results will start coming from in the whole year of FY26.
So if Odisha indeed does as well as it has done in Q4, then the base effect comes into play for you as well for FY26, sir, I presume. And also, TP Solar performance was strong too. You reckon that will continue?
Absolutely right. And, the cell and module plant, both of them have stabilized. Production is good. The efficiencies are very good. And what we will see is only improvement in all these areas, because these are very highly sophisticated and automated plant, and many of the initial teething problems we have been able to overcome. So all in all, I will say that both cell and module will produce more than 3,700 megawatt. The plant in Bangalore will also operate, and the TOPCon will operate also at full capacity in this year.
Got it. Dr. Sinha, the question that I would have is that if indeed, let's say over the next 5 years, because the plans are large, right? I mean, and across varied segments, could it well happen that in a year you might miss select targets as per the guidance that you've given due to various factors, only to make it up in the next year? Because there is, I mean, almost I read 3 reports, all of which spoke about how the FY25 RE addition as well as the capex target has been missed. But could it well happen because there will be spillovers and you would make up for that maybe in FY26? Similarly, could happen in FY27, 28 also. Is that the template, if you will?
I don't think that's the correct way of extrapolating, because what happened, the pace at which we are growing is very high. And it took time for us to set many of these things right. Now that all has stabilized, you can see a very stable performance. So today we are much better equipped in getting land acquired for our renewable projects. The whole evacuation arrangement which is to be done is all tied up. So many of the things which we were in last year, we were still trying to figure out, have been all set right now. And hence, you will see that the consistency of performance will be very good. And that's why I'm saying that our core business, the fundamentals of the core business is very strong foundation. And it will only see huge amount of improvement in the investments that we have made in last few years.
Got it. Is there a probability, sir, that while you've given some of the guidance, by the pace of execution that you would do, you might, let's say if you've given the FY30 guidance, that there's a high probability that you might achieve it sooner as well? A lot of your peer sets that I talk to all talk about these probabilities, that the opportunity size is so large and they want to move at a quick pace in order to take the advantage of it, because the government of India ambitions are much larger than what all of the players put together might be able to dish out by FY30.
Yeah, so for us, it has always been about very calibrated growth. We have not set huge target in terms of the capacity adds, but what we have given is the improvement that we will do in terms of the returns of the businesses. And that's what our focus is. This quarter also, you have seen that our EBITDA has improved tremendously, and our returns have improved tremendously. And that is what we are focusing on, so that we have more stability in terms of the profitability, in terms of free cash, and how we set up projects which will ensure the benchmark returns that we are looking for our business.
You reckon 15 to 17% CAGR EBITDA growth for the next 2-3 years is a possibility? That's what the estimates are, despite the fact that maybe your module margins, which is not a very large part of your console maybe, but the module margins might just normalize a little bit from the higher levels that they are right now. But do you reckon 15-17% EBITDA growth possibility?
Yeah, absolutely. That's the whole objective of setting up these plans and creating the right template for growth in future. And many of the things that we started in last 2-3 years, those results have started coming. This year, you will again see that some of the transmission projects that we are doing, they will get established. Out of the 6, 4 will get commissioned in this financial year. So I think all in all, we have large number and a large pipeline of projects that we need to execute, and with a better understanding of the market dynamics, as also in terms of the supply chain, we are much better equipped. So just for giving you the example, today we make our own cell and module. So our understanding that what will be the price of the modules that we will use in our own utility scale projects is much better and much better controllable. So there will be much better consistency in the performance of the company going forward.
Got it, sir. Okay. We'll leave it at that, Mr. Sinha. Thank you so much, Dr. Sinha, for joining us today and giving us your perspective, and all the best for the quarters ahead.
Thank you very much.
That's Tata Power, confident about execution as well as the targets being set. But you know what, we're wrapping up on the show because we're out of time completely, on the note that it's a bit of a sober market, except for the small cap space, which is fourth consecutive day of outperformance versus the large caps, 0.6% higher, and fairly heartening on that. Wrap it up on India Markets Open. Up next is Ask Profit.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vachrajani, apologies. And we will take you through the next 1 hour of trade. It's taking me a few seconds to get started. I need to have some more coffee. But let's take a look at where the markets are this morning. And it was expected that we would see a little bit of consolidation. This was par for the course. We are seeing a little bit of a cool off from the kind of heady start that we had to the trading week. And we are down about 0.4% for the benchmark Nifty 50. Let's look at the broader markets, and they are outperforming yet again. The mid-cap index up about 0.33%, and the small-cap index doing better than that, up as much as 0.6% or so. And this is the fourth consecutive session in which you're seeing the broader markets outperform the benchmark indices. Let's look at the contribution on the Nifty 50 just to give you a sense of what is moving the needle today in trade today. You are seeing a few of the heavyweights that continue to languish a little bit. So HDFC Bank, Infosys, Reliance Industries, ICICI Bank, the same set of stocks that have proved to be a drag in trade yesterday are continuing to do so today as well. A few steel names even from the Nifty 50 and the broader markets, and metal pack as a whole is doing particularly well. In fact, let's pull up the sectoral indices just to give you a sense of what is moving in trade today. You have the metal index that's topping the charts, up about 1% or so. You have media, you have realty that's up and about, up 0.9%. Defense is one thing to watch as well. Let's pull up the defense pack and see where it's at. At the start today, it was really outperforming, and it continues to do so. Something like in Zen Technologies continued to be on upper circuit. Cochin Shipyard up about 4%. Mazgon up about 2.5% or thereabouts. We're joined this morning by Kush Bora as well as Mr. G. Chokalingam. Thank you so much, gentlemen, for taking the time. And let's start with a question on Wipro. And we've got a question from Qatar. I don't have the name, but bought at levels of 307 in March of this year, currently sitting on a loss. Should you book losses at this point? And really, that is the question. With the upswing that you've seen in IT, should you hold on? Kush.
Hi, first, a very good morning to you, Mr. Chokalingam, and all the viewers. Well, I think you could continue to hold on, but with stop loss around the 230 mark. Let's be honest, Wipro actually falls a lot lower, in the pecking order when it comes to the large IT names. But we're seeing some sort of a recovery that likes of TCS and HCL Techs of the world have shown signs of recovery. Wipro is also getting there, but, the momentum is missing. So while, there isn't a real breakout rally on this one, the fact that it's steadying, the ship is steadying and the stocks are starting to move higher, suggests that he could exit closer to his buy price of about 300 or maybe, 285 to 300 zone. So my suggestion would be to hold with a stop loss around the 230 mark.
Okay, so that's the view with regards to where Wipro stands. The next question is on Nalco. Venkat from Chennai is writing in, and he's holding 420 odd shares, bought at 179 a piece. He wants to know whether this is a good counter to hold for the longer term, from a longer term perspective or not. Mr. Chokalingam, a very good morning to you. I'll come to you on this one. What's the view on Nalco?
Yeah, for time period beyond 1 year, one can hold it. Because the resolution to trade war between China and US is really positive for metal stocks. The deflationary condition would be avoided, serious deflationary condition. So therefore, the outlook for metals, particularly for aluminum and copper, now suddenly improved. So for medium to long term, it's a hold. In case it declines more than 10%, then one can definitely buy quite aggressively.
Mr. Chokalingam, before I take any more questions, I know that we've spoken to you in the past, I think it must have been around July, August last year, where you said that there's too much froth and there's not many opportunities that you're seeing to buy. We've seen a drop post that, we've seen a recovery from those low points. So at this point, when you're talking about the Nifty 50 trending towards that 25,000 mark, not there yet, a lot of people talking about the fact that we're not too expensive, not too cheap. So if you are to deploy, where would you be deploying at this point?
Yeah, very interesting question. That was right. Post September, there were a lot of bubbles, and in February we lost 100 lakh crore of market cap, overall market cap. So from 484 it became 384. After that I changed my view, but again even now little nervous only on border issue. Otherwise, India story looks too good. It's very, very impressive. Last year we had a too good monsoon. Now again, the monsoon forecast is good. Food grain output is going to be record level. Inflation is at a record low level. GDP growth is above 6%. Forex reserves are near record level. There are so many things happening. The only fear is on the border. If there is no major conflict, I think we are set for major recovery. Even now we are down about 50 lakh crore from the record high market cap. I think in this year that can be fully recovered. And I would put, personally also, if you ask me, 60 to 70% of money only in a small and mid cap. Because in the large cap, even now, many sectors are struggling with a single digit volume growth. But out of 4,000 small and mid cap, there are plenty of opportunities. So one should put in equity asset allocation, 30% in the large cap and 70% in the small and mid cap. And one should start with the banks, particularly the public sector banks. Most of the banks are now trading at a one-time book value and looks very attractive. So that is the one space one can look at. Otherwise, it would be very stock specific within the small and mid cap.
I'm sure that our viewers have questions on that, but quickly, Mr. Chokalingam, if you list out maybe 5 or 6 names that you're looking at very closely right now from the broader markets.
Yeah, so I didn't want to volunteer because whatever I recommend, I also invest.
Yeah.
So the topmost one is Nesco. My family, my company have invested. I believe that this is comparable to how the BSE created wealth in the last 7-8 years. I believe I am positioning this as a next generation stock, but the viewers should take their own call because we have invested after recommending to our clients. And the second stock is Bombay Burma. I believe it's a phenomenal stock. It is trading at some 78% discount to value of investments in Britannia. Interestingly, perhaps first time in the century, Bombay Burma gave 2 interim dividends and a very high dividend. I think it doesn't deserve close to 80% discount to value of Britannia. Third stock would be Canara Bank. It's not going to be a multi-bagger, but 20-30% return is very much possible. And it's a really phenomenal stock. Nearly one-time price to book value on 25. And if you take 26, it will be significant discount to price to book value. You have a lot of triggers. One trigger is unlocking money from insurance and the AMC company. And second, I was surprised to note from the management interview that this is holding the largest gold loan book among all the banks. So this is another stock. Fourth one would be Cyient Limited, down a lot, but I believe this is one of the best stocks in the mid-sized IT company because the business is highly diversified. You have a standalone IT services through Cyient, then you have a Cyient DLM which is catering to engineering. Third, you have 100% subsidiary which is catering to semiconductors, which has just started. And the cheapest stock as compared to its peers, Cyient. So these are the 4 stocks. Out of that, personally, we hold Nesco and the Bombay Burma.
Nesco Limited, 6,700 odd crore market capitalization. It is in the business of licensing premises in the IT park buildings and that space. So watch out for that. And do bear in mind that you should do your own research. Of course, Mr. Chokalingam has pointed out what he likes in the space. We've got our first caller for the day. We've got Ramesh calling us from Tamil Nadu. Hi, Ramesh. How can we help you today?
Sir, I have Adani Enterprises.
Okay.
200 shares, about 3,195.
Okay.
What can I do now? Want to average or?
Okay, I understand your question. Let me go across to Kush on this one. Kush, we've seen Adani Enterprises and a couple of other stocks from the Adani group that have moved up post results. In fact, in the up move recently, they've participated in a big way, particularly Adani Enterprises. What would you say about the levels on the upside though?
My suggestion would be to hold. I wouldn't suggest averaging as, I think is now well known. I'm not really a big fan of averaging. What I would suggest is to hold on to this one. The stocks made a good base, around the 2050 mark. You're seeing a steady recovery on this one, not a breakout rally just yet, but that's understandable because the rounding bottom formation resistance comes nearly 2600 mark. Also happens to be the 200-day moving average resistance just close to that level. So I think 2600 is the key level to watch for. Once it breaks past that, then you will perhaps see a much sharper jump to 2750 and then about 2950 kind of levels. Since the stock is holding steadily and gaining traction, my suggestion would be to hold. Slightly deepish stop loss for this one is about 2300. As I said, 2600 is the level to watch for, past which the stock could gain momentum.
All right, standard disclaimer here, you know this already, but it bears repeating. NDTV is part of the Adani Media Group, which is part of the Adani Group overall. We've got the next question on the oil marketing companies, and Mohit is writing in from Ludhiana and asking between the three. He's got IOC already. He's looking at adding perhaps an HPCL or a BPCL, and which is the better stock to pick for the next 3 years. Now, it's interesting, Mr. Chokalingam, marketing margins have benefited in the recent past, and gross refining margins are actually better than the Singapore GRMs based on the fourth quarter. And with crude prices being benign, would you say that these are companies to look at?
I would avoid.
Okay.
There may be an opportunity to make money, but as you rightly pointed out, the oil prices are extremely volatile, and some of these companies have, once in a while hit from the inventory losses by holding the crude oil. And second, the refining margin is also highly volatile. Even for analysts like me with a good amount of experience, we find it difficult to predict, in a stable manner how these companies would perform, even for next 2-3 quarters. So I would prefer, because you need to have a lot of confidence and clarity before you invest. That's a basic funda I follow. So instead of investing in oil marketing companies, I would invest in Coal India. It's a phenomenal stock. If you look at the investor presentation, they have paid about 1,71,000 crore as a dividend to the investors after they went public, and sitting on a huge cash. And coal outlook remains very strong for next 10 years, and the dividend yield will be close to 7% for current fiscal, and also diversifying into the other minerals like graphite, and a lot of expansion in solar power. They are talking of 9,000 megawatt of solar power in the next 7 years. So this stock gives me phenomenal confidence. I have no fear of going wrong miserably in this stock, whether for next 2 quarters or for next 2-3 years.
Point that you make, Mr. Choklingam, and I think a lot of our investors that are tuning in will have an experience over the last 4 to 5 years. And interestingly, I was speaking to Mr. Ramesh Damani yesterday. This is an interview that plays out tomorrow on MoneyWise. And he was talking about the last 30 years and saying that many strategies have emerged. But the one that has stood the test of time is value. So if you see that a valuation of a strong company is relatively is not being priced appropriately, then you should go and buy it, even if there is a period of consolidation, because as you've pointed out, there is earnings through dividend distribution. Would you agree?
Certainly. I mean, he is most respected by all of us. We consider him as one of our gurus in the market. So he made a lot of sense. I just want to add a few points. Value investing goes through pain. I was put under tremendous pressure for recommending BSc at 200 rupees adjusted for bonus 6 years ago. So, but it plays out. So 2-3 facts I want to say that in my learning in the last 35 years, the value stocks, they test your passion sometimes even for 3 to 5 years. But when they catch up and reward you, there is no comparison. And second, in contrast to value stocks, when you invest in a momentum stock, like for example, the Brightcom, EKI, Gensol, there is enormous risk. There is enormous risk. So you have to understand, a detailed manner before you buy stocks at 50p, 40p, all that. So therefore, the value investment for retail investors really, great help. But one has to be really long term. Minimum 2-year investment horizon one should have.
The important takeaway is that do not run behind only momentum, but you should also take a look at where the valuation stands, and value company over anything while investing comes into picture. All right, the next question is from Ravi, who's calling in from Hyderabad. Ravi, a very good morning to you. How can we help you?
Yeah, very good morning. Yes, my query is regarding ICICI Bank.
Okay.
So, at what price it is good to buy?
Okay.
And can I expect for more correction going forward?
Okay.
And I can hold for 1 to 2 years.
1 to 2 years. Okay, got your point, Ravi. I'll quickly come to you, Kush, on this one. In terms of the earnings for ICICI Bank, it is one of the top performer in terms of the Nifty 50 company. Overall net provisions, net interest income did improve. Asset quality also improved sharply. But with respect to where charts are concerned, do you think this is the right time to enter?
So first, let me start with the fact that, I'm very bullish on ICICI, especially if the outlook is, 1 year, 2 year, as, viewers just mentioned. However, from a tactical standpoint, my suggestion would be to wait up before, you buy right now. I think a good entry point will be closer to the 1400, 1375 zone, perhaps even 1350, 1350 to 1400 zone. Now, the reason I say that is because while the likes of HDFC Bank and SBI in the heavyweights have already seen some sort of profit booking, ICICI is yet to see any kind of a meaningful profit booking. So that is par for the course, especially if you look at the weekly and the daily setup. They are suggesting negative divergences on multiple legs, which is not really a healthy sign. And while, it might right now consolidate with a positive bias, these are indicators that, there could be some correction or some profit booking along the way. Mind you, the correction need not be so deep. Hence, I'm suggesting, about 1400 to about 1350 kind of zone where he could start accumulating. On the whole, the outlook is very bullish. I think he can expect levels of 1550 and about 1625 also, in the coming year's time frame. So not a bad idea to accumulate, but on declines closer to the 1400 mark would be a good entry point.
View on the outperforming frontline bank, ICICI Bank. We've got the next question on a stock in the telecom space posted its numbers earlier in the week, Bharti Airtel, and a decent set of numbers. The average revenue per user stood at about 245, if I remember correctly. I've not looked at it on my screen right now, but looked good. Harish from Bengaluru is looking at a strategy where he's adding this as a portfolio stock, Mr. Chokalingam, and he's looking to accumulate 2 shares of Airtel every week as a strategy. Is that something that you can recommend?
Yes,
not every week, sorry, every month. Every month, yeah.
So SIP is always good in equity asset class because Indian market is extremely known for volatility, even including large caps. And coming to Bharti Airtel, yes, the telecom business is going to remain very robust. The tariff would be allowed to steadily go up because that's the only way you can revive Vodafone. And it's not good for a third player to get eliminated, which is not good for the society. So definitely there would be a very friendly policy towards the telecom sector, and also it's a consumer oriented. And considering all that, yes, it's a good long-term large cap stock.
That's the view with regards to where Bharti Airtel stands. Our next question is from Raghu, who is calling in from Bengaluru. Raghu, a very good morning to you. How can we help you?
Good morning. I hold Adani Total Gas 400 quantity. Buying price is 910.
Okay.
So I hold this stock from last 1 year.
Okay.
I'm looking for next 1 year. I just wanted to know, is it good to average or hold or exit in loss?
Okay, got your point, Raghu. I'll take this up with Mr. Chokalingam. Mr. Chokalingam, in terms of Adani Total Gas, for Q4 earnings, volume was up 13%. CNG network also increased to around 647 odd stations. What's the view with regards to where fundamentals stand for the company, and is it a good time to average out for the next 1 year?
Yeah, one can hold it even for 1 year time frame. And in case it starts falling, even 2-3%, one can accumulate with 1 year investment horizon.
Okay, standard disclaimer, Adani Total Gas is also a part of Adani Group of companies, and as Alex mentioned earlier as well, NDTV Profit is also a part of Adani Group of companies. All right, the next question is from Sulochana, who's writing in from Visakhapatnam. She's holding HPL since a year now, and she's bought at the levels of 617 and holding 700 odd shares, and wants to know as to what should be the next course of action for her. Should she continue to hold, or should she sell? Kush, I'll quickly come to you on this one. HPL, Electric and Power, what are the charts indicating?
Well, like most of the mid-cap stocks, this one's also starting to see some traction. I can see, that there is accumulation that is happening at least in the last 3 to 4 sessions. If you look at the stock, there has been accumulation. The stock's trading with a positive bias. Near-term resistance near the 455, 460 zone, but I think once that is taken out, the stock could well move towards the 500 mark and higher. I think there could be some time before she sees her buying price, but on the whole, the things for HPL are starting to shape up well. I would suggest a hold on this one. A stop loss on this one comes close to the 395 zone.
Paramjit is calling us from Himachal Pradesh. Paramjit, very good morning to you. How can we help you today?
Morning, sir. I am having 100 shares of Force Motor at the rate of 6,200.
Wow. Okay. When did you buy this?
2 months back.
Okay. Okay. What a great entry point. Yeah.
Yes. Want to know long term as well as short term.
Okay. All right. And when you define long term, Paramjit, what is the thing?
2 years. 2 years.
Okay.
2 years.
So are you looking for a technical view, or are you looking for a fundamental view?
Both.
Okay. So in this case, I'm going to make an exception because you've made tremendous gains. Mr. Chokalingam, would you say that on the fundamentals, holding at these levels is appropriate for Force Motors?
It has done phenomenally well in the last 10 years, no doubt about it. But The price also reflects, the achievements in my view. Trading at around, 28-29p on FY26 expected earning, which is fairly priced. So anything beyond 11,000, I believe it's a good sell.
So this is a stock, of course, in the automotive space. They've got manufacturing in Pune, as you know. It's up 62% year to date in 2025. Wondering what the advice is on the charts from the short-term perspective, since Paramjit is sitting on gains of 4 lakhs or over, if I'm not mistaken, 4.5 lakhs. Kush, what's the view?
I think this is where you could say that going against the tide is actually profitable. Money is made by courage more than anything else. So kudos to him on buying this stock when perhaps no one else was as interested. So kudos on that. Now what we are seeing is that on the weekly setup, there's a very clear breakout of the rounding bottom formation around the 10,100 mark, and there is momentum catching up. The volumes in the last 3 weeks has actually have actually picked up, which is a very healthy sign. So if his view, as he rightly said, he's expecting a long-term kind of a view on this for anywhere from 12 to 24 months, he should continue to hold. However, there are now negative divergences setting up on the daily chart. So my suggestion would be to book out partially, and by that I mean about 25% or so, and re-enter close to the 10,000, 9,500 zone. But you wouldn't want to let go of the entire holding, right? So you could perhaps trade or book partially with around the 25% of your holdings, continue holding on to the rest of them. There's a good possibility that you could see 12,000 and about 12,800 levels, in the coming months' time.
Okay, so that's with regards to where charts stand for Force Motor. Very interesting moves, in fact, and significant amount of momentum seen in this particular counter. All right, the next question is on IRB Infra. Raja from Chennai is writing in, and he wants to know whether this is the right time to enter IRB Infra or not. 1 year is his perspective. Coach, from a slightly longer term perspective, do you think these are the right levels to invest in something like an IRB Infra?
So a lot of these stocks have started to run quite a bit, and there is all likelihood that this traction could well continue. I think this is a good time to enter IRB Infra. The reason being that it's made a good base. Now it's moving up. It's now taken out some of the near-term averages, heading towards the long-term average. So I think you could very well enter right now. Now it had a resistance around the 48 mark. So your stop loss is very clear. Maybe just under that, which is 47.5 is where you place your stop loss. On the way up, you're looking at targets of 54, and once that is taken out, even a 58. So the risk reward ratio on this one is very attractive. You are seeing volume pickup as well. So on a lot of counts, it does fit the bill. So with the stop loss around the 47.5 mark, this is a good time to enter, IRB Infra.
Good time to enter IRB Infra with respect to where charts are concerned. All right, the next question is from Ronak, who's calling in from Odisha. Ronak, a very good morning to you. How can we help you?
So I'm a novice investor, and my query is, should I enter Nestle India now, or we can see any dips further?
Okay, and you're wanting to invest in this from a longer term perspective?
Yes.
Okay, so you want a fundamental view on this. Okay, I'll take this up with Mr. Chokalingam. Mr. Chokalingam, in terms of Nestle, unlike FMCG companies, it's been a stable, steady growth. It's not like they're outperforming their peers or underperforming. Overall, it's a steady space of growth. What's the view like from a longer term perspective? Should Ronak make an entry in this counter?
It used to be a great growth company, but in line with the whole industry trend, all are suffering, finding it difficult to post a double-digit volume growth. Surprisingly, couple of FMCG industrial stalwarts also, leaders also mentioned that the recovery might take place in next financial year, FY27. I also believe that, the poor single-digit growth volume would continue in the FMCG space. So in contrast to FMCG, I would prefer stock like M&M, again index stock, because both automobile segment and tractor segment, this company is doing phenomenally well. And though overall automobile sector is growing in poor single digit, it's a volume. This company is beating, all the competitors by big margin. And I believe the growth story would remain intact for M&M. So M&M would be better bet than FMCG stock like Nestle. That's my view.
Interesting. And a lot of people have that view. In the consumption space, steer clear of the FMCG space for now and see how that develops over a period of time. And of course, Mr. Chokalingam has called FMCG companies SMCG companies, slow-moving consumer good companies. So let's see if that view changes in the second half of FY26. But we've got a caller. Dheeraj is calling us from Hyderabad. Hi, Dheeraj. How can we help you?
Hi, sir. Good morning.
Good morning.
Sir, my query is regarding Tube Investment of India.
Okay.
They are declaring the results today. They are declaring the results today. Can I buy Tube Investment of India at current levels, or NTPC at current levels, or any other suggestions which are given by you, or should I wait for the market to correct more?
Okay.
Is my question.
So
is it the right time to enter into Tube Investment or NTPC? Is my
Got it. I got your question. I just need to identify whether you are buying this on the fundamental basis for the long term, or is it a short term trade you're looking at?
Sir, for a trading view for the next 1 month or below that.
Okay, I got it. All right, Dheeraj. So let me go across to Kush for this one. Kush, Tube or NTPC, which one would you suggest? Or another one?
So first things first, I mean, I usually don't recommend a trade, on the day of the result, because it's a fairly volatile day and it's a binary event, right? And it could go either way. But let's just keep that aside for a bit now. If I were to just independently, agnostic of the fact that the results are being announced today, if I were to look at the Tube investment, I think it's shaping up rather well. It's seeing good traction as well. The momentum indicators are, turning positive. Also, there's a positive, crossover, a golden crossover of the 20 and the 50-day moving average. So those signs are healthy. My suggestion would be to stick to Tube investments and not look at NTPC just yet. The setup there is a little somber, a little muted. But maybe if you could just wait for a day, let the results, event be out of the way, and then he could consider, getting into Tube investments. Stop loss on this one would be 2,800, and on the upside, you're looking at targets of 3,300 and 3,500. So Tube investment does look well. It's just that on the day of the trade, on the day of the result, you might want to perhaps avoid a big trade on this one.
Avoid trade on the earnings day is the view, but can take a call post its earnings is the view coming in from Kush. All right, it's time to slip into a very short break, but we'll be right back answering more queries and an interesting conversation with AkzoNobel's management on the other side. So stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered. But, we also have a conversation with AkzoNobel's management today. The company came out with its earnings, where the numbers were largely in line. There was a double-digit growth in terms of its B2B business. Revenue was up 9%, EBITDA up 32%. Margins have also improved to 13.7%. And to discuss as to how the quarter has gone by and how things are shaping up for FY26, we're joined by Rajiv Rajgopal, CMD of AkzoNobel India Limited, joining us now. Rajiv, a very good morning to you and always a pleasure speaking to you. My first question is that your sense of how the quarter has gone by, because it's been yet another stunning quarter for you, and overall, what has the volume versus value growth been like?
Thank you, Mahima. Thank you for having me on your show. First and foremost, good morning to all the viewers. Look, I think the quarter is a better than expected performance. Honestly, if you look at our numbers, we've had industry-leading growth. We've grown at about 5%. And the good part is we are seeing decorative slowly come back in it. We've had a sort of a flat sort of a performance, but still considering the sort of competitive intensity and the fact that we've really grown in premium, which is why our margins are looking very good. And we chose not to play in the mass and economy where there was a massive amount of discounting happening in towards the end of the quarter. And we've seen the growths come back in April. I think it's a strong performance. In our coatings business vertical, we've sort of had double-digit growth, and this is continuing over the many quarters. Overall, I would say that we've had a very strong growth. This is another quarter of market share gain, and we remain focused. We are focusing on our brand innovation, looking at how we can get in meaningful differentiated products into our customers, and making sure that we are able to deliver leading performances.
Right, Rajiv, interestingly, you also mentioned that you've gained market share this quarter as well. Just wanted to understand as to, a rough figure as to where your market share stands right now versus what it was, let's say, 2 years ago, so that we get a sense of how much of a market share gain has happened for AkzoNobel.
See, we've gained approximately about a 0.6, 0.7 if you take a 2-year period, and that's meaningful in a segment like decorative, particularly with the competitive intensity that is. For two reasons. One, we have a higher skew towards premium products where I think our brand and consumer disposition is fairly high. And so hence our ability to really deliver the promise of quality, Dulux Assurance, has been very, very strong. Over and above that, we've launched innovative products. Right at the top end, we've launched Dulux Velvet Touch Eterna, about 4-5 months ago. It's doing very well. We've got very good reports in terms of the product quality. So our focus really has been around building and making sure that our premium portfolio and decorative is insulated. On the mass and economy, we are reworking a few tactics, I would say, because I think our products are fairly good, but we really have to rework tactics and a bit of distribution so that, in the quarters ahead, we also start pulling that part along. Yeah, so, to answer your question, I also say that, look, I think in our coatings businesses, whether it's marine and protective, our powder coating business, our industrial coating business, we've had very strong growths. Yeah, so I think overall, I would say that the market share gain has been about 0.6 to 1 if you look at the company as a basket, which is what all of you've picked. And I think I'm pretty proud of what the team is doing under the current circumstances.
Rajiv, hi, Alex here.
Hi, Alex.
The perception when you're looking from the out in, and a lot of investors are worried about this, is that there is a considerable amount of pressure in terms of pricing. There's a lot of action in terms of competition coming through. How do you react to that? And would you say that as a result of this, an investor should be okay with contraction in margins? What is your focus on? Are you focusing on volumes, on pushing certain segments? How are you dealing with it?
So I think we are trying to gainfully gain market share. So hence, obviously, it is related to volumes. But at the same point of time, we are making sure that the contraction in our EBIT margins are not very high. If you look at our EBIT margins, and that tells you a story of a player with the sort of market share we have, our EBIT margins are almost 13.4, and clearly, I think if you just look at the EBIT margin percentage of the last quarter, we are just behind the market leader, which I think is around 15.9, 16%, right? It tells you the profile of the business and how we run this business. So I think that answers your question, Alex. I think, look, we are trying to make sure that we operate within a band. I've always said that, look, to me, I think for a number 4 player, particularly from a decorative perspective, margins of between 12.5 to 14 is ideal, but 13 to 15 is what we normally try and target. And I think we are on track on that. Yeah. Look, I think the fact is the industry, now if you look at the numbers that have come so far, is seeing some growth. I mean, you've also got to realize that the new entrants have added potential volume and value. However, obviously the margin profiles are significantly lower. So I think from our perspective, it is really saying, how do you meander this? How do you use a combination of mind and marketing strategies to make sure that you're playing actively without really bringing down the margin profile, the EBIT margin profile of your business. That's really the strategic challenge, and that's what we've been working. How are we doing it? As we speak, we've made significant investments, and that's what is seen in an OPEX cost on digital. Working with leading firms to really try and put a digital roadmap to improve, enhance customer experience, and make sure that we are able to target our consumers, customers in a much more meaningful manner. So we really focused on building the next step, because both digital drives it drives customer experience and it drives productivity from a long-term period. So that's what we are doing. We are doing a lot of pilots across different markets as we speak. We are looking at, we've got an innovation workshop very soon where we are going to look at meaningful portfolio over the next 1 year.
Okay.
So really, how do we actively partake and start growing the market?
Okay. You made your point very well, Rajiv. I'm just wondering, for an industry that is now coming to terms, I think, with a single-digit volume growth, does that change at all? And this is something that your investors are going to be very curious about, because ultimately if you say that you're going to manage your margin trajectory in a certain band, it's a tough working environment. Does the industry as a whole start seeing a higher trajectory of growth? When does that take place? And what are the factors that need to come into play for that to take place?
So I think that's a good question. First and foremost, two things. So first and foremost, to answer your question, we believe that this year we would get back to mid-single digit value. Volume will be a little higher than value in our case, because we are a very small player in part, in segments like putty and economy, etc., relative to the other players, right? So I think to answer your question, that's the first from our perspective. As far as the industry is concerned, I do think that it'll start slowly picking up. Look, the disruption that had to happen has by and large happened. Right. I mean, I'm saying that, you can say another 6 months or a year, but I think over that, I think if you look at structurally, this industry will get back to a double-digit growth. Now, obviously, the players who invested behind the brand distribution, making sure that you're driving meaningful innovations for the consumer, are the ones that are going to win, right? So I think it's about saying how can you maintain the price premiums that we currently have, right, versus our competition, and that's really the strategy that we are working on. Alex.
Rajiv, a quick question on competition. You did mention that you're the fourth best player in this industry. With the new entrant, plus we're seeing big players also taking away market shares. What's the view like and sense in terms of competition, and what are the strategies in place to beat that?
So Mahima, just to correct, we are number 4 in market share, but we have leading industry performance from last year. I think all results haven't come, but it will not be in vain to say that, look, I think so far, if you look at the full year performance of last year, we would be the leading player. So I just want to correct that. Yeah. Now, look, to answer your question, look, I think the strategies are not very different in paints. I think this is first and foremost, what is our strength as, Akzo Nobel? I think the strength is in the brands and the quality of the products that we offer to consumers. It's about the deep customer relationships, and more important, we've got technologies which are definitely ahead compared to many of our peers in the market. So I think that's what we are going to leverage. How do we really play around, not just on pricing per se, but how do we really partake in making sure that we are offering distinctive propositions to consumers that will impact and be beneficial in the markets we serve. So, for example, we are looking at innovations which are a little ahead in terms of how it can be relevant, whether it's pollution or whatever it is. There are certain platforms that we are working on to try and make sure that we have meaningful propositions to address consumer perspective. I hope I've answered your question.
You did. Rajiv, as best as you could. And thanks so much for joining us this morning. Wish you all the best. A tough operating environment, no doubt, but thanks so much for taking the time to clarify all of those things.
Thank you for having me on your show.
Pleasure. All right, since we're on the topic, why don't we just round it off and take Mr. Choklingham's view very quickly on the paint space. Mr. Choklingam, you heard the management of Akzo Nobel, and hopefully we asked questions that you might have asked. That really is the endeavor. But what would you say you would do as an investor? Should you double down on certain investments that you're making, or should you stay clear of the space for now? I think you might just be on mute, sir.
Sorry. I will sell paint stocks and shift to some quality stock in small and mid cap or to the banking stock, particularly the public sector bank. Quickly, yes, the stock is down 25%, but still it is trading at 36 times on trading earning. And when FY25, the revenue growth was hardly 3%. So I don't know why one has to pay 36 PE. That is a one point number. Second most important point is that all of us know Grasim and the Jindal Group are getting into paints. The one number which is carrying me is that the proposed capacity addition by this big player is roughly equivalent to 50% of the existing capacity. So when the industry is already struggling with a single-digit growth volume, I think this new competition, the two from a powerful industrial houses, is going to make things worse. Third, oil was crashing, but suddenly in the last 1 week, it went up by 8-9%. There is a possibility there could be some more rebound because of the trade deal between China and US, which would be negative for paint companies in the short term. So considering all that, on any rise, I would be a seller of paint stocks, including AkzoNobel.
Okay, so that's the view with regards to where the paint sector stands, and the view not looking very positive. In terms of the demand environment also, we'll have to wait and watch out for as to how Q1 pans out, because there's rate cuts, there's tax cut, there's 8th pay commission also coming in. But we'll have to see as to how that affects the discretionary spending overall.
Will paints be right on top of the order of priority in the list of things you could spend on?
Yeah. Absolutely. All right, the next question is from Kanti Bhai, who wants to have a view on two stocks, LTI Mindtree or Tata Motors. I mean, both of them. Kush, I'll quickly come to you on this one. Charts, how are they looking like for both of these counters?
So LTI Mindtree is shaping up rather well. If you see, on a weekly basis, the stocks actually run up quite a bit. Daily setup also looking rather encouraging. The volumes are a little thin, and that's perhaps not a great sign. But overall, there is price action, which is also which would then obviously be the priority. I think you could consider a buy in LTI Mindtree. On the upside, you're looking at targets at about 5,200, and once that is taken out, the 5,400 as well. There is a support zone near the 4850 mark, perhaps a little lower. That can be your stop loss. So that is the view on LTI Mindtree. As far as Tata Motors goes, this is a good buy from a 12 months to a longer time frame kind of a perspective, because the momentum is missing on this one. But the stock is very close to long-term averages, taking support, attempting a rebound, all of that. But because the momentum is missing, I wouldn't suggest a near-term trade. If you have 12 months or longer view on this one, with a stop loss around the 600 mark, you could consider Tata Motors as well.
I'm coming back to you on BSE Limited, and this is a question from Abhishek. It's a simple question: buy or sell at this point? It's a stock that is that has come up in the recent past as some of these capital market players have done well. Kush, would you suggest buying at this point?
So, Alex, no matter how bullish I remain on this space, I think from a risk-reward standpoint, BSE right now doesn't warrant a buy. It's actually gone into a bit of an overheated territory. Some negative divergence is popping up. That said, volume accumulation keeps on happening, and the price actually keeps on shooting higher. But from a near-term perspective, I think we'd be better off waiting for a dip, maybe closer to the 6,500 to 6,750 zone. On account of profit booking, as and when that comes about, you're better off buying at that time. Again, gunning for targets of 7,200 and higher. But right now, I wouldn't buy. If I had, I would hold, because the momentum is still there. No signs of abating. And, this could perhaps, inch higher. The momentum could take it higher. So with 6,950 as your trailing stop loss, continue to hold. But fresh buy is an avoid. Closer to the 6,750 mark, 6,500 zone is where you should consider a buy.
Okay, fresh buys and avoid right now as per Kush on BSE. The next question is from Raju, who's asking on Muthoot Finance. He's saying there's a huge fall in Muthoot Finance. He'd bought 1,000 odd shares at 2,300 a piece and wants to know if there'll be a rebound in the near time. Now, in terms of what's not working for Muthoot Finance, the AUM growth was largely driven by gold prices. The loan accounts and number of customers were only up by 2% this particular quarter. Overall, they've maintained their gold loan guidance of 15%. And this will be reviewed in Q2 FY26 versus over 40% in FY25. So falling gold prices might be a risk for this particular counter. So overall asset quality in the MFI portfolio has also worsened, and the stage 3 in MFI book has also inched up significantly by around 207 basis points. So a lot of moving parts here. Mr. Chokalingam, I'll come to you on this one. Your view, whether one should continue to hold Muthoot Finance at this moment or not?
If somebody is holding, definitely they can continue to hold because stock also reasonably corrected. But fresh purchase I would not recommend now. I believe the gold prices would correct at least another 5 to 10% from current level, which would be negative. And also, if you look at the conference call notes of public sector banks like Canara Bank, I mean the competition is slowly getting heavily intensified in the gold loan segment from the banks, which have got access to cheaper deposits. So therefore, buying can be initiated in case Muthoot Finance falls at least another 5 to 10% from the current level.
That's a view on Muthoot Finance. And Mr. Chokalingam has pointed out certain banks that have a large holding in the gold loan space as well. Let's talk about Hind Copper, and the entire metal pack, as we pointed out at the start of this program, is doing well. I wonder if Hind Copper is doing okay. So it's not doing too much in trade today, down about 0.1% or so. The question is from Jaya, who's writing in from Bengaluru and asking what the best entry price is and what the view is for a year. Kush, on the charts, how does it look?
Rather exciting. I would suggest this itself is a good entry point for Hindustan Copper. The reason being 228, 230 have been a bit of a resistance zone. It's taken that out yesterday. Even today, even though it's a bit soft, it's trading above that resistance zone. So it's a good idea to consider a buy at the current juncture. What this also does is that it gives you a good risk reward ratio where your stop loss is close to the 215 mark, where the 20 and the 50-day moving average are nearly about colliding. And so that's a 15-16 rupees stop loss. But on the way up, you've got a 250 as the first target. Once that is taken out, you're looking at a 270 as well. So risk reward ratio is fairly attractive on this one. Breakout already there, sustaining above that on a muted day as well. So not a bad idea to consider at the current juncture.
So that's the view with regards to where Hindustan Copper stands. Our next question is from Harshit. He wants to know about Samvardhana Motherson. He's bought 800 odd shares and wants to know whether he should sell it by today or wait for a little longer. Kush, on the charts?
Well, it's gone into a consolidation mode. Volumes aren't really anything to write home about. Price action also rather muted. So it's not got a lot of things going for it just now. If it's bought for a very, very short-term kind of a perspective, then I would suggest, yes, it's not a bad idea to, exit at the current level. The steam after, a rally from those 130 levels that started about, a month or so ago seems to be now just cooling off. So not a bad idea from a very near-term perspective to book profits or exit from Samvardhana.
All right, exit is a call in Samvardhana, and from an auto anch player to an original equipment manufacturer that is underperformed, Hyundai. This is Hyundai Motors India that we're talking, of course, about, and it's 1,960 is the price that Gautam has gotten it for in the IPO. The stock is currently trading below the IPO price. He's got 98 shares. He's wondering whether to hold or to buy more from the perspective of the next 12 to 18 months. Mr. Chokalingam, on the fundamentals, would you buy more, would you add, or would you hold, or would you exit?
I would exit if some investor is very keen on investing in automobile. M&M is better. But if you are looking for better opportunity in general in the large cap in the stocks segment, then SBI. Because as I mentioned earlier, the banking sector assures double-digit growth. It's one of the few sectors to grow the core business parameter in double-digit. So I would suggest M&M or SBI in the large cap space instead of holding Hyundai.
All right, Sampath is calling us from Chennai. Hi, Sampath. How can we help you today?
Good morning. I have 1,000 shares of Gravita bought around 60, okay?
Okay.
I want to buy another 500. This is the right time.
First, Sampath, can you tell me the story as to when you bought this and what the thinking was?
Over a period of around 4 or 5 years.
Okay.
Long time back.
Yeah, and congratulations.
Averaging little by little, I bought them.
Yeah. Congratulations.
I'm the same Sampath who called you from Ooty. I'm back from vacation.
Okay, I'm glad. I'm not feeling jealous anymore. But let's
I want to buy another 500, Alex. Can I do it right now at this point of time?
I will ask your question, Sampath, but I just want to ask you very quickly, when you bought Gravita India, what was the thinking when you looked at the fundamentals?
Well, metal recycling. A lot of metal is being wasted, recycling.
Okay.
It looks like a good company to buy.
Yeah. And so you're looking to hold for the long term,
right?
Yeah. So you're looking.
I'm in the long term. I'm for the long term. Yeah.
Okay. So let me take your question to Mr. Chokalingam. Sitting on gains of 19 lakhs or thereabouts on this acquisition, 60 rupees is his acquisition price, Mr. Chokalingam. This is the way that you buy and hold for the long term, and you keep averaging on the upside. So Kush has got a big smile on his face as well. So, but on the fundamentals, would you hold? Add more? 500 he wants to add right now.
I express view, but I would suggest the investor to take suggestion from our respectable colleague Kush, because I may go wrong on the basis of fundamental. It's a simple logical reason is that the great metal companies like Hindalco, Hindustan Zinc, which have invested heavily in plant and machinery technology, they are trading at anywhere from 15 to 24 PE. It is just recycling, melting and recycling and trading at over 40 PE. So fundamentally, it's very hard for me to give a buy call or hold call, but there is a chance of me going wrong because this stock has been a very tactical one and it has been moving up and going down a lot. So I would suggest Kush to give his suggestion rather than investor listening to my arguments.
Okay, fair point. All right, let me get a view then from you, Kush. What's the view on Gravita India?
So there is definitely an upswing that has resumed after those 1600 levels were tested for a while, and then the stock started to move up. However, there are a couple of technical parameters which suggest near-term resistance. So one, there is a falling trend line resistance which comes close to the 1960 level, the 200-day moving average close to the 2020 level. That might act as a bit of a resistance zone for Gravita, and it could spend some time here. So if I were to look at a very clear, clean view on Gravita as to when to add the fresh 500 shares, my suggestion would be wait for the 2000 level to be taken out. Especially if you're looking at it from a momentum play kind of a perspective, which by his investment strategy doesn't look like. But as I said, from a very clean view, technical clean view, 2000, 2020 are the levels that you should wait for. Once the stock clears that, I think any hangover, any supply zone will be taken care of, and then the stock could zoom higher. So it's an advice to once again average on the upside, and the level to watch for is 2020.
So that's the view with regards to where Gravita is concerned and technicals are concerned. Our next question is from Mahesh, who's calling in from Bengaluru. Mahesh, a very good morning to you. I believe you have a query on Page Industries.
Yeah. So I have 50 shares of Page Industries.
Okay.
At 28,000.
Okay.
So should I sell it or hold it as they are announcing the results today?
Right. Mahesh, you've bought it at, though it's a very expensive stock, but you've still bought it at attractive levels. Just wanted to understand your thinking behind buying Page Industries specifically. Can you hear me, Mahesh?
Okay. Yeah, I can.
Yeah, okay. No worries. I take this up with Mr. Chokalingam. As Mahesh rightly mentioned, Page Industries is set to announce its earnings today, and it is one of the beneficiaries of UK FTA as well, Mr. Chokalingam. What's the view like?
No, it's a great company, no doubt, but is it a good valuation? I have my doubt. The valuation company is not there. So post results, in case it runs up even 5%, I think it would be good to sell with a short to medium term investment horizon. That's with investment horizon up to 1 year, on 5% rise, it's a good to sell.
Okay, all right, so sell is a call on Page Industries. Hope that answers your question. Gentlemen, thanks so much for joining us this Thursday and for answering all the questions that you did. Before we wrap this program, though, we should take a look at Petronet LNG. It's buzzing, and Somit is here to tell you why that is, because it relates to another company, GAIL, and information that it has shared with the exchanges as part of its investor presentation. Somit, what stands out here?
Well, yes, Petronet LNG has been buzzing in trade. The stock is up more than 3% in trade. Now, here's what we have found out from GAIL's presentation. So, GAIL released its Q4 presentation yesterday, and do remember that GAIL owns close to 12.5% stake in Petronet LNG. So, as part of the presentation, GAIL had also given the profitability numbers for its associate companies, and Petronet LNG is one of its associate companies. Now, as per the presentation, FY25 profit of Petronet LNG for GAIL stood at close to 503 crore rupees. Now, back calculating this, which means that this 503 crore profit is for the 12.5% stake. So, if you calculate for the 100%, then for Petronet LNG, FY25 profitability number stands at close to 4,024 odd crore rupees. Now, if you deduct the 9-month profitability of Petronet from that, which stood at close to 2,850 crore rupees, the fourth quarter profit number of Petronet LNG is something that you can get, and that stands at close to 1,170 odd crore rupees, which is way higher compared to what the street estimate number is, which stands at close to 814 crore rupees. A clear beat of 44% that Petronet LNG could report in the fourth quarter numbers, and this has come in much ahead of the result date for Petronet LNG. So that's the reason why Petronet LNG has been buzzing in trade, and the stock is up 3% currently on the back of higher profitability expectations that the street has after seeing the profit numbers of Petronet LNG in GAIL presentation.
Yeah, 3% higher. Thanks so much, Somit, for joining in and giving us that perspective. 3% higher for Petronet LNG. Keep that on your radar. In the meanwhile, we're completely out of time on this edition of Ask Profit from Mahima and myself and the team that put the show together. Thank you so much for watching. Up next is Know Your Company.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome to KYC Know Your Company right here on NDTV Profit. My name is Puneet, and today we are going to be looking at a very interesting company in the electronic manufacturing services or EMS space, and that is Syrma SGS. Now, let's first look at why we have picked this particular company today to take a holistic deep dive into what it does, as well as some of its key strengths, weaknesses, as well as how it favors or maybe compares to its peers. Currently, for Syrma SGS, valuation is one of the key triggers, and we'll talk about that in one of the key parameters as well. If you look at one of the key other aspects is, of course, the company is looking for a turnaround that has started over the last 2 quarters. Again, something which is, I'll give you a spoiler, is right on margins, and we look at that in detail as well, and a substantial change that the company is going through within its product segments that it operates in. So those are the 3 key reasons why we will be looking at this company today and take a holistic deep dive into this one. When you look at the key parameters as well that we will be looking at for KYC today, essentially the first will be in terms of the income statement will be some of the key things that we will be looking at. Apart from that, if you can pull that up on the screen very quickly, that will be the first parameter. We'll also be looking at the balance sheet, the cash flows, as well as return ratios, and give a key rating for all of these. Apart from that, we will be looking at the shareholding, the street credentials, as well as the street coverage on the stock, and finally, a relative valuation picture of how it compares to someone like its peers in the EMS space. Let's first look at what the company actually does. In terms of introduction, Syrma essentially is an integrated electronic manufacturing service player. As I mentioned, for someone who doesn't know, EMS essentially is a player that manufactures for other key companies. Now, that could be somewhere in the consumer durable space, making refrigerators, electronics, air conditioners is one of the key other parts. And currently, they have 14 manufacturing facilities in India. Apart from that, the company also has 4 global R&D centers that it has all over the world. They also have one in Germany for more research and development purposes and entering more nuanced engineering products as well going forward. Now, to understand more about the company, let's look at the 5 key current segments that it operates in, because within EMS as well, we have a lot of companies that focus on mobile, such as Dixon, but for Syrma, there are key 5 segments that you need to know about. First is, of course, the automotive side, where it focuses on EV mobility as well as accessories. That's for almost 1/5 of its revenues. The second key aspect is the industrial one, and this is expected to be the lead in terms of revenue going forward. It manufactures products like smart meters, solar controllers, as well as industrial cleaners. The third one is consumer, and that's something that's common across the EMS players, but within consumer as well, there's multiple products that we just spoke about, like refrigerators and air conditioners. For Syrma, they have some, essentially some mode in BLDC motors, something that's used in fans. They also manufacture Wi-Fi routers as well as modems as some of the key products for the company. Apart from that, in the IT and railway space, the company manufactures a signaling system, which is a key product in terms of margins as well. They also manufacture something like controllers, braking systems, and that's all for the railways as well. Within IT, it also has in PLI for manufacturing laptops. Well, currently something that the company is looking at very closely. Finally, the 5th segment is healthcare. They've also done an acquisition in this space over the last 18 months. They manufacture medical devices as well as diagnostics and therapeutic products, something that they are keen to grow in terms of revenue. Now, within the 5 verticals, let's look at how the split is for the revenue per se. For FY25, we've seen the consumer share actually just grow very minusculely, just by 7%. And that's something that the company's strategy has been to reduce the share of consumer space. The other 2 segments I want to focus on is, of course, industrial as well as auto. You've seen this has almost a very high growth on a very substantial base as well. And the key reason for that is looking at high margin products. That will, of course, improve the EBITDA as well. And that's one of the key strategies that the company is focusing on. The other 2 verticals, IT, railway, as well as healthcare, we showed you the products currently that it operates in. It has high margins as well. Currently, within the total revenue of about 3,700 odd crores, it's a smaller share, but it's one of the key focus areas for the company. So those are the 5 key segments that the company operates in. We've told you about the products as well, but now it's time to look at the key 8 areas that we spoke about. And let's first start with the income statement. Now, when you look at the company's performance in terms of income statement, that has been very solid at 3,700 odd crores in terms of revenue for FY25. And if you also look at the last 3 years, it's grown at a CAGR of 44%. Now, within the EMS space, a high growth in terms of revenue is something that's not very, it's not very uncommon, so as to say, because it's very high in terms of, scale that they manufacture at. But that's also, a positive for Syrma because they've, held pace in terms of EBITDA margins as well as expansion as well. Currently at 8% EBITDA, the whole overall EBITDA has grown by roughly 33% CAGR. Profits have taken a 33% CAGR growth as well, coming in at 169 crores for FY25. It was almost one of the highest that the company has done since its listing back in 2022. So we've given this a thumbs up based on the growth parameters for the company. Let's now look at the balance sheet as well, and that's something that's key for all EMS players because you need very high working capital for this because the cycle of cash coming back to you, and we look at it in the cash flow as well, is also very elongated. In terms of shareholders' equity, it's roughly about 1,800 odd crores for Syrma. They also have a very minuscule net debt of just 0.2 times when you compare it with the equity portion of the business. So we've given this a thumbs up as well. Apart from that, they've also maintained a very strong cash balance of 295 crores. And it's something that the company has been mentioning because within the EMS space, acquisition is also one of the key strategies to acquire new technologies as well as products. So definitely a higher cash balance will be something to watch out for. But for balance sheet as well, we've given it a thumbs up, low debt, high cash, as well as decent shareholder equity as well. When you look at the cash flow though, the picture is slightly different, and the key reason is the net cash flow. In terms of the cash flow from operations, this is essentially what they generate from doing their business. It has grown steadily over the last 3 years, but we've seen a very substantial jump in FY25. The company just reported its results yesterday, and we'll also be speaking to the management as well. My colleague Harsh has caught up with them. But in terms of 3-year CAGR, the strong growth in terms of cash flow from operation is a positive. What is not positive, and hence we've given this a neutral rating, is the net cash flow. They have been investing heavily in manufacturing facilities, and for EMS players, that's a big expense. The cash flow from financing, which is CFF, that's also taken a knock over the last 3 years, and hence the net cash flow from operations is just about 1 crore rupees, and it's a fall of about 42% CAGR over the last 3 years. The key aspect is also that the company has been changing the product mix, reducing the consumer share as well as increasing the other aspects, but that has required higher investments, and hence the net cash flow number is slightly, it's more than slightly, it's actually a negative, down 42% CAGR. So we've given this a neutral rating, at least for now. They are on the strategy to embark on generating higher free cash flow, and that will be something that will be a key monitorable as well. Those were the 3 key parameters of the financials of the company. Now, let's look at the other key aspects that you need to know. In terms of, the next key aspect for something like a Syrma is, of course, the return ratios. And here is, again, a key negative. In terms of return on equity as well as return on capital employed, the company just has 10.2% in terms of both these metrics for FY25. And while this has been stable over the last 3 years, for players like Dixon as well as Keynes Technologies, their number is almost 30 to 40%. And hence, the business hasn't been generating enough returns for the capital employed that they've been doing over the last few years. While this has been a turnaround strategy for them, it's very, very recently. So these return ratios are expected to just go upwards from these levels. But over the last 3 to 4 years, they maintain a similar level of between 9 to 10%. And when we compare it to the peers, it is a key disappointment. So we've given this a thumbs down for both these return ratios as well. Now, let's look at the shareholding as well. And here it's where it gets interesting. Because while the company's promoters holding has largely remained stable at 46%, we're seeing an increased interest from public as well as retail investors, almost 39% stake. When you compare it with the other peers as well, for something like a Dixon as well as Keynes and Amber Enterprises, their retail holding is roughly between 10 to 20%. So definitely a stock that's in favor of retail investors. And I think the valuation has got to do something with it. We'll look at the valuations in a bit as well, but largely stable promoter holdings, a higher interest from the public investors. And we've also seen the FII data also increase in terms of stake for the company. So hence, we've given this a thumbs up for now. The shareholding largely stable, as we just mentioned. Now, the other key aspect is the street coverage. In terms of the EMS space as a whole, the street cred, essentially, let's look at that first. The street cred has largely been, stable because the company listed back in August of 2022. At that time, the IPO was priced at just about 220 rupees per share. It listed at 262 rupees per share, which was a 19% premium at listing. So that is one of the key ones for investors who've held on. Currently, the share price is roughly between 530 rupees per share. So definitely a 70% return since listing over the last just about 3 years. Definitely a very solid return. The key aspect is we've given this a neutral rating because it's underperformed its peers by a mile. We've seen something like a Dixon Tech that's up 17 times. So that's roughly 1700% over the last 3 to 4 years. While players like Keynes Tech is up 600 to 700% in terms of returns. And when you compare that with 70% of Syrma Enterprises, it's a very big negative in terms of relative. And that's the key reason why it's slightly tricky for EMS companies, because we have to look at the company's performance, but also compare with its peers how they've been doing. Dividend yield largely stable at 0.2 to 0.3%. Again, not much to write home about, and that's largely because the company has a very high investment plan as well. So we've given this a neutral rating for now. The dividend yield isn't expected to go up meaningfully, but the company's performance has to improve to get the returns for its investors as well. Let's now look at the street coverage. Very healthy street coverage for Syrma SGS. 24 analysts is what track the stock as of now, and out of that, 20 have a buy call actually. Let's look at very quickly the street coverage as well. If we can pull that on the screen, that is one key aspect. There are 3 hold ratings for the stock and 1 sell rating. There you go, flashing on your screen right now. So, and that's largely to do with the valuations as well, because it's projecting another 14% upside from here. Very interestingly, we've just seen over the last week, the stock was up 17% before the results came in on Tuesday. So definitely is something that the investors are looking at in terms of growth over the next 2 years. But 20 buy calls for analysts at a valuation. We've seen the last 12 months return also at 33% in terms of returns. So it's been a strong year for Syrma, and analysts also projecting another 14% upside. Finally, in terms of valuation, and here is where it gets interesting as well as slightly tricky as well. Because we've seen players like Dixon Tech, Keynes, as well as Amber Enterprises trading at very, very high valuations over 50 to 80 times. We've seen something like Keynes Tech actually at 97 times price to earnings. And those numbers are very, very stark when you compare it with Syrma at 29 times price to earnings for FY27. Now that largely can be projected because of the growth. The growth has been slower for something like a Syrma, and hence those earnings per share growth hasn't also been coming into it, which is the bottom line for that formula. Essentially, it's something that the company has taken a very structural call on reducing the share of consumers, and that is one of the highest revenue growth verticals as well. So that's one of the key reasons for something like a Syrma. We also had a couple of other players in terms of valuations, PG Electroplast as well as Avalon Tech, both trading at roughly about 42 times and 40 times. There you go. PG Electroplast, large consumer play with air conditioners. For Avalon Tech, they've also been looking at increasing their share in terms of consumers. So the revenue growth is one of the slowest in terms of, for Syrma SGS over the last few years. And that could be something that could continue going forward, but they are looking at increasing their EBITDA share as well. So we've given this, we'll come back to the rating in a bit, but what to watch now is something that I want to talk about. And the key reason is because there has been, we've told you about what's happened in the past, but there's a lot more that you need to know about this company, because the valuations are quite in favor when you compare it with its peers. The company has taken a structural call to reduce the revenue coming from the consumer business, which is the low margin product. That's something that investors have actually liked as well, because they've reduced the consumer share from 40% to 35% in this year. FY25 was 35, FY24 was roughly 40%, and that is expected to go down further to just 30% in the next year. What that will do is increase the EBITDA margins for the company. They are projecting FY26 EBITDA margins to be somewhere around 8%, and that's one of the highest, because something like a Dixon Tech is at 4% margins because they have high consumer share, which is mobile manufacturing. So definitely something that the company has taken a structural call on to have lower contribution in terms of revenue from the consumer verticals as well. Management is still expecting a growth of about 30 to 35% in FY26. That could largely come from the industrial as well as the auto vertical that we spoke about as well. The legacy issue of margin decline has largely reversed over the last 2 quarters. We've seen margin growth after a steady decline over the 5 quarters as well. So we saw 5 quarters of margin decline. The last 2 has seen margin growth. And again, that will be something to watch out for. The company is expecting margin growth going into FY26 as well. So what does it do for our final ratings? Let's look at let's pull that up and look at the ratings now, because we've given this a 6 out of 8. When you look at the income statement as well as the balance sheet, it's a thumbs up. A neutral for cash flows. Return ratios we spoke about as a negative. Shareholding is largely positive because of high public as well as promoter holdings. Street coverage is a big thumbs up as well. 20 analyst buy calls, and valuations very, very much in favor when you look at the company in terms of relative valuation as well. Hence, we've come with a strong rating of 6 out of 8 for the company. It's quite similar actually to what its peers have done, and the company's share in terms of revenue is something as well from the consumer business is something to reduce, so margins will be protected going forward as well. But let's now move on and hear from the management itself. My colleague Harsh earlier spoke to Managing Director J.S. Gujral, who spoke about the company's growth prospects ahead. Listen in to a slice of their conversation.
We achieved a top line of about 3,800 crores this year in FY25. Going forward, I think we would be growing at about 30 or 35% for the next year, and maybe at the same percent or marginally higher or marginally lower percent in 26, 27. So I don't think that matches up to the 6,500 crores you said, but my growth will be about 30, 35%. What we had shared earlier this year, that we are recalibrating our strategy to focus on high margin verticals. And that is essentially the industrial, the healthcare, and the automotive. And I'm very happy to share with all of you that in the current year, we have been able to bring down the low margin consumer business to about 35% of our revenue, which was a target which I had set for ourselves. And the balance 65% is a high margin business. Going forward, we'll try to recalibrate this again and endeavor and bring down the consumer business to below 35% or closer to 30% by the end of this year on a year-on-year basis. Now, if that was to materialize, then I think we are on track to achieving superior EBITDA margins of about 8%.
Point taken. So two pieces here. One is with regard to your top line, expected to be at around 5,000 odd crore. That's a 35% growth in FY26. Maybe another 30% in FY27. So around 6,500 by FY27. For FY26, the understanding that I gather is you're bringing down consumer. Two things. Are you degrowing the revenue on consumer? That's point number one. Point number two, give us the rationale. Is it just margins that you are chasing, and therefore is this a conscious calibration?
You see, we have to calibrate, and it's a very conscious calibration to recalibrate the product mix or the vertical mix of the business. And we would like to sort of concentrate on our core competencies, which are automotive, industrial, and healthcare. And renewed focus on this. These contracts typically take longer gestation period than plain play consumer orders. So going forward, our focus would always be to grow these three verticals, and consumer would continue to grow. We would be a bit more choosy in our selection of consumer business, with the idea that we keep growing at 30 odd% growth with superior EBITDA margins.
Okay. So, sir, give us perspective. What is the margin on the consumer business versus healthcare? If you can give us that perspective.
See, the high volume consumer business is a very thin EBITDA margin business. And I think players which are there in the industry, which are focusing on that, the figures are in public domain. It would be sub 5%, 4%, 6% of EBITDA margins in the high volume, low margin consumer business. In healthcare business, industrial business, these margins tend to go up. Healthcare, because it's my own design product, the margins are very, very superior. And in industrial, they are upwards of 12, 15, 10, 12, 15%, depending on the vertical of where we are supplying within the industry.
Sir, healthcare, I take your point. It's your product and therefore you have a niche. What about industrial? Do you believe that eventually margins could erode there, or what's the likely risk of that?
See, when I internally review my margin profile vertical files, it gives me a big satisfaction that there has been a margin accretion in each of the verticals. We have not seen a degrowth of margin profile in each vertical. Now, as my export business goes up, it will help in sustaining the margin profile. And the reason for a comparatively higher margin in industrial is very simple. It's a low to medium volume, complex boards, high value. So it gives me a lower asset turn, but a higher margin.
Okay, interesting.
And we'll be sustaining the margins. I think as we are growing in size, we get a better clout in our sourcing, strategic sourcing. So I don't see the margins declining in these verticals.
Point taken, sir. So what about IT hardware? Because what we're hearing, what analysts seem to be suggesting is that IT spend may pick up significantly given everything that's happening around tariffs. Give us your perspective, one with regard to the macro setup, and second with regard to where you see the IT hardware business going. And is there any PLI accrual there? Is there any chance of a PLI coming in for you over there going forward as well? Just give us that entire picture.
See, on the IT, we are a recipient of the PLI announced by the Government of India, IT PLI number 2. But that kicks in when you start making the end product with at least motherboards and some other components also being manufactured within your compound or within India. If we were to only assemble the computers or laptops or other thing, the IT PLI does not kick in. We have started assembly of laptop computers with MSI of Taiwan. I think it will be a while, maybe during the year as the passes by, that will be integrate the backward integration of manufacturing motherboards and some other components, piece parts, modules of the laptop, which will make us eligible to claim the PLI.
So how far away are we from that point?
See, currently what we are doing for our customer is the domestic demand, and domestic demand being limited because these are high-end laptops. It does not make economic sense for the customer to manufacture the motherboards in India because the volumes are currently small. This was started off about 4 months ago, and the lines having stabilized, I think there's a very good chance that in the coming year, I may get integrated to his global supply chain. And once that happens, then the probability of doing the backward integration of motherboards and some other modules in India, in our factory, is reasonably high. And I think that's the time when the PLI will kick in. But I think we'll have clarity about a quarter or maybe 4 or 5 months from now.
Okay, so I've covered a few of the segments. Let me look at one forward-looking segment that you were considering, OSAT. Where are we with regard to that business? Are you going to actively look at it?
OSAT, our sort of contention and our rationale has been very, very clear right from day one. It's a decent segment, separate segment, thin margins, deep pockets. But we would go in it only if we have a credible technology partner and where I can stuff his global supply chains. Production has its own challenges, but it's not rocket science. The critical key is that whatever we produce in the factories, where do we sell it? So if there's a credible partner and I can stuff his global supply chains, the options are still on the table, but we have not been able to tie up or find a global, what you call partner. And end of the day, if you see only Renesas has come into India apart from Micron. There are no other players like NXP, ST, TI, onsemi, and other people. None of them have so far decided to put shop in India. Once it crystallizes, then we'll share it with the market. But currently, there is nothing concrete on the table.
So can I, sir, assume that this is for the moment unlikely? It's on a back burner at this point.
Even if a decision is taken before the revenues kick in, it will be a year to 2 years from the day we start. So yes, currently it's just under the negotiation and scouting stage. Nothing concrete on the table.
Well, that was the management of Syrma SGS. They are looking to, of course, looking at the OSAT vertical, something very difficult for all Indian players, but largely the industrial, the automotive, as well as the healthcare, these three verticals is what the management highlighted. We've given it a KYC rating of 6 out of 8 for this particular company. But that's all the time we have on this edition of Know Your Company. Thanks so much for joining in, and we'll see you tomorrow.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome to Markets at 12. I'm Mahima Vachrajani. With me is Varsha. Before we move on to an interesting line of conversations that are lined up for you today, let's take a quick look as to how the markets are panning at present. Well, there's some amount of profit bookings seen in the benchmarks. The Nifty 50 is down by about 0.2 odd percent. But the momentum in the broader markets has continued. The mid-cap 150 up by about 0.2 odd percent. The small-cap 250 up by about 0.6 odd percent. Although the momentum is not as good as what it was yesterday, but the momentum still continues in the broader markets. Let's take a look at the Nifty 50 heat map and see what counters are buzzing today. On the losing side, we have stocks like Power Grid, NTPC, IndusInd Bank, Cipla, Infosys seeing loss of about 1 odd percent. But on the good side, the stocks that are buzzing positively, you have something like a Hero Moto, which is up 4.5 odd percent. There's JSW Steel up 2.7 odd percent. Tata Motors doing well in trade today, up 2%. Shriram Finance, Adani Enterprises, Adani Ports, all doing well in trade today. In terms of the sectoral heat map, let's pull up that and see what sectors are buzzing in trade today. There you go. Nifty IT is the top loser amongst all the sectors. It's down by about 0.6 odd percent, followed by PSU Bank, which is down by about 0.5 odd percent. Nifty Pharma also feeling some heat, down by about 0.4 odd percent. Nifty Bank also languishing by about 0.3 odd percent. But Nifty Defence clearly stealing the show yet again today, up by about 2 odd percent. Nifty Metal seeing gains of 1 odd percent, followed by Nifty Media, Nifty Auto, as well as Nifty Realty doing well in trade today. Let's in fact pull up the counters on Nifty Defence and see what are the counters that are really doing well in trade today in terms of Nifty Defence. There you go. All counters in the green. There's Astra Micro, which is up 10%. Garden Reach up 5%. Cochin Shipyard also up 5%. Zentech, Paris Defence, Mazagon, Data Patterns, MTR Tech, all seeing gains between the range of 2 to 5 odd percent. Let's also pull up the BSE 500 and see what counters are how these counters are faring in trade today. Gains are led by Apar Industries, up by 12 odd percent. E-Clerk Service up by about 8 odd percent. Triveni Turbine, Cochin Shipyard, Kajaria Ceramics, some counters doing well in trade today, but some counters under pressure. Muthoot Finance, the reason is of course earnings and the fact that the overall loan growth has taken place because of higher gold prices, but overall customer growth has been only 2 odd percent, followed by Hitachi Energy down by about 5 odd percent. Piramal Pharma also seeing some kind of pressure in trade today, down by about 4 odd percent. But the stock in focus today is Ixigo. The company came out with its earnings yesterday, and in terms of the overall numbers, it was a great quarter yet again for the company. Overall revenue was up 17 odd percent, EBITDA up 16 odd percent, margins have remained stable, and net profit was up 7 odd percent. The stock is seeing good moves, up by about 4 odd percent. To discuss as to how the quarter has gone by and how things are shaping up for the counter, we are joined by Alok Bajpai, Group CEO of Ixigo, joining us now. Alok, welcome to NDTV Profit. Always a pleasure speaking with you. My first question to you is as to how things have fared out for Ixigo overall in FY25 and the kind of momentum that you have seen. Do you think that this is sustainable going ahead in FY26 as well?
Well, you have to see where this momentum is coming from, right? Like if you look at Ixigo's journey, right, we started out by focusing on the next billion users, which is essentially people coming from tier 2, 3 towns or the aspiring middle class of India, where rail and bus are very strong use cases. And we are seeing a trend of premiumization of people moving from taking a bus or a rail to actually taking a flight. So if you look at our growth, large part of it for last quarter came from, how our flight and bus business have grown on the revenue line. Flight business has grown at about 135%. Bus has grown at about 103% year on year. And I think the acceleration just shows the power of, the travel demand in the country coming from the middle class. And I think this trend is quite secular. So if you think about our GTV growth, it's been in the 40s on an annual basis. And I think, what we'll do is try to maintain that GTV growth in the 40s going forward.
All right, and speaking of which, Alok, the overall GTV was directly attributable to Mahakumbh as well, because that is something that has played out well in this quarter. But despite that, your GTV has grown around 50% if you remove that Mahakumbh growth. Just wanted to understand that for the next 2 quarters, let's say, where do you think the growth that this particular quarter has seen will be coming from? What are the events that you're looking forward to, and what will be the levers that will probably augur the top line?
Well, as you rightly said, right, like Mahakumbh is just a small contributor to Q4. In that sense, it was just single-digit percentage of GTV. And I think the underlying growth, if you look at our MAU growth or if you look at our monthly transacting user growth, I think that's a better proxy of how the underlying growth in the business looks like. What we are confident of is that we are on this trajectory where there's a large unmonetized user base that's very sticky with us already, and we just need to convert more and more of these customers into buying tickets with us, as well as buying value-added services such as travel guarantee, which we launched recently, which allows you to get if you don't have a confirmed seat, we upgrade you into bus or flight at a discount, and you could even buy the next train ticket at a discount if your waitlist doesn't confirm. And I think those kind of products have really expanded the TAM for us. So we will continue going down that path of using technology and AI for TAM expansion of our existing user base and try to grow our monthly transacting users over the next few quarters. Like I said, I think sustaining a GTV growth in the 40s will be something that we aspire towards, right? Which again will be way faster than the overall market.
Alok, in terms of the travel guarantee feature that you mentioned, especially the 3x travel guarantee, just wanted to understand, because there are two sides of the same coin, right? One, of course, that is getting in a lot of traffic to Ixigo app because it's a very good feature. But do you also think that, if tickets don't get confirmed, it's a big, amount that will hit your PNL at some point of time? Just wanted to get a sense there as to how this feature is working out well for you.
Yeah. No, I think if you think about it, right, there's a large cohort of waitlisted train ticket customers every single day, which actually do not confirm on the last day, right? And if you're someone traveling for a purpose which you can't, sort of defer for too long, then you will have to book an alternate mode of transport to get to that place, either another train the next day or a flight or a bus. And I think what this product does is essentially allows all the users to share that risk, right? In terms of saying, okay, I can pay a little bit more, and if the probability of confirmation is above a certain percentage, we show this product, right? So if there is, we are in a way saying that, look, if we are saying there's a high chance of confirmation, we are putting our money where the mouth is, because our algorithms are quite sort of primed for predicting that, right? And then if it actually does not confirm, we will give you the money. So it's a profitable product in that sense. The margin may be a shade lower than our overall train ticketing margin, which is why you see some slight margin compression on the train side of the business. But it's a product that is already sort of making money.
We also have Rajneesh Kumar, Group Co-CEO of Ixigo, joining us now. Rajneesh, a very good afternoon to you. I wanted your sense on how things are panning out from a competition perspective, because, for sure, train segment is something that you've aced, and, I don't see a tough competitor in terms of trains booking for Ixigo as of now. But in terms of bus segment as well as flight segments, you have a lot of players in the unlisted space, as well as are more established and have established their business before you did. Just wanted to get your sense of competition there, and what are the strategies in place to kind of overcome that?
Yeah, sure. I mean, even for trains, I would not say that we are complacent, and because we have got 58% market share, we'll just not do anything about it. Like, we continue to innovate there as well. So our playbook remains the same. Like, we always have this approach of being extremely customer centric in whatever we do. So we keep finding those core customer problems. We keep listening to our customers intently. We always have our ears to the ground. And once we find those problems, it's not about really solving a problem. It's mostly about solving the right problem at the right time. And it's also about having the courage and vision to solve those problems. Sometimes these problems that we solve for customers, they don't have any immediate revenue or margin upside that we see, but we still go ahead and do that as a longer term investment because that creates more customer stickiness, word of mouth, and then that is what helps us grow. So we really don't look at competition to see what we really want to do in the future. We rather look at customers and their problems and try to solve them. If you look at any of our products, see, the biggest problem that I see mostly in the OTA ecosystem, and this is global problem, is that most OTAs, they feel that the finish line is selling a ticket to the customer, whereas it's just the beginning of your journey with the customer, right? Because as soon as you book your flight ticket on Ixigo, you will see that you will you'll automatically start getting enrolled for automated trip management. And as soon as, your boarding pass is ready, you will see your boarding pass prepared and it will get pushed inside your Apple wallet if you use Apple, or Google wallet if you use Google. Go to your WhatsApp. As soon as, it's time to head to the airport, you'll start seeing, notifications for which terminal to head to, which check-in counter to go to, what boarding gate your flight is departing, what kind of delays your flight has, or even track your flight completely offline inside the flight. And then, when you reach the destination, you'll also know what kind of which baggage belt your baggage will arrive on. So we spend a lot of this time and resources to build these unique products and services which have nothing to do with the booking experience, but more about, the overall experience that the customer has. And this is the reason why we are able to consistently, innovate and grow organically without spending too much money on customer acquisition. The other reason why these sectors continue to grow for us is also because we have a large captive user base of 83 million monthly active users, and we have created an integrated ecosystem where we are able to now very seamlessly integrate these cross-sell or upsell products, whether it is flights, buses, or hotels, into the trains journey as well, inside our app ecosystem, and even food lately, or even advertising for that matter. And this is the reason why we are able to constantly, improve monetization from this large user base.
Got it. And Rajnish, any new product offerings that you're looking at to launch in FY26?
I can't make any forward-looking statements about what we are launching. All I can tell you is that we focus a lot on these value-added services that we have built over time. So as you can see, we built price log, travel guarantee in FY25. So expect to see more such value-added services coming from our side. And all of this will obviously be powered by data and AI. So as you can see, most of these products, the pricing of these products, the personalization of these products is completely powered by AI. So there's not a single human being involved in how we price these products and manage these products, right? And these products are optimized to optimize our P&L. So it keeps on improving as time progresses. As we keep doing more and more bookings, these products keep on becoming better and better with more data.
And Alok, your quick view. I know I understand that you refrain from giving any forward-looking statements, but in terms of how the company has grown, 3 years compounded sales CAGR has been around 34%. PAT growth has been around 66%. FY25, overall revenue has crossed beyond that 900 crore mark. Just wanted to get your sense, in terms of how FY26 is shaping up. Will this kind of CAGR growth continue? Will it sustain, or will you be outpacing what you've already done earlier?
Well, so I'll give you a long answer and a short answer for it, but let's start with the short answer, right? If you look at our track record, right, we've been able to grow over the last 6 years. If you compare to pre-COVID versus where we are in FY25, I mean, more than 900 crores of revenue, like you said, and earlier it was 40 crores pre-COVID. So we've grown kind of 23 times of our pre-COVID scale. I'm not sure if any OTA in the world has actually done that. But the reason why we did it was a lot of the things that Rajnish was talking about, which is worrying a lot about the smallest of pain areas of customers and building products that may not monetize in the short term, but may monetize a lot in the long term. And I think that's the same playbook we'll continue applying for growth. All I can say is that FY25 growth has actually accelerated over FY24 growth. And we would like to continue thinking of ourselves that way. And the way that will happen is that as certain products mature and their growth slow down, there'll be new products that come in and sort of take their place in terms of driving that growth.
Rajesh, one last quick question to you, and I understand if you don't want to comment on this. Your view as to how things might impact Ixigo going ahead because of the entire tension between India and Turkey and Azerbaijan. It's completely your stance to not comment on this, but just wanted to get a sense, an outlook, not from a business perspective, but for an outlook, because cancellations might be taking place. Do you think that this might structurally impact the overall, companies that are working in the tourism space?
For us, the biggest priority was customers and their safety when this happened. And so we were looking at, in fact, we were more worried about the calls, the barrage of calls that we are getting about, rescheduling and cancellations, etc. So we took a call. We, created AI-enabled voice agents in order to solve those problems and to scale up our operations so that we could service all our customers. We started refunding them instantly, etc. The call to obviously, not support certain countries from a travel standpoint was, obviously as a gesture to the nation and the feedback that we got from our customers, but also because of the safety of these passengers who would potentially be traveling to these areas which were impacted by this conflict. So, the impact on business as such was not that big a decision-making criteria for us, to be honest. We were more worried about the disruption it was causing for the customers, and we were taking actions to kind of support that.
Thank you for answering that, Rajesh. And Alok, one last quick question on the margins. Margins are at the highest level at present. Do you think that this is the sustainable range of margins, or do you see a further improvement?
If you're referring to our EBITDA margins, our adjusted EBITDA is now in double-digit percentage. We would love to maintain it that way and potentially grow it with some operating leverage over time. But we are not, like we had said even in the last quarter, we are not in a hurry to sort of, take that operating leverage to the bottom line. We would rather use some of it for growth, which is why you see marginal improvement, year on year. But we would love to continue driving growth at the levels that we talked about. So we would love for GTV growth to be continuing in the 40s year on year, right? And for doing that, whether it's through growth in other areas, new areas such as hotels or food delivery on trains, or just by converting more people to book their flight. I mean, one of the statistics I want to share with you is that half of the new bookers that come through our NBU apps or the train and bus apps, essentially are first-time flyers, right? So we run surveys for these things, and we've discovered that there's a large new-to-market customer that we're creating. And, I think it's a once-in-a-lifetime opportunity to, over the next 10 years, to bring a very large cohort of customers online to book the first flight of their life. And we are leading that change in that perspective. So I think that's the more exciting opportunity for us. But of course, not at the cost of margins. We would love to maintain these margins and grow them wherever we can.
Alok and Rajesh, thank you so much for answering those questions so candidly, and thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you.
Thank you so much. All right, with that, let's shift focus to Sagility India. This company also came out with its earnings in terms of how quarter has fared, where revenue and EBITDA were in line with what the street was expecting. Revenue growth was fueled by acquisitions of Broadpath in Q4. Overall revenue was up almost 8%. EBITDA was down 5%. Margins have taken a hit. But to discuss as to how things are faring for the company, we're joined by Mr. Srinivasan, Group CFO of Sagility India, joining us now. Mr. Srinivasan, a very good afternoon to you, and thank you so much for joining us. Your sense of how the quarter has gone by and how things have shaped up?
Welcome all viewers. Thanks for asking that question. Our revenue has grown 22% year on year in Q4 compared to the last year, and at about 17.7% at a constant currency. And our EBITDA has been at 25.8%, which represents a 28.6% year on year growth for the Q4. When it comes to the full year, we have actually grown about 17.2% over the previous year. And our adjusted EBITDA margins has been at 26.4%, which again represents 28.4%. So a solid growth overall, and not too sure why I was hearing you say lower single digits in terms of revenue growth.
Mr. Srinivasan, Varsha this side, actually Mahima was referring the growth numbers quarter on quarter. Well, on that, if I were to talk about your margin picture, margin came off quarter on quarter. Now, I understand this is because of the BroadPath acquisition that you have done. When can you expect a bounce back when it comes to margins?
Okay, let me clarify. Like we have mentioned in the past, our business has got seasonality. Our second half of the year is more pronounced in terms of revenues compared to the first half of the year. And when it comes to the margins for Q4 versus Q3, Q3 was an exceptional quarter where we had the benefits of some one-time revenues from the open enrollment season in the US, and which continued in Q4 as well. Q4 has been good. With the acquisition of BroadPath, which is predominantly an onshore base. So hence the business mix has slightly changed for fueling our growth. And yes, I do understand because of that, our margins have slightly dipped. It's also a factor of how the exchange rate had played between December to March. And peso had strengthened compared to December. So that had actually resulted in some exchange losses. So, but for that, our business has been stable, and we are very confident that we will continue to grow between low teens to mid teens in operations, in our regular organic operations. And with BroadPath coming on top, our revenues for the next fiscal is likely to be around close to 20% year on year. And our margins, as we said, has always been stable between 23 to 25%. So we will continue to hold our EBITDA margins between 23-25%.
EBITDA margin expected between 22 to 25%. Got that view. Also, just wanted to understand how much revenue has come from your BroadPath acquisition when it comes to Q4 FY25.
With respect to BroadPath revenues, it would be close to $9 million, roughly. And BroadPath also has a lot of seasonality in their business. Their Q3 being their highest, where they help the customers to source more revenues. So it is pretty much in line with what we had expected. It has significant seasonality. So over the year, it will pan out, and you would actually notice a big jump in our H2 this year. So that is what we are anticipating.
Okay, Mr. Srinivasan, I'm just stretching this margin point because I understand, and please correct me if I'm wrong, the BroadPath margin is little bit less when compared to Sagility as a whole. So are you expecting this drop down in margin in Q1 FY26 as well?
No, see, you have to understand the way how the business operates, and we deliver out of US, Jamaica, Philippines, and India. And any business delivered out of India is going to have a higher margin, but then followed by the Philippines and Jamaica and onshore US. So it's the business mix where we deliver from significantly determines our weighted average margin that we will be delivering for the year. BroadPath, all of the revenues and delivery happens out of the US, which probably has got the lower margin percentage. So from a weighted average perspective, the margins will stay like this. But we are working on integrating it. It should be understood that we are working on trying to cross-sell and get the benefit of the mid-market segment that we have got, mid-market clients that we have got through BroadPath, and trying to cross-sell that. And if there are opportunities, then we will try and push the margins up. But we are comfortable holding our margins between 24-25%.
Understood. And also the top 10 clients contribute to almost 90% to the overall business. Are there any plans to bring down this number considering the BroadPath acquisition?
To an extent, yes. But you should also understand we are heavily payer focused. And in our payer focused business, the market itself is concentrated. The top 18 guys in the US healthcare payer markets contribute to close to 65 to 70% of they have the market share. So the market itself is so fragmented, and we have almost 6 of the top 10 clients as 6 of the top 10 players as our clients. So, and the focus is fairly there. But we still, the best part to note here is the top 3 have actually grown over 11% year on year. And the top 4 to 10 has grown more than 16% year on year. So we don't see any slowness or a risk from a revenue concentration perspective, which is what I keep reiterating. There's it shouldn't be seen that way. It's a reflection of the market, and hence our revenues are also staying the same.
Okay, got that too. Also, there was a concern, analyst concern that there are some medical costs continuing to go up. How this will impact your business in a positive way or negative way?
Medical costs going up is a known phenomena in the US market for the last few years. And our revenue is not a function of a cost, or unlike the TPAs in India, we don't get a percentage of the premium as our revenue. So we do not see that as a direct revenue model, but indirectly, yes, the clients are under significant cost pressures. It gives us a lot more opportunity for the clients to outsource more and look at providers like us. So we shouldn't be really saying this, but we are happy. We are not happy, nor we are unhappy, because this do not affect us in the short run or even in the medium term. Yes, it gives us an opportunity to get extra business when our clients are under cost pressures, but it's a favorable thing for us, is what I would say.
Also, Mr. Srinivasan, my last question to you would be, what do you think would be the key growth drivers, for next 2 to 3 years when it comes to Sagility?
Yeah, penetration into the mid-market segment. That's one of the prime reasons as to why we acquired BroadPath. And BroadPath has got 30 plus clients in the mid-market segment, where we as an organization have not got an opportunity to mine that. So now there are positive signs post-integration. We are actively working with the clients to penetrate and sell more through the mid-market. So that way, to answer your earlier question on reduction in the concentration between our top clients also will be addressed. So our growth strategy is to invest in technology, which we have been continuously doing, build more AI tools that can help improve our productivity, improve margins, and as well as grow actively in the space.
Right. Thank you, Mr. Srinivasan, for answering the question, and all the best.
Thank you so much.
Viewers, this is all we have on this edition of Top 12. Stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research,
shines a light on the biggest.
Hello and welcome to Profit Buzzers. A very good afternoon to all the viewers. This is Hiral Dadia. Let's quickly take a look at how markets are panning at this hour. Clearly, if you see in terms of Nifty 50, pretty much on the borderline, a 20 points cut is what you're watching out for currently. From the day's highs, it has actually corrected as well. We hit a high of 24,800 already in trade today. Let's pull up Bank Nifty, and after that, we'll see the sectoral heat map as to what's happening on that front. Bank Nifty is again seeing a volatile day of trade, 0.3% lower on that front. And if you see in terms of the PSU Bank Index, let's quickly pull up that one on the screens and see what the PSU banking space is doing, because yesterday there was a divergent trend between the PSU banks as well as the private sector banks. There you go, underperformance coming in from the PSU banking space as well in today's session. If we can have the sectoral heat map and then Nifty 50 components. In terms of the sectoral heat map as well, the media and the real estate space are seeing some smart gains. Metals is also up 0.9%. But let's understand what is putting pressure. You have IT, which is down almost 0.5% in trade. Pharma trading under pressure as well. Apart from that, energy, healthcare, consumer durables, FMCG, all of them are on a weak footing. If you talk about the Nifty 50 components as well, either we can get individual stocks or the contributors. Tata Motors, Hero Motor, JSW Steel, Shriram Finance are the ones which are giving the markets a push. But what's pulling it lower is Infosys, Kotak Mahindra Bank, Bharti Airtel, Reliance Industries. These are a few of the names which have been impacting as well. Let's quickly pull up the BSE Midcap and the Small Cap Index as well and see what that part of the trade are doing. Clearly outperforming the benchmark indices. You have Midcap 150, which is seeing gains of around 0.2%. And if you have to look at the Small Cap 250 as well, which is up almost 0.6%. Let's look at some of the individual names in terms of the broader markets, which are actually shining through. If you have to look at few of the names, let's put up an Apar Industries, a 12% up move coming in there. Kirloskar Engineering on the back of earnings is up in trade. Tilaknagar Industries is reacting to numbers, seeing gains of around 11%. E-Clarks is also up in trade. Astra Micro is another one. Muthoot Finance, the cuts have deepened. NIT trading under pressure. Power India, Newland Lab, Lloyds Engineering, these are few of the losers in terms of today's session. But let's also welcome in Dinesh Sani, Senior Research Analyst at Invest4Edu. Dinesh, good afternoon and welcome to the show, and a pleasure to speak to you at NDTV Profit. This is Hiral on this side. A quick view in terms of your read of the markets currently, taking into consideration a pretty flattish day of trade so far.
Hi, thank you for having me on the show. Yeah, so market actually, after what we saw over the global market scenario, so we saw in last 2 days, market is rallying up. But based on some overall sentiments, I think we are seeing some profit booking at this right now. So overall, my view for maybe for medium to long term is very positive. But this is just a profit booking which I can see as of now.
Moving on, Tilaknagar Industries is in focus. The company witnessed strong growth in Q4 earnings. Mahima joins us with more on the growth levers and guidance from the company.
Right. So in terms of Tilaknagar, it's been a strong quarter and overall a strong growth, and we are seeing those strong moves in the stock as well. It was a high value as well as volume-led growth. Of course, a stronger volume-led growth for the counter. Strong market share gains across key states was seen by the counter. This has been the highest ever quarterly volume since FY15 for Tilaknagar. And Q4, in terms of the overall performance, 9 months FY25 had been subdued, but Q4 is back to industry-beating growth for Tilaknagar. In terms of the numbers, revenue is up 14%, EBITDA up 63%, margins improved from 6.2 to normative range of around 8 to 9 odd percent. Profits up 2x, and of course there was an exceptional item which increased by 62%, but adjusted PAT was also up by 95%. In terms of operational metrics, volume growth was at 20%, led by a growth of Andhra Pradesh at 30 odd percent. The company is now back to strong growth trajectory. In terms of guidance, it intends to launch a luxury whiskey brand in first half of FY26. They are targeting brandy contribution to drop from 91% now to 80% by 2030. They may see some competitive intensity in their whiskey portfolio due to the entire UK FTA agreement, and they have a pathway towards increasing the overall stake in Samsara Gin as well. And lastly, margin range right now for them will be between 15.5 to 17. This is their gross margins by FY26. So this is the overall view as to how things have panned out for Tilaknagar in Q4, and absolutely a stunning quarter.
Right. Thank you, Mahima, for all the details. Dinesh, strong growth is expected in this counter. How are you viewing this? Do you track this?
Sure. So definitely the overall view, as you rightly mentioned, was very strong. And what can I see is that there are some triggers which can happen. So for example, as it is rightly mentioned that premiumization trend is very strong. So people are preferring rather than drink more, they are drinking less, but they are drinking better. Right. So premium brands are rightly in focus as of now. So what I can see is this trend will be more coming down the line. And one of the other reasons I can see is at home consumption is very strong. So usually what is happening these days is Gen Z and of course Gen Y is drinking alcohols, non-alcohol beverages. But this trend at home consumption is very strong these days. So this one of the triggers I can see, which is taking all these premiumization trend, plus 1.5 to 2 crores of people are ready to enter in the legal age. So overall, what can I see is that there is a strong up move for the counter. One can definitely hold for near to medium term.
Regards to Tilaknagar Industries, and it's going to be interesting taking into consideration, how your domestic players probably could be impacted as well on the back of the India-UK FTA, because there could be cheaper alcohol that could be imported in the form of Scotch whiskey. I don't know if wine is considered there, but Scotch whiskey was for sure. So interesting moves that could be coming in going ahead as well. But Jubilant Foodworks is another one that is in focus in today's session as well. In fact, Mahima, Jubilant and Westlife, both of them reported numbers in terms of today's session. We are picking up a Jubilant, but I'm sure you would have looked at a Westlife as well. What is the key trend that you're picking up in terms of the numbers, and what is it telling you with regards to the consumption story?
Absolutely. So with regards to both of these counters, Jubilant clearly is an outlier here, because in the past 2 quarters, the way demand has picked up for the counter, it's quite significant. Westlife this quarter has done fairly decent as compared to how it fared last quarter. Some losses have recovered there, and overall there has been a revenue growth also seen in Westlife. But for Jubilant, it's delivered better and it's performed much better than their peers. They have also seen market share gain. There's been a strong margin outlook as well. In terms of the overall numbers, revenue was up almost 34%, EBITDA up 25 odd percent. Margins stood at 18.5 and adjusted net profit was up 30 odd percent. In terms of operational metrics, this was an interesting one because it saw a like-for-like growth of 12%, a double-digit like-for-like growth 2 quarters straight for Jubilant Foodworks, and order growth overall was at 25 odd percent. In terms of delivery, the like-for-like growth stood at 22% on the back of a lower base as well, but delivery has been outperforming for Jubilant Foodworks. So their 20-minute delivery and free delivery initiatives has worked well for the counter. And order growth for the delivery space was at 32%. In terms of call takeaways, average ticket size has started to go up again. Despite of increase in delivery mix, margins have remained stable. 20-minute delivery is a structural change now, is something that the management has acknowledged, and there is no going back from here, and that has allowed market share gains as well. Discounting has come down a tad bit, and repeat rate has started to inch up for the counter, again on the back of delivery sales going up. In terms of commentary on DP Eurasia, which has presence in Turkey, Azerbaijan as well as Georgia, that contributes almost 23% to their overall top line and 27% to their overall EBITDA. Jubilant Foodworks has overall invested around 1440 odd crores in DP Eurasia in two different parts, and according to the management, this business is cash as well as profit accretive. In terms of the guidance given by the management, FY26, they plan to open 250 odd stores for Domino's and 60 odd stores for Popeye, and they expect to improve margin at least by 200 basis points in the next 2 to 3 odd years. So overall, a good quarter and a strong margin guidance is something that's a key takeaway from Jubilant's Q4 earnings.
Right, so that's with regards to Jubilant. Dinesh, very quickly, your view in terms of the consumption story, if you have to look at Jubilant as well as Westlife.
All right, so very strongly what I can see is that Indian business is very strong. This is very clear. And it is also expected to grow, and the management commentary on that domestic front is very positive. And these guys are very aggressively opening their stores. That means there is a clear-cut demand is showing in the domestic market. But one uncertainties remain is for the Turkey business, which is rightly mentioned that almost 23-24% of overall total sales is coming from the Turkey business. So there are some medium to near term hiccups can be there for 1 to 2 quarters. In terms of valuation wise, I think it is trading fully based on FY27 numbers. So what can I say is that if investors want to jump into the stock, they can wait for 1 to 2 quarters more before jumping into the stock.
That. Well, Bazaar Style is in focus. The stock is tanking in trade today despite posting a strong Q4. The company reports strong same-store sales growth. Mahima brings in more details.
Right. So I think what the street is not liking about Bazaar Style is that net losses have remained at the same levels as they were in Q4 FY24 at around 6 odd crores for Bazaar Style. But overall, in terms of growth, in terms of same-store sales growth, also it's been a good quarter for Bazaar Style, mainly because it has more rural penetration and rural demand is picking up. In terms of growth of private label contribution also, that has gone up. Focus brand building is also auguring growth for the company. Revenue is up 54%, EBITDA up 69%. Margins have also improved at 11.6 versus that of 10.5%. In terms of key operational metrics, same-store sales growth was up 20%. Private label share went up to 47% versus that of 42% earlier. Sales per square feet has also gone up by 19%. And number of bills also went up by 58%. In terms of store additions, it has added 15 odd stores this quarter, and the company has also overall added 52 stores in FY25 versus that of only 27 stores in FY24. So overall, I think what is leading to that loss or putting pressure in terms of profitability is that company has aggressively done store expansion. The stores have doubled this year, and because of that, costs have gone up in terms of depreciation, and which is why profitability has been overall under pressure.
But with this, Mahima, one thing I want to talk to you about is the other companies, from a V-Mart to a V2 Retail. The day the numbers came in, the reaction on all these counters was spectacular. I think this is one of the only companies which has seen a negative reaction in terms of the performance. Is there a chance where this is not setting the trend right?
Maybe it's because they've not been able to manage the kind of costs versus the store expansion that is taking place, because even V2 Retail and V-Mart Retail have been aggressive when it comes to store expansion, but they've been able to manage their costs as well, and which is why we've seen a significant uptick in both of their stocks while their business updates came in. So I think this is the one factor where Bazaar Retail is lagging, and that is why probably the stock is under pressure today.
Dinesh, coming to you on this counter, good same-store sales growth, good uptick when it comes to private label, but still stock is down. is market baking in everything, and that's the reason we are seeing, investors are, profit booking?
See, one clear-cut reason which I can see is debt to equity ratio. Because if I'll see based on the numbers, debt is very high, and compared to last year, the debt has also increased. So on operating front, if I'll talk about margins, was almost 11.6% in this quarter compared to last year's 10.6%, almost 1% increase. But if I talk about the profit before tax, right? So that was in loss. Why? Because almost majority of the expenses was gone up in terms of interest, right? So that particularly hit the overall bottom line as well. So one clear-cut reason I think I can see is debt to equity ratio. It's almost 2.5 times. And if you compare with the other companies, I think they are managing well. I think this company is not able to manage well, as rightly mentioned. So this is one of the good reasons. Also, in terms of valuation, I think based on a TTM basis, I think it is trading at more than 100 times. So based on these two factors, I think market is not, participants are not very happy in terms of that. So hence we can see the pressure on that.
Let's move to another pack from the consumption side. Again, is what we're talking about is paint companies. We already have Asian Paints, which has reported numbers, AkzoNobel, as well as a Berger. You have Birla Opus, which is not being considered right now because Grasim numbers are yet not out. I think 22nd May is when they will report numbers. But taking these three companies into consideration, Mahima is yet with us to tell us in terms of how has the sector been with these three companies and what a Birla Opus would also probably mean. Mahima, over to you.
Right. So, as you rightly mentioned, three main painting companies have come out with their earnings. That is Asian Paints, your Berger Paints, and AkzoNobel. In terms of how Q4 has fared for these companies, Asian Paints missed the estimates in terms of revenue as well as PAT growth. Berger Paints was a complete beat in terms of revenue, PAT, as well as EBITDA growth. And in terms of AkzoNobel, the numbers were largely in line with respect to what the street was expecting. Now, in terms of how the financials performed exactly, in terms of Asian Paints, there was a revenue degrowth of 4% and PAT was almost down 45% for the counter. For Berger Paints, revenue was up almost 7% and the overall PAT growth was at 18%. AkzoNobel, the revenue growth was at 9% and the overall PAT growth was flat for this particular quarter. In terms of the operational metrics, in terms of how volume and value growth fared, Asian Paints value growth stood at around 1.4% and volume growth was at 2%. But Berger Paints is an outlier here completely because Berger Paints saw a growth of 7.4% in terms of its volume growth and overall value growth also stood at around 4.4%. So they've been able to grow both in terms of value as well as volume. Plus the company has also added 1,000 plus retail touch points, which have kind of augured the growth in terms of volume for Berger Paints. Now, in terms of commentary for demand coming in from all of these companies, Asian Paints has taken a cautious stance and has said that demand to remain subdued in first half of FY26. Second half of FY26, they'll be seeing demand recovery. For Berger Paints, they've said that demand to improve in FY26 from first quarter itself. So even in terms of demand commentary, positive commentary coming in from Berger Paints, but a cautious approach taken by Asian Paints. In terms of market share, Asian Paints has acknowledged the fact that it has been losing market share on the back of high competition, not just from newer entrants, but also from already established players, and higher urban penetration is one of the reasons as to why Asian Paints is seeing a lot of pressure, because Asian Paints has more touch points in tier 1 cities and urban demand is under pressure. In terms of Berger Paints, it did witness market share gain. Berger Paints market share has gone from 18% in FY22 to almost 20%, more than 20% in FY25. So a good growth in terms of market share there. For AkzoNobel, market share has fairly remained stable. A slight market share growth has taken place as per the management. Lastly, in terms of common takeaways as to how paint companies are giving out commentary in terms of FY26, competition to tighten further in FY26 with new entrants like Birla Opus as well as JSW Paints. In terms of automotive segment growth, that might be ahead of decorative paints if discretionary spending does not pick up. In terms of the gap between volume versus value growth, that will narrow going ahead in FY26. And lastly, tax cuts, rate cut as well as 8th pay commission will improve demand both in rural as well as urban areas. In terms of the overall valuations as to where these companies stand, well, paint companies have never been cheaper. Asian Paints stands at 60 times right now, which has come off quite a bit, but 60 times still expensive right now. It's expected to go around 44 times by 2027 as per Bloomberg estimates. Berger Paints slightly lower than that of Asian Paints in terms of 12 months trailing PE at 54 times to go around to around 46 times in 2027, and AkzoNobel cheapest amongst the three but still expensive at 37 times. Lastly, in terms of what analysts are recommending in terms of these paint companies, Asian Paints we have around 22 sells, 10 hold and 6 buys. For Berger Paints there are 8 buys, 4 hold and 11 sells. In AkzoNobel, not a lot of analysts track this particular counter, but there is 1 buy and 1 hold for AkzoNobel. So this is the overall view as to how paint companies have fared in terms of their Q4 performance.
Right, thank you so much for getting us the comparative. Dinesh, your view and where do your bets lie if you have to consider the 3 companies and take into consideration a Birla Opus as well?
Right, so clearly, I think Asian Paints is lagging behind. If I talk about first Q3 numbers, that is December quarter, I think they have not done very well in terms of margin as well. So 23% was in December 24, December 23, and almost 19%. So on margin front, they're also lagging. But this quarter, I think even in terms of, if I talk about, we mentioned year-on-year numbers. Even if I talk about the quarter-on-quarter numbers, we have not seen a growth in terms of quarter-on-quarter, right? So first, after Q3, this counter has hit very hard. So based on weak H2 of FY25 numbers, and as I rightly mentioned, H1 of FY26, management is not seeing a strong growth, particularly for Asian Paints. Right, so one whole year, if we see, the demand is not there. Plus, I think there was a news which is not cleared as well, that Reliance is considering a 5% stake selling into the company. So because of this, the overall sentiments are weak for this counter. So if one wants to invest in this counter, I think they can wait for now, because there are developments happening in terms of competition, specifically Birla Opus, and now the Berger Paints is upping up the game now. So one can wait clearly for 1 to 2 quarters, and even if they want to invest, I think they should consider rather than Asian Paints, they can go for Berger Paints as of now.
Thank you for that view. Well, let's pull up Muthoot Finance. Now the stock is under pressure. The stock is down almost 7%. Now, Hiral, if you see Muthoot Finance, despite giving strong Q4 numbers, the stock is down almost 7%.
So, Varsha, what's happening over here is that optically the numbers are looking very strong on the back of the strong AUM growth, but that is coming in only on the back of the way gold prices have increased. If you have to look at the customer acquisition or new customer addition, that is up only 2%, and I think that is one of the points which is really concerning. Secondly, the margins have come in under pressure as well this time around. So that is another factor which we are watching out for. Let's quickly understand what are the other things that we should look at. Overall, in terms of their FY26 gold loan guidance, they've maintained a growth guidance of 15%, whereas they achieved almost 40% in FY25. And the management clearly indicated that their CFO is absolutely conservative and they will relook at the loan growth guidance in the second quarter. So let's see what are they alluding to from here on. So basis this, your fall in gold prices or non-sustenance in terms of gold prices becomes a key risk as well. Their asset quality in the MFI portfolio has also deteriorated because your stage 3 in the MFI book has inched up significantly. In terms of the new draft gold circular, The current LTV is at approximately 61%. So the gap that they have, it can max go up to 62 to 63%. So the growth will mainly depend on your gold price sustenance. Apart from that, the ticket sizes becomes a concern. So your regulatory headwinds as well as the kind of competition from banks that is coming in the gold loan business, that is what is impacting business. Spreads could be impacted as well because of the competition. The margin will go down. And overall, the pricing behavior is what will have to be closely monitored from here on as well, taking the multiple players that are coming in. So overall, it's a pretty double whammy year. I think the street is watching out for the risks and factoring that in because the stock is under pressure. And what's interesting is I think if you pull up a 1 month chart of Muthoot Finance as well, you'll understand the stock was up nearly 10% I think in the last 1 month. If we can just quickly have that chart on the screens because that will tell you the story. And in terms of the target prices, right now it's giving you a 2% taking into consideration the 7.5% downtick today. But it's probably already hit the target prices of a lot of brokerage houses and now there is a earnings risk probably that is coming in. In fact, we also spoke to the managing director, that is George Alexander Muthoot. Let's quickly listen in to what he had to say.
We generally give a guidance of 15%. Our CFO, etc., is ultra conservative. He always gives a very low guidance, and we feel that giving a guidance, we should be able to achieve it and overachieve it. As you said, we have been given 15% guidance. But after quarter H1, half year one, we actually revised it. And in the last quarter, we again revised it. So I think today, let us go with the ultra conservative guidance. Probably we look at it after Q2. Q2 results are out. Maybe we may think of revisiting the guidance. But anyway, 15% is what we have been guiding all throughout last 10 years. We have always been guiding 15%, but we have always been able to achieve 15, 20, 30, 40, etc.
Dinesh, how are you seeing this counter? Because, fall in gold price is one of the risks that the investors, are of concern. How are you viewing this?
One thing which I think that market gives a higher multiple to any particular counter is that when they are sure about the earnings growth, right? So even as we understood that the management itself is not clear how exactly the FY26 numbers would be. For now, they have given a guidance of 15%. Yes, given the track record, they keep on revising based on the gold prices. So I think there is a lack of clarity because of that. People are not liking exactly after the numbers. One thing. Second, what can I see is that because of definitely gold price, as it is rightly mentioned, because of gold prices, so we have seen in last 3 to 4 days, gold has declined very aggressively. So Nifty that day itself was up more than 9%. At that day itself, the gold declined almost 4 to 5%. So because of these two factors, I think investors are not liking the overall counter as of now. Maybe after, based on the quarterly developments, they can take a call later.
Right. So that's with regards to Muthoot. Let's pull up a Manappuram Finance also, see if there is a counter reaction coming in on a Manappuram Finance with a Muthoot taking into consideration the commentary that we're hearing from there. There you go. Some cuts, but not that deep. 1.5% downtick on a Manappuram Finance as well. But let's also take a look at another stock that has been buzzing in trade, Petronet LNG. In fact, my colleague Somit joins us to tell us what's aiding this kind of a move as we speak. Somit, over to you.
Well, yes, Petronet LNG has been buzzing in trade. The stock is up more than 3% in trade. Now, here's what we have found out from GAIL's presentation. So, GAIL released its Q4 presentation yesterday, and do remember that GAIL owns close to 12.5% stake in Petronet LNG. So, as part of the presentation, GAIL had also given the profitability numbers for its associate companies, and Petronet LNG is one of its associate companies. Now, as per the presentation, FY25 profit of Petronet LNG for GAIL stood at close to 503 crore rupees. Now back calculating this, which means that this 503 crore profit is for the 12.5% stake. So if you calculate for the 100%, then for Petronet LNG, FY25 profitability number stands at close to 4,024 odd crore rupees. Now if you deduct the 9-month profitability of Petronet from that, which stood at close to 2,850 crore rupees, the fourth quarter profit number of Petronet LNG is something that you can get, and that stands at close to 1,170 odd crore rupees, which is way higher compared to what the street estimate number is, which stands at close to 814 crore rupees, a clear beat of 44% that Petronet LNG could report in the fourth quarter numbers, and this has come in much ahead of the result date for Petronet LNG. So that's the reason why Petronet LNG has been buzzing in trade, and the stock is up 3% currently on the back of higher profitability expectations that the street has after seeing the profit numbers of Petronet LNG in GAIL presentation.
Thank you, Somit, for getting us the details. Dinesh, how are you looking at a Petronet LNG? Because clearly the stock is up over 3%. GAIL actually in its investor presentation gave out these details with regards to, FY25 profit of 503 crores from a Petronet LNG. And that is giving you some bit of a direction with regards to what Petronet LNG could be looking like. Your view on the counter?
See, usually I don't track this overall segment, but what can I understand prima facie is that because, as it rightly mentioned, because of GAIL's numbers, people are estimating that Petronet can grow its profit this quarter. So overall, based on the FY25 numbers compared to last year, it is a very strong growth. So because of this, I think near-term strength is seen in the counter. But given that there is a volatility in margins in quarter to quarter, so if I talk about the 10% or approximately 10% margins in December compared to 9% in September 24. So overall, I think the margins, operating margins are very volatile in these counters and overall segment as well. So I don't particularly track. So for near term, it is a good option. But for medium to long term, I think based on the quarterly numbers, they can take a call. But we have to be very cautious based on that.
Right, so that's with regards to Petronet LNG as well. But Dinesh, please stay with us. We'll quickly slip into a short break. Once we are back, we'll be speaking to the management of Lupin. Ramesh Swaminathan will be joining us to address us in terms of what's in store with regards to FY26. And after that, catch NDTV Profit's special coverage on the big question where India's defense moment is right here. Joining us will be Ankit Mehta and Ashok Atluri with Tamanna as to where the defense sector is headed towards for India's Make in India initiative. Please stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research,
shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Market seesaw to trade flat. Nifty above 24,700 and Sensex above 81,400. Broader markets though outperform benchmarks. 3 stocks advance for every 1 declining on NSE. Sectorial action mixed. Defense, media and metal gain while IT bears the brunt. Nifty bank as well trades with minor cuts. Defense pack charges ahead on Operation Sindhu's success. Nifty defense gains over 20% in last 1 month. Cochin Shipyard, Mazagon Dock, Paras Defense all gain over 5%. Muthoot Finance trades with cuts of over 6% after Q4 results. RBI's draft gold loan circular and the yellow metals prices remain as an overhang. Blue Jet Healthcare shares take off as the company posts a robust fourth quarter. EBITDA and net profit more than doubles. Board also announces a fundraise of 1,500 crore rupees. Welcome to Profit Buzzers. Well, time for an NDTV Profit exclusive. Some details coming in from one of the most awaited IPOs. I'm talking about NSE. Charu, what are you picking up?
Hi, so as per some sources privy to the matter, NDTV Profit has been told that the number of shareholders of India's leading stock exchange, National Stock Exchange, have hit the 1 lakh mark. However, many of them remain in some sort of stuck position or in limbo because they are eagerly waiting for approval on the NSE IPO. So as per some sources that NDTV Profit spoke to, most of them have been looking forward to the IPO but wonder why the right approvals have not come in place. We must also consider the fact that it has now become one of the largest companies with about 4 to 5 lakh crore in market cap, however does not have the approvals for the IPO. Other things that we have come to know is that on Feb 28th a letter was released by SEBI to NSE highlighting several reasons against the IPO that NDTV Profit had reported on. However, as per top sources, most of these issues have been resolved and there is a hope that the remaining ones can be looked into through disclosures in the DRHP, and currently most of the shareholders also associated with the exchange are looking forward to the same.
Got it. Well, thank you so much for that view. Well, Indian Pharma CDMO export data has come out for April 2025. Let's see the highlights of that. Overall trend, if I were to talk about, there's seen a moderation in export data for most Indian Pharma CDMO companies in April 25. But this is considered as normal seasonal pattern after strong March and Q4. If I were to talk about the long-term outlook, you have underlying strength of the sector remains intact. But Trump's price reduction plan for US prescription drugs could impact industry. If I were to talk about the key highlights for individual companies, for Divi's, April exports were down 15% month-on-month but was up 40% year-on-year. For Laurus, if you see, April exports were down 70% month-on-month and 14% up year-on-year. For Newland, it was down 81% month-on-month, and for Suven Pharma, it was down almost 93% month-on-month. Let's see what B&K has view on it. So the month-on-month decline decline in April exports for most tracked CDMO companies was anticipated, according to B&K Securities. Blue Jet, if you see, was a notable exception with strong month-on-month export growth. Laurus, Aarti Pharma, Sai Life Sciences and Heikel reported healthy to exceptional earnings in Q4 FY25, often driven by their CDMO performance. Divi's is expected, to maintain healthy double-digit growth due to multiple drug opportunities and new contracts, according to the brokerage firm. And B&K Securities remains positive on Indian CDMOs like Divi, Suven Pharma, Newland, Laurus and Blue Jet. While valuations are considered rich, but this has been justified considering the global opportunity in the CDMO space. Well, this is all we have when it comes to, pharma export. But on that, let me also invite our second guest, who is Gaurav Sharma, Associate VP and Head of Research at, Global Capital. Well, Gaurav, welcome to the show. Pleasure to have you. Considering this pharma exports data, just wanted to have your view. How are charts looking when it comes to CDMO companies, especially you have Divi's and Suven Pharma?
Divi's is very well placed on chart. We are having it on our radar. It is up for a fresh breakout, which is likely to happen just above 6275, 6300 levels, and once that is taken out, we expect the stock to rally up to 6800 to 7000 mark in the coming 1 to 2 months. Now, when it comes to Suven Labs, this stock has already, Suven Life Science has already rallied in the recent past couple of trading sessions. It has moved up from 130, 135 zone to currently trading around 185, 190 levels. So it is at best, one should wait for a decline in this stock, let it prices soften up and it come down to 165 odd levels, then there will be a good buying opportunity.
That view. Well, Dinesh, I just wanted to have your view, especially on the CDMO companies like Divi's. You have Suven Pharma, because Suven Pharma has actually acquired all, on the CDMO companies, considering Cohance, and your view also on Newland Labs. All these CDMO companies, how are you viewing these counters?
Right. So firstly, I will talk about the branded drugs, which is the development which is happening. So based on the recent Trump overall things which I have understood, so there could be some impact overall. One major company, I think, which may or may not be impacted because based on the prima facie understanding which we are seeing that. Sun Pharma, I think one of the companies which may be impacted based on the branded drugs overall things. But in terms of CDMO per se, I think we have to wait for all the numbers and all the management commentary before we make an overall call. So for now, I think CDMO is comparatively a better stand in the pharma business. And particularly if I talk about other segment, right? So the things like overall Thyrocat Technologies and etc., all these companies comparatively in this overall sector are able to do better if one wants to create an overall wealth, right? So for now, I'm not sure how exactly the branded drugs will play, but comparatively, yes, I think compared to branded drugs, CDMO can be a better player.
Got that view. Well, sticking to pharma space, Piramal Pharma is the next stock in focus. If you can pull up that chart, stock is down almost 4%, 4.7%. Now, this is on the back of earnings. Let's see what are key highlights when it comes to, Q4 FY25 earnings. If you see net profit did missed estimates. The revenue growth that you are seeing is been driven by the CDMO business. Now, we have all seen all the CDMO companies have given a good returns or good numbers when it comes to Q4, including Piramal Pharma. The EBITDA expansion or the EBITDA growth that you are seeing is due to operating leverage and the cost optimization that the company has seen. Company is on track to become a $2 billion revenue company by FY30, and the net profit growth, the sharp net profit growth of almost 52% that you are seeing is aided by higher other income and the lower tax that the company has seen. Also, company had an exceptional loss of 30 crore last year, so you have a low base last year, due to which the net profit has been surged almost 52%. Well, Dinesh, coming to you on Piramal Pharma also, do you track this counter?
So particularly, no, I do not track the counter, but based on results, what I can say is on a year-on-year basis, I think they have done pretty decent job. But in terms of quarter-on-quarter numbers, yes, I can see a good jump in profits, including the margins as well. But one thing which I can see is, which may maybe impact near to medium term is their borrowings, right? So also in terms of valuations, of course, I don't see there is a huge uh, valuation for this counter which people are giving. So for now, what I would say is maybe be in sidelines for at least for 1 to 2 quarters before you take a trade in this particular counter. Yeah, that's it.
Gaurav, how are charts looking for Primal Pharma? Stock is down almost 4%. Good time to enter?
No, not very attractive on charts. Not a good time to enter. Stock has been an underperformer for quite some time. Currently quoting around 208. Yes, today is the impact of its earning nearly 4.5-5% down as of now. Some more downside is pretty much possible if the stock slips below 200. A further decline towards 180 is quite likely. So as of now, I would avoid this stock. I'll prefer wait for some time. If it manages to go past 220, 225 odd level, then only I'll consider taking a position or for trading as well as for investing in this particular stock.
Right, so that's with regards to Piramal Pharma as well, the stock trading at the day's lowest levels. Another one in focus today is a Blue Jet. Let's quickly pull up that one on the screens. Interesting moves because higher sales in pharma intermediates is what has driven the revenue this time around. If you see the last 5 days performance, the stock is up nearly 14 to 15% in trade as we speak. And apart from that, with regards to where the profitability goes, 2.8 times is the kind of growth that they've achieved. In fact, first up, let's quickly listen into the management as well because they've approved a fundraise of around 1,500 crores. VK Singh, the CEO of Blue Jet Healthcare, spoke to NDTV Profit.
This year, we are adding a capacity in one of our units, which is going to be for backward integration. Once that happens, then about 90% of what we buy will be localized. Our China dependence would be very minimal. With that, I think the gross margins will certainly show an uptick.
Okay. There's a fundraise that you announced, Mr. Singh. Is that for further expansion in the very near term?
See, we are a debt-free company, so our balance sheet is completely unleveraged. So whatever fundraise that we have will go towards growth. So we'll be building up capacity. In the last 4 years, we have quadrupled our capacity. In the next 12 to 18 months, we'll add another 40%. Beyond that, also, we envision that we need larger and higher capacities given the customer lock-ins and business visibility that we have. And we'll also be investing in new R&D centers.
Right. In fact, Gaurav, let me come to you. Strong moves in the last 5 trading sessions. What are charts indicating? Are you seeing a positive breakout or do you think these are times to book profit?
Stock is looking good on charts. Rest rightly mentioned, good up move seen in the past couple of sessions. It has already moved up from 700 to currently around 810, trading 5% higher today itself. It is a volume-backed buying. A good amount of volume. I mean, the volume has actually multiplied its previous past 20-day average volume. So all this goes to show that this stock is having good potential and some more upside towards 900 levels is pretty much possible.
Well, Gaurav, how are charts looking for Lupin as well?
Sure. Lupin is sideways, trading in a narrow range from over 2-3 weeks now. It's 2150 on the higher side and the downside the range is just above 1900. So till the point the stock is trading within that range, a concrete decisive move will not be possible. But once that is taken out, we can expect a 10-15 percentage point move in either side direction. But as of now, the direction won't be clear. The only thing positive is the stock is managing to sustain above its key moving averages, which is a positive sign. So that that is leading towards a conclusion that it might come up towards a breakout on the higher side. And if that happens, 2400 will be on charts.
Right, got that view. Well, on that note, Lupin's Q4 results shine with net profit doubling to 772 crore, driven by 19% revenue surge when it comes to North America, which now forms 41% of the global sales. We spoke to Ramesh Swaminathan, who's the executive director of Lupin, about the quarter gone by and outlook going forward. Listen in. I would say the highlighting part when it comes to Lupin. Now, what led to this growth, and is this growth sustainable going forward?
We have been actually working on a number of initiatives and to kind of improve upon launches in America. So, and that has taken the shape of a lot of complex products over the past several quarters. This quarter, our good show could be attributed to continued good performance of Mera Background that we launched beginning of this year. We continue to do well on our respiratory products, albuterol, Spiriva, and the like. Apart from that, we of course launched Rivaroxaban during this quarter, which has also totaled up decent numbers. And apart from that, we also have prednisolone and of course the conventional inline products as well. So the top line, of course, has exhibited pretty good numbers over the last several quarters, and that momentum will continue in the future as well, given the kind of launches that we have lined up for the coming quarters. We launched, as you would know, tolvaptan, which is of course a pretty large molecule, a couple of days ago, and that we have an exclusivity which will go on for 6 months. So we believe that would also total a pretty decent set of numbers. Equally, we have a lot of good products coming up over the next several quarters, especially when it comes to respiratory products, the complex injectables part, the 505(b)(2)s that we're working on. So I think we are fairly optimistic about continued good performance in America.
Got it. And also in FY26, Lupin was expecting to be a $1 billion plus company when it comes to US business. So are you on track?
Yes, we believe so. So we just spoke about tolvaptan, and that would potentially be, a very large product for us in the quarters to come. Clearly, with that, and of course, the continued good performance of the molecules that we launched in the recent past, Mera Background would certainly continue. And of course, the respiratory products, albuterol, we have Spiriva, Zopinex. So I think it's clearly possible to sustain this momentum.
Got it. And also, sir, on the India business, if you see what's the outlook there, because there was a big challenge when it comes to, your respiratory portfolio. And when do you expect this to bounce back? And rather, when can we see double-digit growth when it comes to your India business?
The respiratory portfolio, the industry itself is actually not done too well. It's been, a lackluster over the in fact, the full year, I would say that has not been that great. So we continue to kind of focus on that because it's, of course, of great interest to us globally as well as in India. We are the first to launch, in fact, the India's first triple drug combination, LABA-LAMA ICDS combination with Vilentrol a few quarters ago. So clearly that's important. But overall, we are a little disappointed with our overall results in India, but in this particular quarter. But for the full year, of course, we were a tad above the overall market rate, the market growth rate. But that said, we have continued good performance when it comes to cardiovascular. We're particularly happy with, in fact, our performance on GI. But they've also suffered a little in terms of loss of exclusivity when it comes to diabetes products. This particular quarter, for example, we had a couple of those going, the empagliflozin and its range of products. We got impacted because of that, because it went generic. Apart from that, I think, of course, you just spoke about respiratory. But clearly, we are optimistic about the future, given our plans to focus on our strategy of looking at more feet on the ground, looking at a differentiated portfolio, perhaps licensing products, and of course, at some point of time, looking at M&A in India.
Okay, and on the Mera Background status, what is the kind of liability that you may have after the litigation that's going on?
I think the last word has not been said on that. The court opined on only one aspect of several things that we are fighting about. So it's not really a setback from our perspective because there are clearly other defenses that we have, including things on the non-infringing process. So it will be some time before a final decision is cast on this. So possibly sometime next year. So we have also not been, injuncted from selling the products. We continue to do this, and it's grossing up decent numbers for us.
Okay, and also, so your cost optimization strategy has, really contributed when it comes to your improved EBITDA margin, and also I think the improved margin is flowing from the improvement that you've seen in the US business as well. So going ahead in the next, 12 to 18 months, what kind of margin performance are you seeing? Because you guided 20 to 24% in FY25. What's the outlook when it comes to FY26? Can you see more improvement from here?
Clearly, the buoyancy on the top line will continue, and the reasons were obviously our continued good performance when it comes to products that we just launched, and the step up on tolvaptan during the course of the next several quarters, and clearly, as you clearly mentioned, there is a lot of emphasis on reining in costs. A lot of the initiatives that you've taken in recent times, things like routes to synthesis, alternate vendor development, focusing on productivity across various lines, be it at the sales force, at the R&D level, at the manufacturing level, and all of that. All of this have borne fruit and have resulted in fact, EBITDA margins which are continuously rising. I would also add, we still have, in fact, the adjacencies which are loss-making from our perspective. The diagnostics, the digital, the CDMO business, the OTC business. And they, in fact, total up close to about 4 percentage points loss of EBITDA margin, so to speak. And as and when they evolve and grow, which will happen over the next 2 to 3 years, I would expect margins to certainly continue to certainly increase. So there is a lot of optimism from our perspective. Even in this particular quarter, 23.2%, this is after taking into account a larger R&D spend and a lower PLI. So clearly, the spread in margins is certainly is increasing.
Well, this was Lupin on Q4 FY25 numbers and the outlook going ahead. But moving on, while speaking in Qatar, US President Donald Trump says that he spoke to Apple's Tim Cook and told him there's no need to build factories in India unless it's to serve Indian market specifically, and says India offered to remove all tariff on US goods. Listen in.
Apple, as you know, is coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff, you couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's the difference? They're the highest, and now they're saying no tariff.
Well, that's all the time we have on the show. Stay tuned to NDTV Profit. Coming up next is our big question special on the defense sector, with major focus on Indian defense equipment's post-operation Sindhu success.
That's huge. That is a biggie. It's on deck.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research. shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real
Welcome, you're watching The Big Question. I'm Tamanna Inamdar. Now, in the past few days, the country and the entire world has seen the might of the Indian Armed Forces as they launched Operation Sindoor, conducted precision strikes at terror hubs in Pakistan and successfully thwarted the swarm of drone attacks from Pakistan. What the world has also seen is the success of our indigenous, made-in-India weapons, a feat that many believed India was perhaps not capable of a few years ago, completing missions in 23 minutes and destroying Pakistan's foreign-supplied weaponry. These have all been the result of made in India weapons. Now, this is the important perspective to look at in context. India has been an importer of arms for the last several decades. Our nation has relied heavily on foreign imports to meet our defense needs, making India the second largest arms importer in the world, with indigenous capabilities playing a limited role. In fact, indigenous defense production was often viewed as slow, uncertain, or symbolic. But that perception is now being rewritten. From a 65 to 70% import dependency, India has come down to 35% and aims to become a net exporter in the next few years. Defense exports are up by 34 times over 11 years. Defense production has seen an almost 3x increase. Now, while efforts have been underway to build self-reliance, Operation Sindoor marks the first significant test of these capabilities in action. For the first time, India's indigenous weapons were tested not just in trials, but on the battlefield. And they delivered. Some of the indigenous stars of Operation Sindoor were the Akash missile system, the Nagastra-1 kamikaze drones, ISRO satellites that kept surveillance and Indian citizens safe. These weapons not only defended, but also neutralized enemy weapons like the PL-15 missiles of Chinese origin, Turkish origin drones, and much more. So understand it like this: while the enemy had to import and was using weaponry made by China, by Turkey, India was hitting back, striking back, and defending, of course, with technology with our partners, but largely with indigenous weapons. Post-Operation Sindoor, India's technological edge and tactical superiority has been recognized by experts around the world. So in that sense, Operation Sindoor is not just a military milestone, it's also a watershed moment for made in India weapons and the defense sector in the country. Now that's something, of course, that those of you who follow equity markets have been seeing in defense stocks. But this is a bigger story than just that. It's a moment that shows the transformation of India's defense sector from a buyer to a builder, from importer to innovator. And that's the big question we're talking about today. Is Operation Sindoor Indian defense sector's moment in the sun? And who better to speak on it than Ankit Mehta, CEO and co-founder Idea Forge, Ashok Atluri, Chairman and MD, Zen Technologies. Welcome to both of you, and thank you so much for speaking with us here on NDTV Profit. Just to set the ground rules straight, we're not talking about the financials of your companies here. We're not talking about your balance sheet. And of course, we will not ask you to divulge anything which will not be in our national interest. But we want to get a sense of how big a paradigm shift this is. Mr. Atluri, let me begin with you setting the context, because this is something we're seeing externally. But you know the shift and the tectonic shift that has taken place in the Indian indigenous defense sector.
Yeah, I think this is a big event, Tamanna. I think what's changed is the perception that India, the made in India brand has improved because of this. I think this was a fantastic marketing opportunity for us. And I do feel that some companies have really come out tops. They have proven their products, and the government is really very excited that it's not only. So now the government has shifted from talking about only make in India for the India, but making in India for the world. Now they're trying to identify global champions. When we talk about being a net exporter, what we want is identify few product segments in which we can absolutely dominate the world and pour a lot of R&D amount into it, and then so export it to the world. But again, even before that, these companies should be have been battle tested. They have been also indigenous IP tested, in the sense there is a category called Buy Indian IDDM, in which they examine the IP content and they by only Indian-made, Indian-developed drones and anti-drones. So I think this whole thing from, basically the effort that was started in 2016 by Mr. Parikar when he introduced the IDDM category, 2020 reiterated. So, and now we are actually seeing that in the battlefield, the products have worked. This is a huge, huge thing. And I think the days for India to become a major defense player, not a made, so, when people say make in India, I do get a little irritated. It is design, develop and make in India. The IP is owned by us. We are not just partnering with it. So that's one category. Of course, there are other categories, as you said. We are collaborating with foreign players to develop locally and then sell it. Yes, but this is a complete India game now.
This I just love this. Zentech, and by the way, stock has been on upper circuit for the last several days. That's not what we're discussing today, but just that confidence. He gets irritated when people say make in India. We're designing in India, we're ideating in India, we're innovating in India. Ankit Mehta, that's an important difference to make. We're also going to be exporting from India.
No, absolutely. I think what Ashok sir said, I think it's really, really important that we recognize the fact that India is no longer dependent entirely on the rest of the world to give it technology. I mean, I completely second his sentiment that it is actually very, you can say, demeaning to the Indian technology in the Indian context, where we are trying to say that we can't actually build technology in India when we have some of the biggest and the best global institutes in the country that have done us so proud in the rest of the world. The same talent, if it can do well there, then we can do stuff here as well. And that's what we are showing over the last 20 years at Idea Forge. That's what we've been doing. We've been building not just technology in the country, but we are also building some of the best capabilities in the world in the categories that we build for. I think that confidence will see a huge boost now. And we will see more people coming into this area, and we will see that more people will have the courage to not just get stuff from outside, but to make it such that it can be relevant for the rest of the world. And India is a great testing ground for that. In India, we have to make technology that has to work, not just now. We have tested them in real conditions, real crisis or a real moment of, you can say adversity with our neighbors, but we also have to build for them in the peacetime to work in some of the highest operating environments in the world. We are talking about flying at more than or operating at more than 6,000 meters, operating at minus 30 degrees, minus 40 degrees, operating in the deserts of Rajasthan, operating in the marine environment of our country. So building technology in India is really a testament to building very high quality stuff that actually works and can work anywhere else in the world as well.
So, Ankit, let me just take a follow-up from you. You've echoed what Mr. Atluri said, that why this idea that, it can't be built in India, because it hasn't been. Let's be honest, things have been very different. And Make in India before Operation Sindoor was a great idea. But now the theory has been proven by the practical. So people need to see the practical to see that it's really working, which is why I'm asking, is this the paradigm shift? Is this the moment in the sun for the Indian defense industry? Ankit, that question to you first.
For a war scenario, yes. But if you look at what we've been doing in India, and we've been combating militancy, we've been combating terrorism for a long while now. And the technologies we have created to combat militancy, terrorism in our country, they are also showing up in a very big way. We will see incidents, but the amount of development, process, method, technology that has been conducted, and a lot of it homegrown for doing these operations. Again, India has actually real world tested systems that have helped catch militants, insurgents in many, many operations out there. So that is one part of what we are very good at. We have proven capability there. But now with what has been battle tested, again, we get to a new moment under the sun where it will be recognized globally, and we will see that our technology will be trusted as well.
Mr. Atluri, for the longest time, the biggest news on the defense sector used to be deals that were inking with, and this was part of state visits, where you'd be inking deals with a European nation, with the United States, with Russia. And there was always this idea of transfer of technology, TOT. Ashok Atluri, the question to you. Where it would be, okay, India will get some transfer of technology in return for these large orders that we're giving. Has that TOT built the base of what we're seeing today, or is this an indigenous PLI incentive scheme-backed push that we're seeing? How exactly has this gotten the Kickstarter it needed?
I think the products that we have developed are not my personal view is that it's completely indigenously developed. Companies like Ankit's IdeaForge, there's some other companies in drone segment, and Zen Technologies has been the forefront on R&D, and we have been working on a counter-drone system since 2018, when there was complete silence about anti-drone systems. We were talking about anti-drone systems. So what I think is whatever have been battle-tested were completely indigenously developed. Some of the product, but some products, of course, have been imported. But I think this have the key, the paradigm shift here has been that India can develop and it works in the actual war. That confidence that the government must have got from now. So the follow-up action should be, the one thing any startup or any even existing player wants is, we want orders to come in a regular flow. And, we want to build our capacities for a full-fledged war. Somebody was asking what kind of capacity should India have. We should think of a multi-front war from all our enemies. And we should say that if the full-fledged war is going and the expenditure of the ammunition, the equipment happens on a per-day basis, we should be able to replace. The industry should be able to replace. That is the capacity that we need to build. And, government has to come forward. And especially, in some certain segment, they should say, listen, this is the spare capacity you need to keep for a full-fledged battle kind of scenario. I think that confidence has come in after this event, and we feel that we feel almost redeemed that we bet big onto the IP development for the country.
Oh, redeemed and how? Redeemed and how? We're putting that up on our screen. These are the industrial heroes behind Operation Sindoor, and of course, full salute and respect to our armed forces. But these are the guys that are making sure it's indigenous. We're not dependent on anybody who can use their equipment to us as a bargaining chip or operating leverage, and that makes a huge difference whenever you are in this kind of a scenario. Ankit Mehta, I want to understand what is the kind of capability we're developing, because one thing that we've seen in Operation Sindoor, and which is why it's marking what new age warfare looks like, that everything has happened without crossing borders on both sides. No one crosses any borders. It's all very technologically driven. It's a lot of stealth weaponry which comes into use. So this is truly at the cutting edge of what we're seeing globally. Is that safe to say, or is it an overreach?
No, absolutely. I think from the point of view of the counter-drone systems that were very effective in neutralizing the kind of challenges and the kind of attacks we were facing on our side, we definitely have proven that we have one of the best anti-drone and anti-air defense technologies in the world. And some of it is indigenous, some of it we have gotten from our partners, some of it is legacy systems as well. And all of them worked in a layer format to prevent an attack on our soil and our territory. And on the other hand, if you look at what we attacked with, again, I think the technology has to be there to do the kind of precision attacks that we have done on the other side, where we have been almost inch perfect in terms of what we targeted and where those munitions landed and how they were able to create the necessary damage that we were seeking on the other side. So yes, technology now going forward will entirely be dependent on the use of the aerial power, the unmanned systems, both in terms of attack and in terms of defense. They will be required, and they are also required even before any of this starts. They are required to gather the intelligence on the other side. They are supposed to operate in our territory and get us intelligence of what is happening on the other side, so that we can get the right kind of targets to look at the kind of targets that we can zero in on to ensure that we are able to be precise in what we are doing. And that precision is something that was very, very critical in India's operation. The ability to maintain that we have been very precise and very, very specific in what we did, I think is a huge win for our country. And that's the future, where we are going to do in any war scenario an end effect that is very clear, that it achieves its precise objective and does not cause too much collateral damage. That's going to be very important as we make sure that we get rid of the challenges that we face from across the border.
Precision without collateral damage. I mean, that's really the kind of thinking we want. Mr. Atluri, just want to understand the extent of technology and how we would compare to say what we now know and see across the world? Because it's one thing for us to say, and Operation Sindoor has shown that tactical excellence as well. But in terms of just pure hardware, weaponry, technology and capability, how do we compare to some of the biggest defense producers of the world?
So in terms of counter drones, I think we are absolutely there, and because we have demonstrated it. We need better integration with the weaponry system that we have. That's an ongoing process at this point. That's a proven process. I wish the armed forces accelerate the induction of that. But again, we are absolutely on and absolutely in top 1 or 2 as far as the counter drone technologies goes, ability to intercept, and very preemptively. One of the things that we did was lot of problems that the procurement process now we're facing is they are buying counter drone technologies with commercial drone capabilities. That means to say only DJI drones are something which fly at 2.4 or 5.8 gigahertz are being stopped. But when we started investing much ahead and saying, listen, the terrorists or the government supporting them will not stick to the commercial frequencies. They may come with any frequencies, and lo and behold, we have actually seen in this scenario that they were flying in all kind of frequencies, and our systems are able to thwart them. Again, very very few companies in the world are doing it operations at this level. So I think this was really, really proven that, what we are giving is not a, second kind of thing. It's absolutely in the top of the products in the world.
And Mr. Atluri, may I point out, without any media spotlight or glare, I mean, you and I speak pretty much every quarter, and of course we discuss your numbers, and sometimes you talk about what the new products etc. are, but not just you, for the industry as a whole, no media spotlight, no glare, no information on what India is really building till it is in action, and that also becomes a very important part.
Very frankly, when this thing came, our guys are there supporting the armed forces at the place of action. So the general feeling in Zen was, this was the moment we have been built for. And, we were completely all out saying, what can we do at this point in time to support the Indian armed forces to win the war? And I think that commitment is much more than the orders that we are getting, the thing that, I could see that, when companies that are not having that high agency, that factor of that patriotism, will actually, when the war comes, they want to back out. Which is kind of strange, So this is the time we really put your heart and soul in supporting the government. So I think we, as a company, it also kind of proved to us that, these guys were actually fighting with each other to go to the fronts. So, I think we are very, very lucky in that way that company is, completely committed by heart and soul to ensure that India wins every war, not only now, but in the future also.
Just amazing to hear. That's just amazing to hear, because it's intertwined. It's nationalism, patriotism, of course, profits, balance sheet. You are a listed company, so there will be that scrutiny. Ankit Mehta, we've hopefully got your line back. Just this point of how we compare with the best in class, because that's also important. We shouldn't lose sight of that bigger picture there if you want to continue to excel at this pace.
No, absolutely. So if you look at, technology, particularly insofar as drones are concerned, and Ashok sir mentioned regarding what is happening in counter drone, but insofar as drones are concerned, there are many categories. There are categories that you can create that can launch from the palm of your hand, that can observe the target right in front of you, maybe a house or something else. And then you have drones that can operate from 5 kilometers away to go to the house and observe it, or maybe from 100, 200, 300. So it depends on from where you want to take off and go and observe your target. And each category has different roles as well. Some have the ability to observe the target, some have the ability to attack the target, and some will have the ability to have some kind of other sensing that may be required in that area. So in different categories, our drones will compare to different players in the rest of the world. And if I talk about this palm launch drones, I think India has just started.
Oh, we seem to have a poor line there. Ankit, can you hear me? Okay, we'll try and patch him back. He was at a very interesting point in talking about this Palm-launched drone. I mean, to be fair, we are not going to be talking about anything that is not already in the public domain. That is not what we want to do. Ankit, can you hear me?
Yeah, I can hear you.
Okay.
Sorry.
So you got no, the line got cut off when you were talking about the Palm-launched drone.
Yeah. Yeah, so I'm saying that depending on that category, perhaps we are just getting started in the country. But if you look at one category that exists between 5 to 20, 30 kilometers, I think India has the best drones insofar as intelligence, surveillance, and reconnaissance are concerned in this category. Some of the drones that we build outperform what the rest of the world builds by a significant margin in terms of capability. Then there is a capability above that. Again, India is getting into that category right now, and we will progressively build the best in the world as well. So there are some categories for which we are already very, very good. And there will be categories that progressively we will become better at. And I think this experience in the war will also make sure that what we build is resilient and is capable of operating in the kind of environments we are going to see in the war. Going forward, we will need resistance to electronic warfare equipment on the other side. We will need resistance to making sure that we have capability of upgrading the intelligence of our systems in the field, so that, like Ashok sir said, we need people on ground to make sure that they can adapt to any situation as it evolves on the ground. So there are many learnings, and those learnings have to be translated into what we buy, and that is what's going to drive us and propel us to be ready for the next wave and the next iteration of what can happen.
So this becomes crucial in the next iteration. Ashok Atluri, what needs to be done to push us to our goal of being export surplus country in the defense sector by 2047?
I think we'll revise it to 2027. I think we should be really working very fast, and and I think what the government has already done: easy policy rules, PLI schemes, banning of import. These are the kind of steps, and IDDM. If you get these things right and then they insist that indigenization should happen, the IP should be Indian. I think we will be on track. And very frankly, Tamanna, we are almost there in the sense that 2047 looks very, very far away. I think by 2047 we will be really. I personally think we'll be the largest economy in the world. But if we should get the policies right, where these, and now the policies are right. What the industry needs is the proven technology. People who have done, please start giving them large orders so that they build the capacities. And even the procurement process, when you go, there is a platform called GEM. In that, you become L1, and they have something called the reverse auction enablement. Those are the kind of things that really kill the IP owned companies, because there's a lot of R&D involved, and people who are actually reselling products, buying and reselling, they can really cut down their prices and come down to a very, very low level. And that's the way to kill the technology within India also. So these river RAs and all those kind of things have to be removed, or people who have proven technology, give them lots of orders so that they can make the system and keep improving. Listen, the fact of the matter is, if there is a IP driven company, no matter how much they give, they are addicted to R&D. All the money will go into R&D to create the next range of products. So you identify those companies which have track record, which have created the IDDM, and then start giving them large orders, and they have already proven the technology. And I think that will set the path for the global domination in certain categories. Again, we don't want to be dominant in all the categories, but certain like drones, counter drones. We are also good at training simulation. We are the best in the world in training simulation and robotics that we are trying to get into. So get to dominate. The Pareto. These are the Pareto fields in which, if we dominate them, we'll definitely become one of the largest exporter of defense goods in the.
I appreciate that, Mr. Atluri, but having said that, there is a tried and tested system of procurement in India, and looking at the history we've had over, the history of the nation really, for the defense sector especially. I think if there is a transparent, tried and tested process, yes, it might be a little painful for you as an innovator, but that's part of what is important in a democracy as well, I'm sure. you will appreciate that. But just fantastic speaking with both of you. Thank you so much for your time. This has been a very enjoyable conversation. Idea Forge CEO and co-founder with us today, Ashok Atluri of Zentech, also speaking with us on the watershed moment, the coming of age, really, of the Indian defense sector. That's all the time I have on the big question, but stay tuned. A lot more coming up on the other side on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real
What a beautiful afternoon from a market's perspective if you're a bull, because we are now nudging 25,100. 25,000 seemed to be a distant possibility a couple of weeks ago. We are close to 25,100, and what a surge in the last few minutes of trade. And almost everything has participated. Now, we know mid-caps and small. I love that. I love that bull that we had. By the way, can we have that back? The point being, this is lovely, because for the last 4 days we've been talking about how the small caps have essentially overtaken the Nifty, and yes, they had. But in today's session, in the last few minutes of trade, the Nifty 50 is making its presence felt. Can we get the heat map up on the screen and just show you what's moving? Actually, except for IndusInd Bank, everything in the green. Now, the last few minutes of trade, some heavyweights have started to move up. So you've seen a bit of a move in Reliance Industries in the last few minutes of trade. ICICI Bank, about half an hour ago, has had a good move. And then the big winners of the day today, Hero MotoCorp, 5.5%. Brokerage notes doing the trick there. JSW Steel, I would reckon that Tata Steel did that yesterday, JSW doing that today. Effectively some spurt in metals because of the China factor. So pretty good going really for a clutch of these names. And this is what the Nifty Metal Index is doing, right? 4% higher for JSW Steel, Nalco 3.5%. There is strength in JSPL. Effectively, steel is doing very well. You also have an Adani Enterprises chipping in along with Hindalco, by the way. But it's effectively steel which has done really well the last couple of days. I mean, surprising, because effectively when China were to do well, base metals would have come to the fore. But now we have the steel stocks doing well. So all in all, very good move for the large caps. Now, before I hand it over to Tamanna, bring up the mid cap and the small cap indices here for once on the screen. It's a remarkable move in the large caps, but let's pull up the mid caps and the small caps as well. I love the bull, by the way. The producer compliments. It's a really good one. Mid caps 0.5%, small caps probably less than 1%. Yes. So today the Nifty 50 is coming out and doing this. Now, some of it could be short covering, some of it could well be some FI buying. I think it'll be very interesting to see what the kind of FI number is like in the session today. But Tamanna, well, for once, the benchmarks or the large caps are really outperforming, but a clutch of small caps out there with their story to tell.
Oh, absolutely. This is an all-round party, and we were waiting for the 25,000 mark. In fact, the feeling was that it would be a slow and painful journey to 25,000. Not at all. The kind of move we've seen in the last 1 hour of trade has been astonishing, to say the least, and you can see that from the chart of the day. Mid-caps also doing well. Obviously, the excitement with the index levels seen on the Nifty, but mid-caps not half bad at all, but 0.5% up on the Nifty mid-cap 150. Small cap also index doing fairly well, nearly 0.5%, little over 0.5% up. I just want to quickly pull up the advanced decline ratio before we get to our first speaker to just break down what's happening in the markets right now. And advanced decline ratio is looking robust as we speak. But Dinshaw Irani joining in of Helios Capital Management. Dinshaw, great to speak with you. What's the cheering about?
Hey, hi, Tamanna. So basically, I think it's about the flows which are hitting the market. And frankly, I mean, if you see how the large caps have been behaving in the last couple of weeks, they didn't participate as much as the mid caps and the small caps did. I think it's a matter of time before the rally caught on with the large caps too. And that's what's pulling the market across. And frankly, I mean, as I've been always saying, that now it's the active money which is really coming and hitting the markets. And that active money always chases value. I think the only value that they see today in the markets is probably the large caps, and that's what's happening there.
You know, you probably also on Nifty expiry day, so perhaps some of the short covering that we are seeing over there. When you say active money coming in and chasing the large caps, Dinshaw, what is looking most exciting to you, which still has value to give? Because we've seen IT stocks roar last few days. Do you think that's one place where you would feel some comfort, considering that it has taken quite a beating before the US-China deal was announced? Do you still like banks which have been sitting out for the last few days?
Yeah, actually, Tamanna, the fact is that IT, I think, is more of a relief rally than anything else. Because if anything, the fact was that there was a lot of uncertainty in the US, and that's why IT was suffering. But even with these deals in place, I don't think the problem, I mean, deals isn't, I'm talking about tariff deals in place, I don't think the US economy is looking that great right now. And anyway, with AI coming in, IT is going to be an overhang for all these guys. AI is going to be overhang for IT for all these guys. So that's why IT is not the place that I think the money is getting parked. And mainly, I think it's the banks. Autos suffered a bit, and I guess autos is another place where the money is getting parked. But frankly, I mean, we're not that comfortable in autos. But PFSI, definitely, we're on with that.
Dinshaw, just and well put, and thank you of course for talking. But just one more question here, and which is do you reckon that this is not quite the end? Because as you said, small caps have done well over the last 4 days, matter of time. Does it happen in a day's job, or do you reckon that this party could last a little bit longer?
Neeraj, actually, we were always believers that India is a mid to long term story, but in the immediate short term, things aren't looking that great for us. I mean, you look at the way the demands are panning out. Hear the calls of all these domestic consumption plays. They are pretty downbeat and stuff like that. So we weren't sure whether this rally will last or no. But our feel is that with the money flows coming in, maybe the rally will be there for a while, but beyond that, valuations will catch on somewhere. Probably from the second half onwards, things may start looking really good on the fundamental side also. So our feel is that maybe the market should go in for a breather from here on.
Okay. A bit of a breather from here on. Dinshaw Irani, thank you so much. Really appreciate you taking the time out and talking to us. Good move. But maybe a bit of a breather here on. Kush Bora believe that. Let's go and get a trade perspective there. Kush Bora, thank you for joining in. Are you of the same opinion? Is the market looking stretched? Are you taking money off the table, or do you reckon there's still some more to go? Now, right now, we're talking about the Nifty first.
Hi, Neeraj. A very good afternoon.
Well,
I'm not sure if we're in for a breather. The reason being that we spent some time before we broke out above this 25,000 mark. Well, to be honest, it did catch me also by surprise, because given the kind of setup that we were seeing yesterday for this weekly expiry, the range was looking somewhere close to 24,700, 750 thereabouts on the upside, and about 24,500 on the downside. But yes, as even Tamanna referred, I think there is a short covering rally that kicked in, and a pretty big one at that. Now we're crossing 25,000 on the back of fairly decent volumes in the F&O space as well. I think we're here to sustain these levels. What will happen now is that the support levels will shift from 24,300, 24,500 to about 24,700, 24,800 levels. So yes, if you have a position, I think you should continue to hold on. If you go by even what Mr. Dinshaw Irani was saying, even if this is a liquidity or a momentum play, then you might as well enjoy it rather than book your profits early. So I will hold on to my positions on the Nifty. Even if the next weekly expiry, that starts from tomorrow, if you see that, then the 25,000 straddle that's playing out has a premium of about 350, 400 rupees. So 25,300, 24,350 is anyway on the card. So I will hold on to my long positions with 24,800 as my trailing stop loss on the Nifty.
New positions you would build, Kush. Very good afternoon to you.
Hi, Tamanna. Yes, I would build with the same levels in mind, with the 24,800 as the stop loss, 300, 350 as the target, because this is a very clear breakout and a strong one at that. And a lot of sectors, in fact, all the sectors practically except for the PSU bank are participating.
And what about on the Bank Nifty? Bank Nifty has been sitting on the sidelines last few sessions.
In fact, for about 15 odd sessions, there's been a falling trend line resistance that we were seeing. But if you recall our yesterday's discussion, that was more of sector rotation that was being witnessed since everyone came to the party. It was just Bank Nifty since early April, late March. That was riding high. Now everyone's come to the party, so Bank Nifty couldn't have stayed out for too long. I think that was a good buying opportunity. That's the one thing that we discuss consistently. That it might be muted, but it's a launch pad for the next up move. I think in this rally, 56,000 will be tested once again and perhaps even taken out. So 56,700, 56,800 are the zones to watch for. HDFC, ICICI Bank, rather HDFC and SBI, they've had a breather and they're starting to move higher. It's just ICICI Bank just doesn't seem to stop, so might as well play that momentum as well. So remain constructive on Bank Nifty as well. 56,700 are the targets to look for on the upside.
Okay. And Kush, what are your stock recommendations for this afternoon?
Well, like we discussed on Monday, the mid and the small cap segment of the market will, start doing their thing now, and we're seeing that. So the picks are from, that segment. Techno Electric, again, a good move on this one. Rounding bottom formation breakout yesterday, continuation today above the 1150 mark. So I think, this momentum is here to stay. So on the upside, you're looking at levels of 1250, 1290 and 1170 is your stop loss. The other one is Gabriel India. I know it's a little soft today, a little over 1%, but if you see the accumulation that it's seen over the last week or so and the moves that it's made, I think this is a good chance to enter Gabriel India at slightly lower levels though. But 660, 680 are your targets, 620, 615, that's the support zone, so that should act as a stop loss.
Kush, just wondering, just before we get to rights, but very quickly, any trade in a metal name? I'm sorry if I missed you recommending or saying a sell or a buy on any of the large cap steel names, because they've been on a roll the last few days.
So not really the large cap ones, Neeraj.
JSW Steel, Tata Steel, no?
So again, they've had a good move already, and there is momentum building up. But these sectors, especially the Tata Steels of the world, are very prone to volatility, and now it's coming up against the resistance of 160. If you see the call option congestion on this one's very heavy. So while I will not initiate a fresh long position, if I had a fresh one, If I had a position on Tata Steel, I would continue to ride with a trailing stop loss around the 154 mark, but I wouldn't initiate a fresh one. JSW Steel, yes, perhaps, because the resistance level on this one are slightly higher, close to the 1060 mark and then about 1085 mark. So maybe that's one you can still consider. The risk reward ratio not that great, but you can still consider. Tata Steel, I wouldn't. I would ride the momentum, but I wouldn't create a fresh position on this one.
Okay, thanks a lot for that, Kush, for those ideas. And I'll stay on Kush, so much more to talk about. But RITES is a company in focus as well. The numbers came out. It was a flattish quarter because, revenues were down about 4.3% because I think there were, as our analysis seems to suggest, the lesser revenue from quality assurance and turnkey projects which impacted the revenues. Margins also remain kind of range bound, though you would argue that the operational metrics at 30.2% versus 27.4%, margins look better than what the quarter was. Let's quiz Mr. Rahul Mittal. He's the CMD of RITES, who joins in to talk about what the quarter and the year looked like and what the outlook could be like. Mr. Mittal, good having you. Thank you so much for taking the time out. A flattish quarter, was this penciled in or were you hoping for a better performance in quarter 4?
Yeah, good afternoon. In fact, to the contrary, if you look at the previous quarter and the entire FY, the challenge for this FY were from the two streams of revenue. That is the quality assurance business and the export revenue, which is nearly nil for the entire FY. So if you recall, the guidance which we had given at the end of quarter 3 was that we'll put out all our best efforts in quarter 4 to peg back, because this being the toughest year for us, to come as close as possible to the previous FY. And what we were aiming that on a FY to FY basis, we'll end the top line to aiming to end below 10% and bottom line below 20% vis-a-vis last FY. And that's why the focus on operational efficiency, if you see in Q4 sequentially, has been the best possible sequentially for the entire FY, making it possible that we ended the year with a YOY total revenue 8% down and profits 14% down.
Yeah, okay, but having said that though, it is still a flat quarter, sir. But yeah, the margins have certainly looked good. So you may have done better than estimates, Mr. Mittal, and kudos for that. The question, therefore, from a shareholder's perspective would be this, that if FY25, as you said, was one of your toughest years, is that behind you now? So what were the factors that led to it being such a tough year? Are those changing? Do you expect FY26 to be materially different than FY25? And why so?
The two main factors which were there right from the beginning of the FY was two very important streams of revenue. The export stream of revenue and the quality assurance stream of revenue. We had no export orders for last 4 years, COVID and post-COVID. So we started the year with hardly any export order. Similarly, in the quality assurance vertical, which traditionally for 5 decades we were doing work for the IR Indian Railways on a nomination basis, about a year back that opened up to 4 players. So the quantum went down 30% and the rates went down to about 20%. So these were factors which were the challenges at the opening of the year. Now coming specifically to where we worked on it and where we ended the year. The aggressive order inflow in exports, 1 order of exports every quarter after a gap of nearly 4 years, has made it possible that we ended the year with an export order book of 1350 crores. Similarly, in quality assurance business, we diversified for the first time in the last year to take on a large number of new clients. And overall, we ended the year with the highest ever order book of about 8,900 crores, 1 order a day for the entire FY. So having reached that, the guidance for 25-26 is a huge aspiring to see at least a 20% growth in the top line while executing this large order book.
Mr. Mittal, very good afternoon to you. Tamanna here. Just looking at your margin increase in what is a tough year, because margins have gone up and it's a good bump up that we've seen from 27.4 to 30.2%. What has contributed to the improvement in margins, and then is that a sustainable number?
No, in fact, if you see margins in isolation in Q4, they won't give you a correct picture. The focus on Q4 was to extract maximum possible so as to be able to reach, as I said, on an overall FY basis as close as possible, both in top line, profitability and margins vis-a-vis the last FY. So if you see overall on the annual basis, the EBITDA margins are at about 23% and the PAT margins are around about 18%. Where we are aiming and what we feel realistic where these margins will settle down in the coming FY, EBITDA margins will settle down around about 20% on an annual basis and PAT margins around about 15-16%. That's the realistic levels of margins on an annual basis which we foresee for the coming FY.
Yeah, so what has happened in Q4 to bump up that number?
So Q4, as I said, the whole effort was to target our high margin consultancy orders to extract maximum possible in Q4 to be able to come as close as possible to the overall levels. So that's the operational efficiency, a very, very key focused approach in Q4 to target our specific high margin consultancy orders, as I said, to be able to bridge this gap.
Sure, understood. So what happens with consultancy in this financial year as a revenue contributor? What are its plans and your outlook for consultancy, which you've said now is a high margin business for this financial year?
So the order inflows which you see for the entire FY, including for Q4, the consultancy, which is our core business and also export, has been continuously growing. And even the consultancy revenue, if you see sequentially or YOY for Q4 has grown. With this fresh orders coming in the last 2-3 quarters, the consultancy revenue will definitely continue to grow. Besides that, as I said, the export orders will start generating revenue. So that's what gives us that confidence that you'll see an overall growth in the revenue in the coming year.
So Mr. Mittal, sorry. So just reconfirming, you are saying that for FY26, and correct me if I'm wrong here, for FY26, your growth may be between 15 and 20%. Did you say that? And would that be accompanied by EBITDA margins, which will be what, 15 to 20%? No.
Yes, so you got it broadly right. What we are aiming, the total revenue, we are aiming at a growth of 15 to 20% in FY 25-26. EBITDA margins on an overall annual basis settling down around about 20% and PAT margins settling down at about 15 to 16% on an annual basis.
Okay, so 20% growth and margins coming off to between 15 and 20% would mean that from an annual average in FY25 of 23% odd, if you slip down to 20 or below, then while you will have 15-20% growth on the top line, the bottom line might still suffer a little bit because of the drop in margins. Got
yes, so the growth in bottom line, we are aspiring that there would be a growth in bottom line, definitely vis-a-vis FY 24-25. The extent of growth will be obviously not commensurate exactly to the growth in terms of the growth in top line. But yes, we would be aspiring to a growth in the bottom line also.
Fine. Great. Mr. Mittal, thank you so much for taking the time out and being with us. Really appreciate your time this afternoon, and all the best for FY25 as well. Okay, maybe not the most traded a stock which is really giving great gains. RITES is just about 0.35% higher today, and I believe the last since February it's kind of been in this 200 to 250 range. Kushbora, I'm guessing not quite something that is giving any breakout or breakdown from a trade perspective.
Spot on, Neeraj. Spot on. The only thing is that there was a minor trend line resistance, that's been taken out, but it now once again comes at that 61.8% retracement, of the rally that began, sometime back. Now the 250 resistance will again start acting up. So my suggestion, if someone does hold it, not a bad idea to partially offload around the 250 mark. If and when it crosses the 250 level, perhaps, it will see some traction and move closer to the 275, 280 zone. But for now, yes, the 280 resistance, 250 resistance still acting and might just continue to do so for some time.
Okay, Kush, just but because RITES is PSU and since some of these defense names are doing very well, just wondering, in the morning. We just speak about any of these. I mean, they've rallied a bit more as well. Cochin is up about 4.5%, 5%. Would you take some money off the table? You're on mute, Kush, maybe?
Yeah, sorry. Yes, I would take some money off, but only partially. With the kind of rally that these stocks have had, some of them have started to hit overheated territories, especially if you look at the likes of PEL, which has been a favorite even, all through the downturn. So yes, I would book them out partially, about 50% or so, but I will look to re-enter in, those same names or at least the same sector, as and when profit booking sets in. So yes, I wouldn't let go of my holdings entirely, but a partial profit booking is surely warranted on some of these names.
Okay, there's no slowing down for the markets right now. You are now about 400 points up. I don't know if you'll take out 25,100. You still have an hour, 10 minutes to go for trade. So never say never. And so many stocks to cover today. We're talking about Blue Jet Healthcare, buzzing in trade on the back of fourth quarter earnings, robust set of earnings. Revenue growth was driven by higher sales in their pharma intermediate segment. Varsha is joining in with more details of what worked for Blue Jet.
Thank you for that. So, good set of numbers, and that's why the stock is buzzing. Revenue growth that you're seeing is driven by higher sale in pharmaceutical intermediate. The profit improvement that you're seeing is due to high sales volume, cost optimization strategies that the company has done, and the company has also announced fundraising of almost 1,500 crore. Now, speaking about the segmental revenue, this is where this is what the highlighting factor. If you see, the contrast media saw negative growth of 9.5% year on year, but the pharma intermediates saw 446% year on year growth, and that's the reason why the numbers are quite well when it comes to Blue Jet. The high intensity sweeteners grew negative almost 12.5%, and if I were to talk about the contribution of all these three segments, pharma intermediates contribute almost 45% to the overall revenue, and this is the growth factor which will drive future growth. Contrast media contributes almost 40%, and high intensity sweetener contributes 13%. If I were to talk about the 5-year CAGR of these of the segmental performance, the contrast media grew almost 3.4%, pharma intermediates grew 83%, high intensity sweeteners grew 7.8%, and others grew to 269%. On the outlook, though, long-term revenue growth guidance has been given by the company at 15 to 20% CAGR, and the company is very bullish when it comes to CDMO. They're expecting strong traction from Europe innovators and also benefiting from China de-risking as well. And lastly, they're targeting GLP-1, that is diabetes portfolio, which all pharma companies are actually targeting. Cardiovascular and gynecology intermediates are some of the few growth drivers which will make company go ahead.
Okay.
Yeah, so no, Neeraj, we had such a great conversation with Blue Jet Healthcare today.
Yeah.
And the fact that they are building, just broader picture, because these things get lost when we just cut out one bit of the conversation, that they are building back-end integration to reduce dependence on China. So companies that are managing to change that paradigm also become very important.
Yeah. In fact, hear out what the management had to say. I mean, he's spoken a variety of things, but this is probably one of the most important answers that he gave us. Hear out what he had to say.
This year, we are adding a capacity in one of our units, which is going to be for backward integration. Once that happens, then about 90% of what we buy will be localized. Our China dependence would be very minimal. With that, I think the gross margins will certainly show an uptick.
Okay. There's a fundraise that you announced, Mr. Singh. Is that for further expansion in the very near term?
See, we are a debt-free company, so our balance sheet is completely unleveraged. So whatever fundraise that we have will go towards growth. So we'll be building up capacity. In the last 4 years, we have quadrupled our capacity. In the next 12 to 18 months, we'll add another 40%. Beyond that also, we envision that we need larger and higher capacities given the customer lock-ins and business visibility that we have. And we'll also be investing in new R&D centers.
Well, solid guidance out there. Kush Bora, pharma is in focus today. Just before we take that break, a word on Blue Jet, if you've looked at it, and parallelly, a word on Piramal Pharma, which on the back of slightly weak numbers has corrected about 4.5, and that's a very widely traded stock as well. So give us levels on both.
So, Neeraj, Blue Jet Healthcare has been on my radar for some time. It's been popping up, every now and then. And dare I say that, your team have perhaps discovered a hidden gem. There are a few factors that are going for it. If you see the institutional holding, especially the FIs, has actually gone up in the last quarter. Since listing, the stock has more than doubled. Even now, if you see the recovery on this one has been fairly sharp compared to some of the other peers that it has right now already, retracing more than 50% of the fall that it had, from those 950 odd levels. So I think this is going to be an interesting stock in the coming days. Not a bad idea to keep some of it in your portfolio as a tracking stock. I mean, that's how usually I play. I don't have it just as a disclaimer, but yes, as a tracking quantity. So Blue Jet is a very interesting find, I must say. As far as Piramal Pharma goes, it did have those bouts of upswing, but didn't sustain. So right now, the broad range for Piramal Pharma is 230, 235 on the upside and about 200, 195 on the downside. If and when there is a range breakout, you play for that. Other than that, I think you could very well give it a miss.
Okay, all right, we'll take a very short break. Kush, hold that thought. We're coming right back with all the top ideas for the day, and of course that segment that you should never miss if you're doing anything in this market. Heard on the street, all of the chatter, the buzz of what's happening in the market after this break.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome back. It's rock and roll in the Indian markets this afternoon. I mean, there's a prep for the weekend and how. Now, you could call this short covering. We are looking at an expiry day, a weekly expiry, and that's probably what's happening because you have now crossed 25,100. I mean, there's no stopping what's happening here. 440 points up and still an hour of trade to go. So what's all the buzz? This is the segment that you should not miss. You see all of this info only on NDTV Profit. Amit Sarkar back as usual with all the gup-shup from the dealing rooms.
Yeah, the first stock that is on the focus is Nalco in trade today. Now the stock has gained more than 3%. Obviously there is a big flow that is coming in when it comes to metal stocks, but Nalco specifically is what dealers are indicating that domestic mutual funds have been buyers, and we could see the delivery volumes on the higher side for Nalco in trade today because domestic mutual funds are active buyer here. When it comes to updater service, dealers indicate that large HNIs have started to accumulate this counter at lower levels ahead of the Q4 numbers. They're expecting a strong set of numbers coming in from updater service. The company will be reporting their numbers on May 20th. When it comes to Nuvama Wealth, smart HNIs have started to accumulate this counter on anticipation of a positive news related to the promoter stake sale. Now dealers indicate that promoter has shortlisted couple of buyers and the due diligence process has already started, and the stake sale will happen at a premium and which will be followed by an open offer is what dealers are indicating for Nuvama Wealth. So keep an eye out for that stock. And lastly, it's Star Health. Large influential investor group have been a buyer of late in this count, and that's the reason if you see in the last 5 days the stock has moved more than 15% in trade. Now dealers indicate that there is a buzz that the existing promoters might fully exit the company and a private health insurer could be a buyer here. So keep an eye out for Star Health. Not obviously this announcement would come in the next couple of days, but something has been in works when it comes to Star Health and Nuvama Wealth as well.
So you're saying a private health insurer, existing private health insurer could, you are hearing could get into Star Health. Okay. Yes. The question though, Samit, that I had was for Nuvama. Why would a stake sale if PAG is, I'm presuming PAG is the seller and
they are the promoter, they'll want to exit.
The last couple of times the stake sales have happened at a discount. How is it that it can happen at a premium? And are they gonna sell so much of stake that it will lead to an open offer?
Yes, they'll completely exit. I guess they own more than 40% at this moment. They'll completely exit.
At one go?
Yeah. A PE, obviously it will not be via block deal. It will be via an off-market transaction. A PE investor would come in.
Yeah.
And yes, given the fact that it's more than 24-25%, there has to be an open offer.
Interesting. Any timelines for these transactions?
The due diligence has started. It might take at least a month.
Okay. At the very least. Okay. But this is interesting stuff. Samit, thanks for bringing it to our notice. Now, viewers, keep in mind, these are very actively traded stocks. Nuvama Wealth for sure, even Star Health. So there's something that you want to keep an eye out for sure.
But Samit is sticking on with us for a couple of other stories that he's covering today. Samit, you've had a busy day. You're also tracking what's happening with Petronet LNG.
Right. Well, at one point, if you look at the stock was up 3%, and one of the reason why, or in fact, the only reason why the stock was up 3% at that moment was the fact that GAIL had released that fourth quarter presentation. Now, in the presentation, if you look at GAIL, they had also given the numbers for their subsidiaries and associate companies. Now, GAIL owns around 12.5% stake in Petronet LNG, which makes Petronet LNG their associate company. And in the presentation, GAIL had mentioned the FY25 profit numbers for Petronet LNG. That number stood at close to 503 crore rupees. Now, this 503 crore rupees is a representative of GAIL's stake in Petronet, which means that if GAIL owns 12.5% stake in Petronet, then his share of profit stands at close to 503 crore rupees. So, which means that if you back calculate this number, you can get the FY25 profit number for Petronet LNG, which stands at close to 4,024 crore rupees. And if you deduct the 9-month profit numbers for Petronet LNG, which stands at close to 2,850 crore, you can get the fourth quarter profit numbers of Petronet LNG, which stands at close to 1,170 crore rupees. Now, this is as per our back calculation. The company is yet to report their numbers, but this profit number of fourth quarter of 1,170 crore is 44% more than what the street had estimated. Street has estimated this number to be close to 814 crore rupees for fourth quarter, but the number that could come in for Petronet LNG is 1,170, and that's the reason why the stock was up at one point of time more than 3% in trade. But the key question here is whether this beat in profitability, is it because of some one-off that could happen in the fourth quarter, or is it because of an operational beat? So that is something that we need to watch out for when it comes to Petronet LNG.
You know, the other stock in focus is Kirloskar Oil. Just before we get to the numbers, it's one of the top gainers today, of course. Kush, are you looking at this on the charts? Of course, massive run up. Would this be a key for profit booking right now? Just a view on the levels on Kirloskar Oil?
Oh, absolutely. Time to book profits. I mean, it's popped up on the list after a while now, since you mentioned. Now it's coming out of supply zone. If you see, 830 to about 870 is where, there is some congestion. Right now, it's bang in the middle of that range. You could see some profit booking. But I typically like to play momentum, via either a trailing stop loss or, booking partial profit. So I would just book partial profit and hold the rest with a stop loss around the 825 mark. Because, if you get this kind of momentum and there is a follow through, then you might miss out on another about 3 to 5% of gains, if not more.
This is something that you've looked at the numbers for, Samit. You've looked at the numbers for Kirloskar Oil very closely, and they seem to be quite a bumper.
Yeah, there are multiple reasons. Firstly, the stock was an underperformer, and what they have reported in fourth quarter is a very strong set of numbers. It is a beat on all front. If you look at the revenue, it's an 8% beat. EBITDA is 10% ahead of what the street was estimating, and net profit, the reported net profit is a 26% beat. But there's a one-off of around 21 odd crore rupees, or around not 21 odd crore rupees. It's around 2-3 odd crore rupees. But if you remove even that exceptional gain that they had, the net profit number is still a beat of around 10 to 11 odd percent. So what happened in this fourth quarter? The company's revenue grew nearly 2% on a YY basis. Now this growth number might look small, but do remember that fourth quarter last year was a very high base number. Despite that, the company has reported a growth in the fourth quarter numbers. The B2B segment was broadly flat, but the B2C revenues grew nearly 15%. EBITDA came in at 170 crore rupees as against analyst estimates of 160, and B2C segment profitability has started to improve. Last year, this number, or the B2C segment margins, were at close to 5.2%, and now this number stands at around 11%, which means that margins have nearly doubled for the B2C segment. Net profit, adjusted net profit increased around 8%, again a beat also compared to what the street was estimating. And why this Q4 numbers were important is because last year, if you remember, there was a pre-buying action that was seen because of the CP-CBO, that is the generator transition that had implemented from FY25. There was a pre-buying activity that we had seen in the fourth quarter. Hence the street was expecting that this year number would be a decline, but despite that, we have seen a growth. Also, if you look at the cash flow situation of the company, that has improved. For operating cash flow has increased by nearly 13%, while the free cash flow has increased by nearly 17%. So overall, a strong set of numbers coming after an underperformance in the share prices that we have seen, and that's the reason why the stock is up 17% in trade.
What a mover this has been today. Somit, thanks for putting all of that into perspective. Dharmesh Kant, Head of Equity Research at Chola Securities, also joins in on the show. Dharmesh, I'm going to start with the micro first, since we were talking about Kirloskar Oil, Petronet LNG, a possible large deal coming up in Nuvama. Thank you for joining in. Do you track any of these businesses? Did you have a chance to look at the Kirloskar Oil results, for example?
Yeah, good afternoon, Neeraj. I mean, today is such a hectic and busy day. So I did not have a chance to look at those numbers in detail, so difficult for me to comment. And the other deal also, which is there for the Nuvama front, so haven't studied that very closely.
What have you been busy buying in this hectic day?
Yeah, it was automobile stocks. Hero MotoCorp was the topic after the management con call yesterday. It was, I mean, a likely good, traction was expected in this company. The reason being, I mean, whatever details they highlighted are very valid. There has been an interest rate cut scenario. Inflation has eased out. Monsoons are expected to be good, and disposable income has gone up in the hands of people. We did dealer checks as well. I mean, in East India, North and Mumbai itself. So the chances are 6-7% kind of a volume growth is likely in this wedding season, the 2 months which is there. And the stock prices were beaten down quite, significantly. So that was one pick. And the other was the defense, which I have been saying for quite a long time. So HAL, BEL all looked pretty good in this environment, and the order book is swelling. So that's again a good advantage to them. And in the defense only, this one company from a small cap space, that's a DCX system. We are again expecting a good set of numbers, and the order books have almost doubled from what they were standing at last year. So these are the, sectoral, very, concentrated kind of pockets which we were looking at.
Okay, so a lot of defense names then. I find that interesting. HAL, BEL among them. Kush, today are you seeing especially BEL and HAL a further upside? Of course, there's no stopping that defense momentum for good reason. But in terms of charts?
There is, as you said, very strong momentum. But I think, now is the time to perhaps take some money off the table, as I said, partially, not fully, because this momentum could very well continue. And it's not just, I think sentiment, it is also a price action clubbed with very strong volume action over the last 3 days. HAL, BEL, these stocks have had volumes which are significantly higher than their last 20-day, 25-day averages. So last month average volumes, they're dwarfing those volumes now. So I think from that perspective, momentum could continue. So you wouldn't want to let go of what you're holding. Yes, but a partial profit booking along the way does not really hurt. And then again, you could re-enter these names as and when they see profit booking. So hold 50%, book 50% right now. and the rest, as I said, if you want to accumulate, as in when see a profit booking dip, you could re-enter.
Okay. Okay, let's talk about the stock of the day. Now, while we're talking about everything up and about, celebrations all around as far as the markets are concerned, not everything is having a good day. I mean, the sort of meltdown in Muthoot Finance is to be seen to be believed, because the numbers didn't look that bad. But tremendous pressure faced today with the stock trading with cuts of nearly 7%. Puneet is telling us why the pain in Muthoot.
Well, thank you for that. Definitely some key points that we want to highlight on the pressure for Muthoot Finance. The first one is, of course, the AUM growth in this particular quarter. Over 30% growth in terms of asset under management, but largely a lot of that is because of higher gold prices. Essentially for a gold loan company, when the prices rise in terms of gold, the loan to value ratio comes down, and hence the gold companies can actually loan more to the same client for the same asset as well. So that helps all these gold loan companies, and that's seen in the AUM growth as well. In this particular quarter, the customer additions were only 2%, and hence most of the gold loan growth in this particular quarter came from the rising gold prices. The second key reason is, of course, the guidance. They maintained for FY26 a 15% loan growth guidance, while the guidance as a whole percentage, it's not that bad, but overall last year, the guidance was over 40%. So definitely seeing the market conditions getting tougher going forward, apart from a higher base as well. The third key reason is the asset quality in the MFI portfolio. Something that's affected all banks, but the mid-cap as well as the small-cap banks are getting affected because of the MFI exposure. We've seen some large caps like IndusInd also impacted because of this. And the stage 3 loan book has inched up by 207 basis points to 5% now. That's a key concern going forward and a key monitorable for the market as well. The fourth key reason is the loan to value ratio. It's currently at 61%. We spoke about, as the gold prices keep rising, companies do tend to offer loans. The growth from here is limited for someone like a Muthoot, which is already a very dominant player in this aspect. It would depend pretty much on the gold prices, if they sustain or inch up forward as well. That could determine the growth. But if that is not the case, then customer addition will be something that the company will be banking on at a time where the competition has been heightened because of banks as well. And that's one of the other key aspects, the regulatory headwind. The management spoke to us about that as well. It has enhanced competition, of course, taking banks into consideration now. And that is the other key aspect. And finally, entry of multiple new players has also increased the competitive intensity. The one key aspect will be pricing behavior as well as the asset quality. But overall, these are some of the 5 to 6 key reasons impacting Muthoot right now. And valuations as well. I'm not sure if we have the valuation versus Manappuram. There you go. That valuation differential has always been there with someone like a Manappuram. It's almost inched up to 2 times now. So Muthoot trades at double the valuation of someone like a Manappuram. The 5-year book value average is also very similar, and it's trading at a very close to the premium that it has seen. So overall, some pressure on Muthoot. Valuations also are pricing in a very high growth for FY26, and that hasn't come yet, in just 15% versus 40% earlier. Watch out for this stock going forward as well.
Okay. Thanks a lot for that. And, it's interesting because, I think Puneet enumerated as well, you probably believe that valuations and maybe gold prices not rising the way they have been, probably one or two key factors. In fact, we spoke to the managing director of Muthoot Finance, George Alexander Muthoot, and asked him about the outlook on AUM growth. Listen in.
We generally give a guidance of 15%. Our CFO, etc., is ultra conservative. He always gives a very low guidance, and we feel that giving a guidance, we should be able to achieve it and overachieve it. As you said, we have been given 15% guidance, but after quarter H1, half year 1, we actually revised it, and in the last quarter, we again revised it. So I think today, let us go with the ultra-conservative guidance. Probably we look at it after Q2. Q2 results are out. Maybe we may think of revisiting the guidance. But anyway, 15% is what we have been guiding all throughout last 10 years. We have always been guiding 15%, but we have always been able to achieve 15, 20, 30, 40, etc.
Yeah, 7% lower for this one. The numbers weren't bad, right? Is it just the valuations? And does this 7-8% downtick kind of take care of the valuation froth, if I can use that term?
Yeah, Neeraj, to my mind, when the market is trading at 21, 22 times 1 year forward PE multiple, you are chasing a growth which should be higher than at least 20 times. So when the guidance is at 15, 16 times, and in the present scenario, how the ease in the geopolitical situation is happening, gold prices are likely to come down further. So this time the management may actually find it tough to achieve the guidance which they have given of 15, 16%. And when in the same space you are having NBFCs who are delivering more than 20, 25% kind of a growth. So that is one catch point. The other devil, in the basket, which to my mind was the asset quality concern. So microfinance is definitely in our trouble. We have seen that with many small finance bank space as well. And in this condition, when you're trading at a high valuation multiple with asset quality problem and your growth sliding to 15, 16%, and you're expecting not the same. At the same time, the macros are also advocating same kind of growth. I don't think buyers will come easy to Muthoot Finance. It may continue to stagnate here or some more downside left.
Okay. Kush, how are you looking at Muthoot on the charts?
I have a slightly contrarian view on this one. The reason being that if you look at the last two and a half years, in fact, early 2023, the stock spent very little time below its 200-day moving average. I mean, the worst it's gone is about 2.5%, 3%, maybe a little more below its 200-day moving average, and then almost immediately, found flavor and it shot up back. So right now, the 200-day moving average comes close to the 2070 level, which is still some distance away, but then the risk-reward ratio becomes favorable. So how I would trade this one is I would give it one more day, see if the downward pressure, downward momentum does in fact, overflow to tomorrow as well. And then if I do get it, between that 2020 and 2070 range, I think for me this becomes a good contra buy with a stop loss around the 1960 mark. So slightly contra bet on this one, but you perhaps give it one more day to see if this, this fall that you're seeing on the back of very good volumes, very strong volumes, does in fact overflow or stem here. So as I said, I'll be a buyer close to the 2070 mark with the 20-day moving average, a 200-day moving average.
Okay, so many stocks that are buzzing today, including auto stocks. I'm going to get a quick view because Motor up 6% today. And yes, the market mood is good, but this is something else going on. Of course, the con call take has enthused the street. Look at a Tata Motors, look at a Bajaj Auto, all of it looking really good. It's auto, it's metals which are shining today. So is Eternal, about 3% up. But there's a whole host of companies that are in focus because of either results or any other news, which is why they're buzzing. So Mahima joining us for all the top buzzers at this hour.
Right, so I'll start with Tilaknagar first. In terms of earnings, a great set of numbers for Tilaknagar this quarter. Overall, it recorded the highest ever quarterly EBITDA. Plus, Q4 FY25 has had the highest quarterly volume since FY15 now for the company. It's been both value as well as volume-led growth. In terms of number, revenue is up 14%, net profit up 2x. Even in terms of adjusted EBITDA, the overall adjusted EBITDA did very well in terms of operation metrics. Volume growth stood at 20%, and this was led by growth in Andhra Pradesh, which stood at 30%. In terms of guidance, they intend to launch a luxury whiskey brand in first half of FY26. They are expecting margins to be anywhere between 15.5 to 17% in FY26. The management also acknowledged the fact that they may see some competition coming in because of the UK FTA taking place. The next one is Jubilant Foodworks. Again, good set of numbers for this particular counter. In terms of the overall numbers, they delivered better growth as compared to their peers like Westlife. Strong margin outlook given by the management as well. 12% like-for-like growth was recorded, plus the order growth stood at 25%. Delivery has been a significant growth driver for Jubilant Foodworks. Around 22% like-for-like growth was seen in delivery sales, and the overall order growth stood at 32%. In terms of DP Eurasia, it contributes around 23% to its top line and 27% to overall EBITDA. And total investment so far done in DP Eurasia stands at around 1440 odd crores. Lastly, in terms of guidance, management has said that FY26 they are set to add 250 new stores of Domino's and 60 new stores of Popeye, and they expect to improve margin by 200 basis points in the next 3 years. Lastly, Bazaar style also is in focus. I think what the street is not liking about this particular counter is that the company has still remained in net losses. We've seen V-Mart retail and V2 retail come out with their business updates, but the kind of store addition that they have done, they've managed the cost as well. But here with store addition, the company has not been able to manage their cost, and which is why we're seeing net losses widen and continue in Bazaar retail style, and which is why we're seeing the downtick in stock. Otherwise, revenue was up 54%, EBITDA was up 69%, so good set of numbers there. Same store sales growth was also very strong at 20 odd percent. Private label share also went up to 47% from 42%, and sales per square feet also increased by 19 odd percent. They added 15 new stores this quarter, and overall FY25 added 52 new stores versus only 27 stores in FY24. So this is the overall view. This is the overall view of how these stocks, and as to why these stocks are buzzing and what's in focus.
Okay. Some more numbers on your screen. Welspun has reported, and you're seeing an uptick in the stock price as well. Looks like a good set of numbers. EBITDA is up 35% at 153 crores versus 113 crores. The margin number should be something that the street will like, up about 13.7% to 15% odd. There'll be a final dividend of 3 rupees per share as well on Welspun Enterprises. So decent set of numbers. Net profit is up about 29.6% for the quarter. So we're seeing that stock doing okay. A whole host of stocks that we've talked about. Dharmesh, I wonder what you made of Tilaknagar and Jubilant, if you've tracked those two and saw their numbers.
Yeah, Tona. I mean, Tilaknagar Industries is definitely a re-rating candidate. Jubilant was more of a business as usual kind of a number. So, see, being a product company and deliver 10% volume growth that too into alcohol and beverages segment is a difficult task which they have done. At the same time, the entire cleaning of the balance sheet, debt overhang, promoters pledge, everything has gone away, and the management sounded pretty confident. They have guided for operating margin of 16-17%, which is an improvement from 14%. This is the pro forma operating margin I'm talking about. Valuation wise is very cheap. If you compare this to say United Spirits or Breweries or Radico Khaitan is trading at 1/3 the PE multiples which those companies command. At the same time, the return on equity is quite good for Tilaknagar Industries with good operating cash flow. I think this will definitely, warrant analyst attention. And to my mind, 450, 452 should be the first stage of re-rating when from 27, 28 kind of a P multiple, it gets re-rated to 31, 32 with the same kind of a profitability growth. So the advice is to acclimate this stock, even if it is up 14% today. And maybe if one gets a dip, one should be acclimating it and hold it for at least a year.
Hold for at least a year on Tilaknagar. Kush, on charts, Tilaknagar and Jubilant, and any of the others that we discussed, if you want to add.
So maybe alternatives. So, for example, Jubilant hasn't really done much. 725. That's been a major resistance zone that is again acting up. Maybe in this space, you could look at an RB, a Restaurant Brand Asia, or even a Devyani International. There is some accumulation going on. In both of these names, they've had a good run over the last 2.5 months, and now getting ready for a launch. To the next level. So maybe some of these you can consider. Jubilant is an avoid at the moment. Tilaknagar also, is doing well. Of course, we know the reasons why. But I think the next stop for this one is at 365. If I had the position, I would book out partially. Maybe hold the rest for higher levels, but definitely take this opportunity to book some positions. I would suggest look at something like a Radico as well. This one's had a good move, is now consolidating. Close to the 2600 resistance, but I think once that is taken out, you could see this one zooming higher as well. So while Tilaknagar, yes, you could continue to hold, look at a Radico, and Jubilant is in a void. So RBA and a Devyani International are something that you could look at instead.
Just mark a couple of stocks which are flying around in trade, and a bit of a spurt in Anupam Rasayan, I believe, in the last few minutes of trade. If we can pull that one up as well, like there, 6.2% higher. Really strong show. Okay, on to the bull versus bear segment. And in today's session, we get you the bull versus bear argument by Puneet on Anupam Rasayan. Puneet.
We'll try getting persistent. We'll try getting a persistent view first. Definitely a stock, in news flow because of a negative news flow that's come in today. One of its key clients, United Health, which is one of its top clients in the healthcare space, is now being probed for Medicare fraud. Now, that is definitely one of the key negatives because in this particular year, for Persistent, healthcare was going to be one of the key growth verticals. It's roughly the third highest in terms of revenue for the company, so definitely a negative news flow there. We put the bull cases, the recent news flow on quarterly earnings. It's well known, very strong earnings, very strong deal wins as well. But this will be something to watch out for going forward. We had a note today from Dolat Capital. They are anticipating, let's look at the second bull and bear case, the 60% of Persistent's FY25 incremental revenue will be impacted because of this, and that came specifically from this one client, which is United Health. So that was a major portion for the company in terms of healthcare incremental growth revenue, that is compared to FY24, and hence going into next year that might be impacted. We've also seen the other verticals like BFSI is expected to continue the growth in FY26 at a time where we've seen within the developed markets we are only seeing BFSI as a criteria being spending essentially on IT. That could be one of the key wins for the company, but definitely this is a negative news flow. Finally, let's look at the near-term growth that largely will now be skewed towards the non-health only and could put a little bit more pressure for those clients to for Persistent to outperform at least on those clients. That will be the third bear case that we're putting. Company targeting $2 billion in terms of revenue by FY27. They are currently at 1.4. So anticipating strong growth over the next 2 years. And finally, in terms of valuation, and that's at 41 times price to earnings for FY27, one of the most expensive stocks, or actually it is the most expensive stock in the IT pack, and that is largely because of the company's growth seen over the last 4 to 5 years. That could be under pressure going forward from the newer verticals like healthcare. They have mentioned, or as I mentioned, the last 5 years have been incremental in terms of growth post-COVID. But now with this news flow, stock could be under pressure going forward as well. And the company, we will be awaiting some more details on this. But as of now, stock down in trade today because of one of its key clients facing probe in the US.
So just Puneet, thanks for that. And the number is, it's one of the top 5 customers. And the top 10 customers' contribution for Persistent is about 40%. So now you can kind of do the math that this could be about 8-9% of revenues, or maybe 12% of revenues as well, or thereabouts. And I mean, the number is not quite known because none of the IT companies give that name and the customer-wise breakup. But no surprise that Persistent Systems down about 1.47%. Dharmesh, at 41 times FY27 with a top client coming under pressure, does it call for caution? It does, right?
Yeah, definitely, yes. See, the one good thing about Persistent System, it was quite persistent with its growth trajectory in last 2-3 years, and it was consistent with all the numbers and the margins itself. This quarter earnings was also quite robust and quite good, with commentary being quite positive. But one has to look into the details of this entire probe, and definitely it's a cautionary stand. And these things are taken very seriously in the Western world, and definitely there would be some damage, and it's a reputational risk as well. I don't know how much it will come to the softwares which Persistent System has implemented there. That accountability has to be seen. But as of now, it's an avoid. Let's be on a cautious side. And people who have been invested into this company, I'm pretty sure they would be making good money because the stock price in that way is quite resilient. So I would recommend them to book money and be out of it.
Okay, so I got that joke, Dharmesh, persistent on persistent. And just to take it forward with Kush, IT having its moment in the sun, Persistent in a bit of a downtick today because of very specific concerns with a large client in the United States. But do you think there's more to this to this IT play?
I have been persistent with my call on persistence just to continue that conversation.
I think we should start fining for PJs, especially Kush should be fined for PJs.
If I had a penny for every. Lots of the news is being priced in because you saw that dip early in the morning, close to the 200-day moving average, about 55, 50 thereabout, and the stock is starting to inch higher from there. While yes, I'll be a little circumspect. I think the profit booking that you've seen in the last 3 sessions, versus something like a Coforge or even an HCL taken the larger name, I think that is suggesting that this something was in the offing and now we know what. I will perhaps give it a day or two, see if the 200-day moving average near the 550 mark is held. If it is, then I think this will just turn out to be a buying opportunity, as it has in the past. So still remain constructive, but slightly cautious because of the news flow that's come out.
Okay. So that's the story with persistent systems. We have to take a very short break, but I want to play out this clip that came in today while President Donald Trump, the US President Donald Trump, was speaking in Qatar. And he was talking about a conversation between him and Apple's Tim Cook. Now we'll play that out, but Neeraj, I found this baffling to say the least, because I can't quite understand what Trump is doing in the last few days. And these comments on Apple's plans for India, out of the blue, out of context, it was quite difficult to glean what he was trying to say.
Yeah, I mean, it was completely out of the blue, and I don't know if it's, I mean, why it needed to be done in the first place. But
yeah. Well, who can really understand what's going through his mind right now? But let's listen in. Before we get into that break, we'll come right back with closing strategies and more.
Apple, as you know, is coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff, you couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. Just want to address the numbers for Page Industries. If we can pull those up, it looks like a robust set of numbers. EBITDA at 43.2%. Margins, look at the margin increase. Net profit up 51.6%, but margins have gone up from 16.6 to 21%. Revenues up about 11% as well for the quarter. So that's the first cut of numbers coming in for Page Industries. Let's pull up the chart as well and see. You can see a bit of a spike there. Cooled off now, but looks like a robust set of numbers in the face of it. The fourth interim dividend is 200 rupees per share as well. Welcoming now Pankaj Pandey on the show. He's Head Research, ICICI Direct. Rajesh Palvia, SVP Technical and Derivatives Research, Axis Securities, also joining us this afternoon. Very warm welcome to you, Pankaj and Rajesh. Thank you for speaking with us. Rajesh, let's get your take. This is an expiry day move up, of course, but underlying strength that you're seeing on the charts?
So definitely there is a strength because if we look at the broader market, the broader market is clearly showing a good performance and buying interest across the sectors are there in the market. Looking at the breakout about 25,000 is giving more confidence on the street, and we believe that if we sustain about 25,000 level, I think mid cap, small cap space will also exhibit good amount of relief further. So we believe that about 25,000, yes, there could be chances that Nifty may extend its gain towards 25,200 to 300 kind of level also in the continuation of this up move. Definitely, this is today's move is purely based on the expiry based move because call writers needs to cover their position as the major call concentration area has been breached by the market in intraday basis. So I think 25,000 is the important level now for rally to continue further. At this juncture, 24,900 needs to keep as a stop loss to hold long position, and we believe that broader market will extend its gain, and another 2 to 3% kind of up move we may see in the coming week for Nifty as well as for the broader market also.
Okay, Rajesh, how are you trading? I mean, at these levels, I mean, is there a trade in the Nifty or the Nifty Bank? And couple it up with maybe the stock recommendations for this afternoon.
So definitely for Nifty, we are bullish and we have initiated buy even at the current level also with stop loss of 24,900 and projecting target of 25,300. So we are buying a call option of 25,100 at this juncture for next week. And for Bank Nifty also, again, after a brief correction here also there is a fresh buy signal on the near term chart. So for Bank Nifty also one can initiate long position, and we believe that till 55,100 stop loss is intact on Bank Nifty future. Here also there is a possibility that Bank Nifty may also extend its gain to 55,800 to 56,000 level because 55,200 call concentration area has been crossed by the Bank Nifty. So we believe that here also we may see short covering action. On the stocks front, two stocks idea which we are focusing for trading point of view. One is Tata Elxsi. If we analyze the weekly chart, there is a breakout of falling trend line on weekly chart for Tata Elxsi. We believe that here we could see further more traction towards 64.50. So one can buy this stock with stop loss of 6130. The second stock is from the automobile space, that is Ashok Leyland. Stock managed to view breakout of its multiple supply zone on the weekly chart. And the way stock is holding above now all its near-term, short-term moving averages, we believe that this stock may also extend its gain. And possible target towards 252 we can see for Ashok Leyland. So one can buy this stock with stop loss of 235.
Okay, a clutch of stocks doing so well today. Just before I get to Pankaj Pandey, so Nelcast is up 20%. HCL Info is up 20%, I presume because of the Semicon JV. I have no idea if HCL Info is anyway directly benefiting out of this JV or no. It's HCL Group, but be that as it may, HCL Info is up 20%, Kirloskar Oil 17%, E-Clerks up 15%, Tilaknagar is 14%, Apar Industries 13%. I mean, the number of double-digit gainers and some fairly popular names out there is fairly large. Pankaj Pandey, the broader markets, fourth day on a trot, doing so well. Today, just that they're not outperforming the large caps, but doing well nevertheless. Are you fishing for opportunities in the broader markets or are you sticking to large caps?
So, hi, good afternoon, Neeraj. So we are very constructive on the market, be it large cap, be it mid cap or small caps. I think the universe is fairly large for the broader markets. And the pockets which are sort of doing well. So for example, within large caps, I think one needs to be selective in banks. So for example, Axis Bank relative valuation wise looks attractive. SBI also looks attractive given the fact that overall ROEs are expected to be closer to about 1% odd. In commodities, we are liking both cement and steel as a pack, largely because in cement we have seen that the quarter-on-quarter improvement in EBITDA per ton. Along with that, the pricing discipline is sort of maintained, and I think volume growth is expected to sort of normalize to 7-8%. And these are the segments which we are sort of liking in the large caps. Obviously, there will be more stock-specific names as well. But in the mid cap or on the small cap side, again, beaten down names like even the ceramic players or even companies in the hotel or hospital side, I think both look very attractive to us, or even in the auto ancillary side. So I think it's a fairly large universe, like I said, but we are very constructive on the markets because while Nifty has recovered a good amount of the losses, but the mid caps and small caps are yet to sort of do. So I think price appreciation wise, opportunities are more in mid caps and small caps.
Opportunities more in small caps and mid caps. What are your favorites there, Pankaj?
So, for example, some of the names which are sort of structurally liking, one is in hospitals, HCG. In hotels, we are liking right from Chalet Hotels to ITC Hotels. I think the other stock what we are liking is NRB Bearings. I think this is one company which is trading half of the valuation of the MNC peers, and is now doing a capex of about 200 odd crores after a good period of time. And then I think overall sense is that Heikel and even Piramal Pharma looks good to us. While Piramal Pharma post commentary, I think 2026 looks out to be a washout year for them. But structurally, we are liking that. And similarly, Heikel also we are liking because most of their capex of 700 crore is largely behind us. So these are some of the names which are liking. The list is actually more.
Okay, it's always a good time in the market when there's a long list of stocks that the analyst likes. But let's talk about Vodafone Idea also in focus. They filed a fresh plea with the Supreme Court seeking over 30,000 crore rupees in AGR relief. Mukul Rohatgi mentioned the plea requesting an early hearing on May 19th, citing sector-wide impact. Let's bring in Charu for more. Charu, how many times can a company go to the court and ask for the same thing?
So it's as per the laws that are prevailing currently, you can go up to the Supreme Court when your original cause of action arises, and once you are not happy with the judgment that has come out, you can go for a review petition or a curative petition. However, here a fresh case has been filed by Vodafone seeking some more relief in the AGR dues judgment, and as you say, senior advocate Mukul Rohatgi appeared on behalf of the company asking the court to schedule a nearest date so that their grievances can be heard. They also said that government, despite being a major stakeholder in the company, cannot really help in granting any relief because they are sort of handicapped by the AGR judgment that the Supreme Court had come out with recently. So the Supreme Court is slated to hear the case on May 19th, so it remains to be seen whether they admit it or how they deal with it further. That's all we know for now, and we'll keep you updated with more details.
Thanks for that, Charu. Well, you know, it's so interesting that it's happened with a clutch of other sectors, but you know, Airtel and Vodafone are the classic examples. A lot of times people have thought of buying Vodafone because it's cheaper than Airtel, and all that the two stocks have done, if you can get a 5-year chart of both those stocks or 1 year chart, what have you, whichever time frame you look at it, I think Airtel would have outperformed Vodafone by a country mile. So no matter what news flow comes out on it, from a stock perspective, somehow nothing. Kush Bora, but we're talking about Vodafone. So let me ask you, because it's a heavily traded stock, is there a trade here? Oh, sorry, Kush Bora is gone. Okay, so but we have Rajesh with us for sure. So Rajesh, any thoughts on a Vodafone Idea?
The stock is not going anywhere. It's
Exactly.
It's stuck in the range only. So everybody is just making their trading position in view that maybe it could be a make or break kind of thing. So they are just taking their bets. If something happens on the positive side, so they may get some good return. But since so many months, there is no movement in the stock prices, stuck around 850, 900, 9 rupees kind of level. So it's not going beyond 9 rupees, and on the downside, stock is holding about 6 rupees. So I think 6 rupees to 9 rupees is the range. I think looking at the near-term structure on a weekly chart, if at all stock crosses above 9 rupees, then there is a chances that some reversal trade or some sign of reversal would be there on the near-term chart. But till stock is below 9, I think there is no point to make any kind of trading bet in this stock, because you have so many other opportunity in the market to deploy your investment.
Yeah. And conversely, Pankaj Pandey, is Airtel a buy now, or would you kind of wait for, or would you look at other sectors?
I think the telecom side, our sense is that every 20-24 months, we have seen a price hike, at least in the last 5 years. And a bulk of the capex for both Reliance and Airtel is behind us. So we would want to believe that the free cash flow generation in the next few years is going to be a lot more higher. And our sense also is that probably we might see one more round of a tariff hike, and which is why we are structurally bullish on both the companies. In order of preference, it will be Bharti, because Bharti will generate a higher ROS. Though the valuation of Jio probably could be on a higher side because of the other inherent business in it. But telecom is one business I think the worst is behind us in terms of capex. Numbers are going to sequentially improve. And if we get a tariff hike, we'll see further upside. So we are very constructive on the telecom as a space.
Telecom is looking good. What about auto, Pankaj? We haven't quite spoken about it with you, but you have all the auto stocks on fire. I'm going to pull up the auto index as well. Hero Motor on a robust and impressive 6.5% uptick. Even Tata Motors recovering from all of its blues that we saw in trade yesterday. What would be your favorites here, Pankaj?
In auto, I think you see a very selective performance. So, for example, on the four-wheeler side, you have my M&M clearly doing very well. They've been growing at mid-teen kind of a growth, especially their SUV portfolio. Tractor business is witnessing one of the best margins, expected to grow at 8 to 9% this year. So M&M clearly is the topic. And then I think Tata Motors can be looked at because when we are sort of valuing the company, the JLR business is valued at 2 times EBITDA. So from that perspective, if globally things improve, then Tata Motors can be looked at. Otherwise, on the two-wheeler side, what we sort of like is more of Eicher, because our sense is that they are consistently crossing 80,000 kind of a mark on a monthly basis for their volumes. And I think it's a good play on the premiumization, given the fact that the tax benefits will start accruing in. So that is another stock what we like. Otherwise, most of the other companies really do not look inspiring in the auto side.
To recap, your favorites are Eicher, Pankaj?
M&M.
Okay, Eicher and M&M.
And Tata Motors.
Eicher, M&M and Tata Motors. Okay.
Correct.
Okay, great. Okay, let's put the focus on Apar Industries. That stock was up 37% in the last week. The company also saw significant growth in Q4 revenue. Anushi, what's sticking for Apar again? 16% up today.
Right. So as you said, it's a 37% of an upside that we've just seen in the last 1 week or so. Strong trigger being also the fourth quarter results, which came out now here. We are looking at a 17% of a revenue growth. Margin stood at 8.8% as compared to 9.6%, but it was net profit, which is up around 6%. Now, it's the guidance forward, which is interesting in this for the company. Now, the company is to invest about 100 crores in capex for the next 12 to 15 months. In fact, if you look at the conductor business, they expect a conductor volume growth of 10%, and EBITDA guidance is also revised upwards. So that is something that we should be keeping an eye out for. Cable business, if we talk about, that is expected to grow at a rate of 25% with an EBITDA margin in the range of 10 to 12% is what we are seeing. For the specialty oil business, if we see the volume growth expected is in the range of 6 to 8% for FY26. The key monitorables here being firstly is the US exports. Now for this FY25, we have seen significant recovery in where the US exports were concerned. So that is something for which the commentary would be we would keep a track of. Chinese competition in other markets is something also that has been a concern. On how that could impact the revenue and the trajectory going forward is something that we should be seeing, and pace of re-tendering in Indian market is another factor to eye out for. Have a couple of brokerage notes also on focus. Firstly, Nuvama on Power Industries. Now they expect elevated profitability with shift to premium conductor side. Higher US export mix adds further to the growth potential for the company. Now outlook remains brighter with guidance raised, but however they've trimmed their EPS estimates for FY26 to 27 by 4% each. Now if you are talking about Prabhudas Leeladhar on Power Industries, they see a strong fourth quarter driven by domestic US recovery that we are seeing. They have as compared to Nuvama, they have revised their FY26 and 27 EPS upwards by 1.4% and 0.3% each, but they have cautioned for heightened Chinese competition in non-US markets may impact exports going forward. So this is the overall picture that we are seeing for the Power Industries. Overall, a strong set of recovery from the US side of the business, and domestic growth has remained strong, especially on the conductor business that we are looking at. So Power Industries in focus, and the stock has seen considerable gains in the last few sessions.
Okay, wow. But what a move today and what a move for the last few days. And Anushi, thanks for putting this into perspective. Pankaj, do you track a Power Industry?
So in the transmission and distribution side, we don't track the stock, but say some of the stocks, what we are liking is say something like Transformer and Rectifier India Limited. Now, our sense is that this company is also witnessing a fair amount of growth. Our sense is next 2 years from FY25 numbers, both top line and bottom line could be more than sort of doubling. So I think this is the entire T&D space hasn't seen much action for a good period of time. And last few years, most of the stocks are doing phenomenally well. So be it APAR or be it some of these transformer stocks. I think this space is going to remain interesting, because I think while we talk a lot about on the generation side, distribution is something which is still sort of ignored as of now.
Okay. Now 3:20, Rajesh Palvia, you've given us a couple of ideas already, but now that we're just 9 minutes away from market close or 8 minutes away, what is the top BTST or STBT?
Definitely, it's a BTST only in this kind of market. So Birlasoft is looking very bullish. The way stock has moved up in last couple of weeks. Now the stock managed to cross its 50-day moving average, and then looking at the derivative data also, we believe that here we may see further more traction towards 445, 450 kind of zone. So Birlasoft one can buy as a BTST with stop loss of 422.
Okay. So that's the BTST call for tomorrow. Now, the other sector which is completely in focus is the defense sector, and the country and the entire world has seen the might of the Indian Armed Forces. I had this conversation exclusively. We spoke to Ashok Atluri, Chairman and MD at Zen Technologies. We also spoke to Idea Forge, and you can watch that entire show on the channel later in the day as well. But some of the interesting comments that came in from that interview, and Neeraj, I must say, I was completely blown away with the confidence I heard from Ashok Atluri. This is something that we've been just saying, right? Indian defense capabilities coming of age. And I told him, Make in India is working. He's like, I'm offended when people say Make in India. We're not just making, we're innovating and we're designing as well. Listen in to some of the things he said.
I think from the point of view of the counter-drone systems that were very effective in neutralizing the kind of challenges and the kind of attacks we were facing on our side, we definitely have proven that we have one of the best anti-drone and anti-air defense technologies in the world. And some of it is indigenous, some of it we have gotten from our partners, some of it is legacy systems as well. And all of them worked in a layer format to prevent an attack on our soil and our territory. And on the other hand, if you look at what we attacked with, again, I think the technology has to be there to do the kind of precision attacks that we have done on the other side, where we have been almost inch perfect in terms of what we targeted and where those munitions landed and how they were able to create the necessary damage that we were seeking.
We want to get a sense of how big a paradigm shift this is. Mr. Atluri, let me begin with you setting the context, because this is something we're seeing externally, but the shift and the tectonic shift that has taken place in the Indian indigenous defense sector?
So, and now we are actually seeing that in the battlefield, the products have worked. This is a huge, huge thing. And I think the days for India to become a major defense player, not a made, so, when people say make in India, I do get a little irritated. It is design, develop, and make in India. The IP is owned by us. We are not just partnering with it. So that's one category. Of course, there are other categories, as you said. We are collaborating with foreign players to develop locally and then sell it. Yes, but this is a complete India game now.
Ashok Atluri, what needs to be done to push us to our goal of being export surplus country in the defense sector by 2047?
I think we'll revise it to 2027. I think we should be really working very fast. And and I think what the government has already done: easy policy rules, PLI schemes, banning of import. These are the kind of steps, and IDDM. If you get these thing right and then they insist that indigenization should happen, the IP should be Indian. I think we will be on track. And very frankly, Tamanna, we are almost there in the sense that 2047 looks very, very far away. I think by 2047 we will be really. I personally think we'll be the largest economy in the world.
Yeah, some very heartening statements coming in there from both Zentech and Idea Forge. Just a quick view from Pankaj, since we've been talking about this space, on what's happening in the defense pack and whether you would build any new positions right now.
I think defense is a buy on every dip because I think this is one of the few sectors where you are going to see, from a production perspective, 17% CAGR kind of a growth rate. On the export front also, while the numbers are expected to be lesser, but the growth rate is going to be higher. You pick any defense PSU stock, the order book to FY25 revenue would be closer to about 6 odd times. So there is enough work, and which is why I feel that a lot of private sector participation is also sort of warranted. So from that perspective, I think defense, be it HL, be it Bharat Electronics, PDL, all are looking good to us. Even on the shipbuilding side, I think we have far more indigenized compared to the aircraft manufacturing. And on top of it, I think some of the private players, what we like is Solar Industries and Astra Microwave.
Okay, what about you, Rajesh, on the charts?
I think from the defense, I think BDL is looking very promising, and Cochin Ship, these two stocks we are focusing at this juncture, and the way both stock have managed to give breakout, I think here we could see another 5 to 10% kind of rally. For BDL, we are projecting target of 2,000 rupees in the continuation of this up move. The way rounding bottom formation breakout happened on the weekly chart, I think 2,000 would be the next target. Buy and accumulate would be strategy. On the downside, one can keep a stop loss of around 1,700. Cochin Shipyard is also looking very promising. The way stock has formed a bottom, and there is a sign of reversal after consolidation of almost 7-8 month consolidation and then now breakout. So Cochin Shipyard is also looking promising. We are projecting target towards 2,000 to 2,100. Keep your stop loss around 1,720 for Cochin Shipyard also.
Okay, fair call. Point well noted. Final things, Rajesh Palvia, very quickly, the wind equipment or the companies, right? Inox Wind and Suzlon, both active. Do you like them on the charts at all?
So Suzlon and Inox Wind, both stocks, looking attractive at this juncture. Inox Wind is on a verge of giving breakout of almost 15 to 20 week consolidation range. So I think any move above 185 can take this stock towards 200 to 210 level. So yes, definitely one can buy this stock with stop loss of 174. Suzlon is also looking promising. Now stock is penetrating to its multiple supply zone of 61, 62 range. I think any move above 62 can take this stock to 68 to 70 level. So Suzlon is also looking promising after a long consolidation. Stock is now approaching to its multiple supply zone. So one can deploy long trade here also with stop loss of 59.
Okay, thank you so much, Rajesh. Thank you so much, Pankaj, for joining us today on what has been completely, very, very newsy and momentous day for the markets, I would say, because you're back at 25,000 after quite a bit of pain. The journey back to 25,000, mind you, has not been an easy one. We've had a global recession fear, trade war, geopolitical conflict, regional conflict, all of that before we've come back to 25,000. So that's why, you know, it's just a number in that sense, about 1.5% up on the Nifty. But the journey here is an important one for more reasons than one. It's an across-the-board move today, and that's what's really heartening. I want to pull up the advance decline ratio very quickly just before we get to the heat map in the last few minutes of trade. And the advance decline ratio looking robust. 1601 advances to 646 decline. This gap has been maintained through most of the trading day, and that's what's important as well. But the big bump up truly coming on the Nifty and from auto stocks. Let's pull up the heat map, the Nifty 50 heat map, and what a pretty sight. Just one stock in the red. That's Indus Ind after quite a damning report in one of the newspapers today, and that was just ending pretty much flat, not like with a big hit. On the winning side, because today is the day of winners, it's all about auto, 6% up on Hero Moto. Those con call commentary from the management has enthused the street. Tata Motors pulling back quite sharply and smartly after the downtick yesterday. Steel stocks in focus, JSW Steel doing well, so is Trent. So another stock from the Tata Group which is doing well. HCL Tech moving through, but even Bajaj Auto joining the party as far as auto stocks are concerned. But across the board, you're seeing quite a set of sharp up moves. I mean, the average win on the Nifty is between 1% and 2.5% up, and then of course you have the outliers there. But just the sectoral heat map as well, if we could pull that up before we get into more minutiae of what has worked through the day. The defense story continues to shine. In case you haven't got that conversation we had today with IdeaForge and Zentech, please do catch it. You'll see at 6 and 9 o'clock as well on NDTV Profit and on our YouTube channel, of course, at any given time. Over 2.5% on the Nifty India Defense. Realty stocks are showing a rebound, about 2% up there as well. Auto, so all consumption plays which have been hit with overarching fears, with those fears lifting, you are now seeing that play come back. Metals shining once again. Just let's look at the small cap and the mid cap intraday to give you a sense of what's happened there, because while it's the Nifty that has really seen that up move, you are seeing the mid cap 150 close near the day's high. Let me pull up the small cap index for you as well, and there as well you see it closing close to the day's high, not exactly at, but of course close enough to the day's high is where you're seeing the Nifty small cap 250 closing as well. I also want to pull up the top gainers and losers on the broader markets and see what's happening over there. It's all about the results. Today is the day which you're seeing a lot of double-digit gains, a lot of double-digit gainers in the broader indices, and mostly around results. E-Clerks is about 15% up. Apar Industries, again, good set of numbers, doing well, 13% up. VIP was actually not a great set of numbers, but you're seeing a rebound over there. The defense play continues with Cochin Shipyard. KEC International also doing okay as we close up. On the downside, Hitachi Energy was not a great set of numbers. Muthoot Finance, I mean, dropping gold prices. Gold prices have internationally dropped about 10% in the last 1 week, and that's what's reflecting in the Muthoot Finance stock more than anything else. Piramal Pharma also again on numbers. Easy Trip also not doing too great, about 3.5% down that we're seeing on this. So a lot of stock specific action that we're seeing. Now, what do you have to watch out for tomorrow? First of all, PPI. Important data points to watch overnight, and you will see some impact of this in the markets tomorrow as well. Possibly we'll of course get you the global aid set up in the morning. The producers price index, because right now very close watch on what's happening in the US economy. The inflation data for April was not half bad, but does other data back it up? Even initial jobless claims in the US will be an important factor to watch. The US Fed Chair Powell's speech is something that the street will be watching very, very closely globally as well. So these are some global cues for tomorrow. US industrial production data and Japan's GDP growth rate also will come in tomorrow. Well, who's declaring dividend? You have Keval Kiran Clothing, 2 rupees per share. Aptus Value Housing, 2.5 rupees per share. Advanced Enzyme and Aptech, about 4 and 4.5 rupees per share. IEX will give about 1.5 rupees per share, and State Bank of India will declare dividend of 16 rupees per share. Tomorrow is the record date. Aadhar Housing Finance will see a lock-in exit out to the tune of 35%, so you could see some pressure there. And of course, earnings in focus. Watch out for Hyundai. We're already seeing some very important commentary coming from Tata Motors, Delivery, Imami, Texmaco Rail, whole host of numbers that you should watch out for. Watch out for Nucleus Soft as well in tomorrow's trade as the numbers come out through the day. Well, so a lot of factors to watch out for. It's been a great day of trade. Will we close off the week with that kind of a move is what remains to be seen. But for now, for me and the entire team that put the show together, thank you so much for watching. Stay tuned for a lot more on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to NDTV Profit. You're joining us on this special conversation just days after a Japanese financial services giant, Sumitomo Mitsui Banking Corporation, has announced that they will buy 20% stake in Yes Bank. This is stake that is currently owned by State Bank of India and a clutch of other lenders, which SMBC is looking to buy at 21.50 a share. Now, of course, I am here at the Yes Bank house in Mumbai, and I'm joined with Mr. Prashant Kumar, who's talking to us about what SMBC's investment, SMBC's confidence in the Yes Bank franchise would mean for everybody who's watching this, including, of course, a lot of your shareholders who have been waiting with bated breath that something will turn.
I think first, thank you so much for being here and talking about this very, very significant transaction. And this transaction is not only confidence in India from Japanese second largest bank, but also in the soundness of the Indian financial system. And definitely the confidence in the franchise of Yes Bank. Okay. So this also talks about that a overhang for the bank, where State Bank of India and other banks were holding almost 33% equity, and since lock-in for them was over in March 2020. Okay, so there was always a question in terms of what will happen to their equity holding, how they would be replaced, and how the stability would come into the bank. And I think this transaction has actually clarified that issue, that SMBC is buying out 20% from the State Bank of India, and Japanese banks always have a very long-term strategic role. They have the patient capital. So I think they investing us is also a confidence in the franchise and also gives a stability to the bank, and they would be the largest shareholder for us.
So this pricing of 21 rupees 50 paisa a share, when the deal was announced, it was at a significant premium. But for an investor like SBI and the other banks who in 2020 had at that time entered Yes Bank as part of the reconstruction plan, for them also it's a massive sort of exit. How are you seeing this in terms of, say, valuation, rating for Yes Bank?
No, I think I would like to see in terms of bank continuously delivering on the both business growth as well as on the profitability. It's a continuous upward trend. Okay. And whenever we were speaking to the rating agencies, there were always two questions. The first question in terms of they would like to see a continued path of the profitability, which bank has demonstrated. Okay. Last 4 years, it's a profit. Last year was actually almost double the profit of the last year. Okay. And quarter on quarter, there has been a growth on the profitability. So that part has been addressed. The second question was more in terms of what is going to happen to the shareholding of these banks, how they would be given exit, and actually who are going to replace them.
Correct.
The worry was like if they are replaced by some short-term players like a private equity, then actually the problem is not solved. Okay. But since now they are replaced by a very reputed, the second biggest financial group in the Japan and the 15th largest in the globe, then I think that question is also addressed. So we are quite hopeful that there is an opportunity for the bank for the re-rating of the bank.
Now let me just talk about this investor. Now you've had PE investors, private equity investors come in the past, and they bought sizable stake to large private equity players. To your mind, what does patient capital do for the strategic intent of the bank? Because yes, they will be patient with their capital and they will continue to repose faith in the way the bank works. But to your, as a leader of a bank, how important is this for you?
No, I think what is important for us to understand, the private equities, their objectives are different. Okay. Normally, the private equities, they come for a period of 3 to 5 years. But the objective is always to maximize the returns for their investment. Okay. And when the objective is to maximize the returns, sometimes you don't contribute in terms of investing for the future. Yeah. Right? Yeah. But a strategic player, when they come in, they always would like to see that you need to invest for the future, so that there is a sustained improvement in the business growth and the profitability of the bank. I think this is a very significant difference in the approach of a private equity and a strategic investors like SMBC, which is again because of the objectives for both these funds are there. So I would always like to see that especially in a financial institution, we need to have the strategic investors, okay? Because sometimes you come with a short-term objective, okay, and you may maximize your returns, but whether you have really contributed to the long-term vision and the stabilization of the bank, I think sometimes there can be doubt around this.
Okay. You've obviously met with the management at SMBC, before this conversation has closed. I mean, it's been going on for about a year, because I remember I reported on it when the original conversations had started. To your mind or to your understanding, what is it that they want to achieve by buying a sizable 20% stake in an Indian franchise?
SMBC, they were interested in the Indian financial market, because if you see the growth of GDP in India, the fastest growing country. Okay. Similarly, the financial system of India is not only stabilized but doing very well. Okay. Now today, if you see the presence of SMBC in India, they operate through 3 branches, right? Delhi, Mumbai and Chennai. Last year they have opened a branch in the Gift City also. They also have a 100% subsidiary as a NBFC. Okay. Now this NBFC actually takes care, they have more than 1,000 branches in the NBFC. They take care of mostly the rural and semi-urban area for a very, very small borrower. There are 3 large branches, take care of very large corporates. So their own ambition in terms of having a presence in India in the entire banking spectrum, okay, Yes Bank actually completes that spectrum. Okay. So they have the very large corporates, they have the NBFC going into the rural and semi-urban, but they were not having a bank which takes care of the SMEs, which takes care of the retail deposits, which can take care of the commercial banking, and on top of it, Yes Bank has a very strong transaction banking platform and the digital capabilities. So I think these capabilities and the business segment complete the entire spectrum of a presence as a financial conglomerate in the Indian market.
Now, let me talk a little bit about the meat and potatoes of this investment, right? So you talked about this NBFC. Is there, or have they expressed any interest in merging these 2 entities? That could be one way of increasing their stake in Yes Bank and have a controlling position. But have they expressed anything? Because RBI on its own doesn't allow, say, 2 different lending entities under the same umbrella.
No, I think that I would first answer the second question. RBI doesn't allow a promoter to have more than one entity. Okay, they are coming as a largest shareholder.
Yes,
but they would be the public shareholder. Okay. They would not be promoter. Now, coming to the first part, I think this is a strategic call which SMBC has to take going forward. We are not aware about any such plans.
Okay, fair enough. This 5-year journey since the reconstruction, right? I mean, obviously, I think about year 2 only, most of the issues that were there before 2020 had been resolved. You then entered that one large transaction with an ARC to offload the NPAs off of Yes Bank's portfolio. As the leader of this bank for these 5 years, what have you picked up as probably crucial things that one needs to look out for? Because now that you have a strategic investor, a long-term investor, the focus is all going to be growth, growth, growth. So what does the patience of these 5 years teach you?
No, I think the first was always have a patience. Okay, because if you are taking care of a bank which is in deep trouble, okay, you need to have a patience in terms of first taking some fundamental corrections. Okay, don't go for any kind of aggressive growth. So I think what we have done in terms of correction of some fundamental issues which bank was facing, one was definitely in terms of the asset quality. We started with something like 17% NPAs. Bank has done the largest stress asset deal in the Indian space, which was like a 48,000 crore. And if you see the outcome of that has been highly successful. So not only we have been able to redeem more than 2/3 of the security receipts, okay, but we are also getting an upside. Okay, and today we are having 100% provision on our residual security receipt. So it means going forward, any recoveries coming from the ARC would be adding to our profit. And today we are having one of the best asset quality in the industry. Our net NPA is 0.3%. Okay. So asset quality has been completely solved. The second issue which bank was facing was definitely in terms of capital. Okay. We were actually below the regulatory requirement. And again in July 2020, bank raised 2 billion through FPO, which was again the largest FPO in the banking industry. Okay. We raised that, and subsequently in December 2020, we raised another 1.1 billion from the 2 private equities, Advent and Carlyle. Okay. And we continue to have a CET of 13.5%, which is good and sufficient to take care of our growth in the near term. But I think this particular transaction would also give, say, stability in terms of if there is any capital need going forward. We have a strategic investor who would be willing to contribute in that capital raise. Okay. The another part was in terms of deposits. Okay. Because of all these issues which bank has faced, the deposits have gone down to less than 1 lakh crores. In last 5 years, if you see, our deposit growth is 22% CAGR. Okay. Our CASA ratio has improved by more than 7%. We started with 26, now we are having a 33%. Last 18 months, every bank faced the situation and where cost of deposit for everyone has gone up. For us, last 18 months, cost of deposit has remained the same. So cost of deposit has not gone up. Okay. Bank was facing a very serious challenge in terms of not meeting the priority sector targets. And because of that, we have to keep funds in the RIDF, where the returns are 2 to 3% below the repo rate. Okay. And actually 11% of our assets were sitting in the RIDF, which was a huge drag on the profitability. FY24 and FY25, there is no shortfall in the PSL overall and also in any of the subcategories, right? Actually, last year, we have sold the surplus PSL in the market. Okay. So gradually what is happening, that 11% has already come down to 8.7%, and in next 2 years, it would be less than 5% of our total assets. So it would also help us in improving our profitability part. Another part, if you see in terms of cost to income, our cost to income was very high. This time the cost to income has come down to 71%. And actually, if you see the Q4, we exited at 67%. So we have a very, very strict control on the cost. Income is growing. We are quite hopeful in next 3 to 5 years, we are working towards bringing the cost to income below 50%. So I think all these efforts are going to help us not only growth, but a profitable growth.
Okay. Now, I want to talk a little bit about the business at Yes Bank right now. So 59% of your advances are in retail and SME, and that proportion has come up significantly over these years. I wanted to get on the ROA and ROE conversation, because wherever your portfolio might be, at the end of the day, those are the figures. You've doubled your ROA between FY24 and FY25, but it still remains sub 1%.